everyone. Welcome to day 6 of the Traders Conference. My name is Kelly Clement. I will be your YouTube host today, so I'll be back here in the background making sure all the magic works. We'll keep our fingers crossed that all the magic works. Anyway, so we are excited for another day of learning. We're going to get into our presenters today here in just a few minutes. But first, I'd like to introduce you to who we are, what we do. We are Metastock. We are the hosts of the Traders Conference. So I would like to show you just a quick video, introduce you to Metastock, who we are, what we do, and then I'll be right back with you to talk about today's schedule.
Hi there, Greg Lewis, Metastock Software. As the marketing director, I get asked all the time, what is Metastock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. Metastock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of Metastock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the Metastock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The Metastock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the Metastock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love Metastock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And Metastock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, Metastock explains how they work in an easy-to-follow commentary window. Metastock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. Metastock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the RMO. And as you become a more experienced trader, Metastock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Hey, I know that music just makes you want to dance. You know, how can you not dance to that music? It's just so exciting. Anyway, so that is an introduction to Metastock, who we are, what we do. Again, my name is Kelly Clement. I'll be your YouTube host today. As you come into the room today, make sure to say hello. Tell us where you're coming in from. We'd love to hear where you're coming in. Good morning to Gretch Armstrong, to Scott Gow. Good morning. Welcome to both of you. We're excited to have you here. Thank you for saying hello. We appreciate it. let's go ahead and talk about who our presenters are going to be today. So one of the things that you can do is you can go to metastock.com/traders-conference. I will put that up on the screen for you there. So you can actually go there to register for prizes and also see today's schedule. So go to metastock.com/traders-conference, and we can take a look here. I'll take that down for just a moment. So if you go to metastock.com, just directly to metastock.com, it will take you to, oh, that's not the right page. That's the right page. If you go to metastock.com, click on this little banner right here that says live all this week, register for the online traders conference. It will take you to today's schedule. All we have to do is click on Saturday here. And you'll see here that we are starting the day with Tushar Chande. We're excited for him. He's always got a great take on the market, what's happening, what's going on, and how to really analyze the market in a very clean, concise way. So stay tuned for that. And then after that, we have Mr. Barry Burns, going on to Toni Hansen, Buck Dormeier, Rick Sadler, Norm Hallett, and closing out the day with Martha Stokes. So we have an amazing day of education planned for you. Of course, all for free here with us as a sponsor. So we have us as a sponsor. We have Stocks and Commodities Magazine as a sponsor. We have AAII as a sponsor, and we have the CMT organization as a sponsor. So great organizations that are sponsoring this event and helping us bring you all of this great market education. So I hope you're excited for that. Hope you're excited for this awesome day of learning coming up. And again, go ahead and go to metastock.com/traders-conference to get registered for prizes. And I will put that link up one more time for you there. So just go there. You can also scan that QR code. It'll take you right to the page where you can register for the prizes and see today's schedule. So let me just go check, make sure everything's good to go on the GoToWebinar side, make sure we are ready to roll. And I will be right back with you to kick us off. Okay, it looks like we are all ready to go over on the GoToWebinar side. So we are going to go ahead and kick off this great day of education. Thanks for coming, everybody. Make sure to like and subscribe. It helps a great deal. Helps us bring you more awesome content like this. Have a great day of learning.
Hello. Hey, everybody. Hope you're doing well. Thanks for coming. You probably know me by now. My name is Jeff Gibby. We're going to kick us off. Thanks for coming, though. As we kind of enter the last day of the conference, I want to thank everybody for participating. I was talking to Kelly, who introduced us just a second ago, how well everything's been going. We've had a little bit of some slippery schedules and had to make some adjustments for internet and all kinds of stuff, but everybody's done such a great job. Attendance has been solid. And I hope you feel the same way, but I've certainly felt like the conference is going well. I've learned some stuff. And that's been great. So I want to thank you for coming. Want to thank you for coming in here. Garudas, I'll send you the recording. Garudas asks if we can get a copy of the recording. I will. I'll send it over to you. After today is done, about an hour after we kind of hit end recording today, go to webinar. Will automatically send you all the YouTubes for all of the days. I've got timestamps on everything, so you can go and easily find exactly the presentation you want. Everything except for yesterday, that is. I'll work on that after we get started. But anyway, good morning, Raymond. Good morning, Garudis. Hello, Scott. Hello, Gretch. As you come in, make sure to say hi. It's good to see you. Make sure to like and subscribe if you're watching this on YouTube. It helps a great deal, and we appreciate it. And I'm going to go ahead and get going. So let's go ahead and do that. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Good morning, Raymond. It's good to have you here. Good morning, Ghana. Thanks for coming. Before we kick it off, I want to say huge thanks. Stocks and Commodities Magazine for sponsoring our events, a long-running sponsor of all of the Metastock events, from the Online Trader Summits that we started 11 years ago to, I guess we've been doing the conferences for about three years now. So big, huge thanks for them, for their support over the years. We'll be giving away a couple more magazine subscriptions today, but we really do appreciate that. And if you want to get a subscription, go to traders.com and you can do that. I also want to say thank you to CMT Association. Last night we had a really good presentation from CMT Association that talked about, if you're looking to have assets under management or gain more assets under management, or if you want to trade for an institution or bank, having a CMT organization and having some good CMT designation, having some good CMT training can really help you with that goal. If that applies to you, and if you're interested, or you just want some really good market-related content, cmtassociation.org, 646-652-3300. All right. And then, here, let me just do this. Hey, it's good to see you again. Thanks for saying hi. AAII.com. AAII is a nonprofit organization. They've been helping traders. They've helped millions of them. They've been doing it since 1978. Hugely well-respected organization. We love the fact that they're partnered with us. And AAII.com if you want to find out more about them. So with that being said, we're going to kick off today with a great, we are Metastock. Metastock's been rated #1 30 years in a row. We've talked a lot about it. We'll talk a lot more about it. The offer that we're doing, and if you haven't tried out Metastock, you could. I mean, you should, and you can. So we've been rated #1 in our price category for 30 years straight. If you buy a month today, we'll give you a second and third month for free. You can find out more about that at metastock.com/conf promo. You can also get us online at metastock.com/sales chat or 800-882-3040. And so now, without further ado, our first speaker today is Tushar Chande. And Tushar Chande is somebody that is just a systems designer, a technician's technician. He's written a couple books. One was with Stanley Kroll called The New Technical Trader. You can see that right here. And Beyond Technical Analysis just came out. It's in its second, I don't know about just. Everything's, the older you get, the more recent things seem to have happened. The Tushar, one of the things that I like about Tushar is how good his systems work. I know some of the built-in Metastock systems that he built with stochastic RSI test so well for decades and decades and decades. And so today we're happy to kind of introduce Tushar, bring him on here. We're honored to have you, Tushar. Let's go ahead and get you started. How you doing?
Good, very good.
Good.
You got to turn my camera on.
Yeah, here you come. And then I'm also going to give you the screen.
Okay, great.
Okay. And then I'll make sure everything looks good before we. Okay. I can see the volatility. I can see your picture. I can see the non-expanded view of your PowerPoint.
Yeah, I'll expand. Just a couple of things. Thank you very much, Jeffrey, for having me here, and thanks to Metastock.
Thanks for coming.
expand my screen, but when I do that, I lose the sidebar here with questions and so forth. So, if you have questions, just feel free to ask them anytime. Jeff, you can interrupt me. But once I go to max screen on this, I can't see that. So that's the main reason.
No problem. I'll keep an eye for questions, and YouTube too. If you guys have any questions, let us know. Tushar, it's all yours.
Thanks. Hi, everybody. Welcome. I'm Tushar Chande. If you're in the US, welcome. If you're in India, happy Diwali. Wherever you are, thank you for spending your Saturday with us. I'll start by thanking Metastock once again for putting on a fantastic conference. Just tons and tons of good ideas. So if you get a chance, go back and look at the videos if you missed some sessions. And then today we're going to talk about seizing market volatility. So by market volatility, the terminology really means declines in the major market indexes, like the S&P 500. So we're trying to understand how we can take advantage of declining markets. So we will talk about how to anticipate declines, how to play defense during declines, and how to play offense during declines. I've assumed that 1/3 of the audience is new to trading, 1/3 is a discretionary type trader, and 1/3 is a systematic type trader. So for all of you, you'll find some tools and some ideas that you can use in your trading. So if you're trying to, I'm sure you're here on a Saturday because you want to get better at trading. So I hope that I'll give you some ideas that will really help you along the way. And the other thing to remember is that systems and indicators are interchangeable. So when I show you a system, I can convert that into an indicator. If I show you an indicator, I can convert into a system. So when you talk of a system, what do you need? You need an entry level or an entry point or an entry rule. You need an exit rule, and you need money management. So I'll assume that the money management part you will take care of, and I'll give you some ideas for entry rules and exit rules, and I'll show you one system where everything is hooked together. And rather than bog you down in piles of testing, I'll try to explain the ideas, because you can only trade what you believe. And I'm going to try to explain things in sufficient detail. So if you get the package and play with it, you will have the confidence to use it. So that's sort of the overview of where I'm going. I've exaggerated my mouse so you can see it on a smaller screen. I hope you don't mind that. Quick disclaimer, just like Jeff said, risk of loss in trading, past performance is not necessarily indicative of future results, and systems are designed with the benefit of hindsight that don't necessarily tell you how they will work in real time, because liquidity and stuff has changed over the test periods. And just one other disclaimer, I'll show you a bunch of charts, but they may not look exactly like what you'll see if you buy the package. And I urge you to buy it because it really has tremendously powerful tools, and you'll see that as we go along. Okay, let's get started. So as I said, we're trying to seize market volatility, that is, learn how to anticipate and take advantage of declines in the market. So this is sort of different from what you typically hear, where people are telling you things how to take advantage of when the market is rising. So we'll go the other way and say, how do we take advantage when the market is falling? So there are three areas. There's anticipate the declines, play defense, and play offense. And I'll start by giving you an overview, and then I will go into details. And again, if you have any questions, please ask them as we flow along, so that I can just answer things for you as you think of it. And don't be shy about asking questions, because if you have a question, you can be sure that 1,000 other guys have the same question. All right, let's go. So let's look at this chart without getting too confused. So this is the QQQ daily. And the indicator in the upper panel is something I call the reverse stochastic RSI. So let me just change this to a laser pointer, so a little easier to see perhaps. And the length of the calculation is 100. But let's ignore all that for a second and look at the upper panel. So the scale is 0 to 100, and we have a dashed line at 60. And what do you see? What you see is that when the market is declining, this indicator is rising. So this is, again, opposite of most typical indicators, which rise when the market is rising. So again, we have a little bit of a decline in the market. It's rising. When the breakout succeeded here, this indicator fell below 60. We have a decline in the market, a rise in the indicator, and when the market breaks out of this trend line, the value falls below 60. And then here, we have a rising value for this indicator. And then even though the market is in sort of a small consolidation, which it could go higher, on this one single bar, it pops well above 60 and then stays near 100 even when the market goes sideways. And this is January of 21, and this is January of 22. And I'm sure you know that this is sort of near the high of the move. So clearly, this indicator is anticipating declines. So let's see what happened. This is QQQ again. This is December 21 or January 22. This is the October low. So we know that it went down in, say, 5 steps or 5 waves. But look at what the indicator did. This is the same indicator, the reverse stochastic RSI. The scale is 10 to 100 or 0 to 100. And we have a line at 60, reference line at 60. So when the market fell, it rose above 60 and approached 100, pretty close to where the top occurred, and stayed above 60 for almost the entire move down. And it fell a little bit below 60 while we had a little rebound, and then when the downtrend resumed, it went above 60 again. So clearly, this indicator is rising when the market is falling. So we're using it to anticipate declines. Now remember, just because it goes higher above 60 doesn't tell us the depth and duration of the decline. So we cannot anticipate or predict how far the market is going to fall and how long it's going to fall. So it doesn't tell you anything about the x-axis or the y-axis. It just tells you there's a change in direction, and that should be sufficient for for most people. Okay. Now, again, part of the overview. Another way to anticipate declines is seasonality. Now, if you've been around the market, you'll have heard about seasonality about a million times. So this is the 1,000,001th time. But I'm going to do a slight twist on what you typically see. This is again a complicated chart, so let me explain what's on this chart. These are the S&P 500 returns starting in October of the calendar year. So if you look at the horizontal axis, it's monthly data, but it starts in October rather than January. So we're starting from October through September. I've done monthly calculations from the year 2000 to 2023, so September of this year. But I could change the starting point and get roughly similar results, or I could start from 2010 or 1990 and get approximately the same chart, though of course the axis will change. So what I want you to notice is that the average monthly return are these blue bars, and clearly, and the range is say +2 to -1.5 or +1.5 to -1.5. And you see that there are consistently months that seem to decline in the calendar. Now, as a professional money manager, you can't do anything about it because you have to be fully invested most of the time or all the time. But as an individual, you can take advantage of it because you can try to anticipate declines during these months, and particularly in July and August and possibly October. And this orange line is the equity curve, the value of a $100 investment. If you started in October and held it through, say, the end of July, on average, you'd do quite well. Though, of course, it shifts from year to year to year. So the idea of this curve is that you can use the calendar patterns, however imperfect they may be, to anticipate declines. That's all we're talking about, anticipating declines. So the next sort of group of ideas is playing defense during decline. So I showed you 2 tools to anticipate declines. Now we'll talk about playing defense. There are 2 basic approaches here. Suppose you are long something like Meta or Apple and or something else, and you want to, the market has changed, is showing that it may be reversing. Then what do you want to do? Do you want to get out at that point, or do you want to be stopped out at the point? So you can shorten your time period to accelerate your stop, and you can use an adaptive exit. So just continuing a little bit with the adaptation idea, this is another indicator. I'll explain that in a moment. This one fell below, say, the lower line at 20, and so you know that there should be a downtrend occurring. This is the SPY chart, 30 minutes, so we've shrunk the time horizon. And this is another indicator, momentum indicator called the Chande trend meter, which is part of the package. The CTM has 2 lines here at 80 and 20. So values below 20 means a strong downtrend, and values above 90 or 80 means a strong uptrend. So here, right at this point, you're somewhere over here. You're still above this low, so you haven't really had a breakout, but the indicator is suggesting that there's a potential for a strong downtrend. You could have gone short. Eventually, you would have been taken out by the trend line, some other trailing stop that I'll show you. And then there was a little rebound, And again, it went lower. Again, the indicator fell below 20. Got another leg down, then a rally. And then, of course, this is a rebound in October. So again, you can anticipate declines and speed up your stops by going to a shorter time period. And let me show that. This is Meta with a 4-hour trailing stop. The dotted green line is the 100-bar high. And Meta is clearly trending because it's hugging the 100-bar high as it moves higher. The trend meter on top is showing values above 90 along the way, which means this is a very, very strong uptrend. And there are two trailing stops. These are volatility-based trailing stops I invented decades ago. There's a 6x multiple and an 8x multiple. So you see the purple dots is 6x. It's closer to prices. And the red dots are 8x, and they're further away from prices. So you can have a tighter stop or a looser stop based on whether you have 6x or 8x multiplier. You could use a multiplier like 10x. It's sort of a matter of how much volatility you're willing to tolerate. So for example, if you had used either of these stops on an hourly 4-hour chart, you have been stopped out on this breakout. Take this breakout, you would have been stopped out over there or over there based on how you do it. So you can change the speed and reaction of your stops by either changing the multiple or shrinking the time horizon. So that's another way to play defense when you think the market is going to reverse, but you're not sure. So then you say, I'll just tighten my stop, let the market take me out. Lastly, we'll talk about an overview in terms of playing offense. So this is a very important system that you should be familiar with because it can be used in a variety of ways. It's a very, very robust system, and I'll show you in good detail. So this is a swing system. This is the 30-minute SPY chart. This is starting in October, so we had the sell-off in October. A clearly defined downtrend line. You see that we got an entry here that got stopped out, another entry here that got stopped out, and an entry here that got stopped out. So the stops are pretty tight, so your risk on any one trade is relatively low. And this is a very deep market, so the gap risk is low. And then right here on the absolute bottom of the move, the first bar up, remember, there's a 30-minute bar. So within the half an hour of the absolute bottom of the move, you got an entry. Now, you don't know what the market is going to do. So you can either ignore it because you can say, gee, I got 3 losing trades in a row. Or I think of it as, hey, I've got 3 losing trades in a row. The probability of a successful trade is higher now. And what do you think happened? I'm sure if you follow the markets, you know exactly what happened. The market rallied dramatically off this October low. But the important thing to remember here is that the system gave you a specific entry point, and it gave you a trailing stop or an exit point. So clearly, the speed of entry and the speed of exit have to work with each other and not against each other. So clearly, this is a system that buys near lows. So remember, in terms of market psychology, in terms of market commentary, in terms of all the external feedback, great negativity, people are talking, it'll go down to 3,200, 3,000, 2,800, great negativity. So it takes a lot of courage to step in and buy and put on a large position at this level. But the system does it for you. It automates the process of finding lows. And like any other system is not perfect because you could have a breakout system and a reversal or a moving average crossover and a reversal and so on. So the lack of imperfection of the system is not a problem. What we want to know is where is the signal coming? And the signal is coming very close to lows. And that's what the system is designed to do. And it gives you a trend following exit. So we're not holding it for 10 seconds and getting out. We're holding it, try to capture as much of the move as possible. So very different philosophy. Okay. So that's the overview. So now for the next, whatever, the rest of the talk, I will go into the details of what these are. Now, I have traded for a long time, and I can only trade what I believe. So my goal here today is to try to convince you, try to give you the logic behind the object or the logic under the hood. So you can believe when you see the results. For if you show your test result without telling you anything, you will not believe it, you can't use it. So I'm going to go into the details of the design, so you'll be more comfortable in using it when you buy the package. So the first part of the anticipating process is the reverse stochastic RSI, which is simply 100 minus the stochastic RSI. So it's the inverse. Now, the stochastic RSI indicator is already in Metastock. If you look at the list of indicators, you'll find it there. I did it a long time ago. It's in my first book and so on. And this is what the stochastic RSI looks like. So the scale is 0 to 1 by default, but I can multiply it by 100 and nothing changes. This is a 14 bar, which is default, but you can use any number you want. But what I want you to notice is that when the market is rising, the stochastic RSI is rising. When the market is falling, the stochastic RSI is falling. So the stochastic RSI is moving in the same direction as prices. Now, how does one calculate that? Now, I'll assume that the number of periods is 14 periods because that's the magic default, but it could be anything. So don't get hung up on this number in particular. So we first calculate the RSI. Now, the RSI, as you know, if you looked at the details of the RSI calculation, is the ratio of the up-day average divided by the up-day plus down-day average. So you separate the up-day momentum or the up-day daily changes and the down-day daily changes, and then you take moving averages, and then you take the ratio of the up-day moving average divided by the up by down. So which basically it's a ratio of momentum. It says what is the upside momentum over the last X days. So if you get a number of positive days as you would when the market is rising, the RSI rises. So as simple as that. Then you calculate the max RSI over the range and the minimum RSI over the range. And this could be anything. These two numbers don't have to be the same. Then you calculate the RSI minus the minimum RSI. So how far is today's value above the lowest value of the last X days? And then you calculate B, which is the range of the RSI values over the last X days. And stochastic RSI is simply 100 times A divided by B. Again, this could be 1. And the reverse stochastic RSI is 100 minus stochastic RSI. So I'm going into this so you have an intuitive understanding of what the stochastic RSI is. So we're combining the stochastic concept and the RSI concept to get a range location oscillator for the RSI. So it's a second level indicator. So this blue bar is the range of RSI values. This is the max RSI values. NP is the number of periods using the Metastock notation. This is the minimum value. So this minus that is B. This is the current value of the RSI. So this minus the low is A. So stochastic RSI is simply A divided by B times 100, or you can just leave it at 1. So it's the range location. Where is the current value located within its range over the last X days? So clearly, if we are at the top of the range, then A is equal to B. So it's 1. So A is equal to B. Stochastic RSI is 100, and reverse stochastic RSI is 0 because 100 minus 100. So the converse is true, right? So if you're at the top of the range, these two amplitudes are the same, so the value is 1 or 100. And if you're at the bottom of the range, then it doesn't matter what B is because 0 divided by anything is 0. So then the stochastic RSI is 0, and the reverse stochastic RSI is 100. So you see that when that's why in the earlier chart I showed you when the prices are falling, RSI is falling, but so it'll be 0, let's say, in the limiting case, that RSI would be at the bottom of the range. But then the reverse stochastic RSI will be at the top of the range. So the reverse stochastic RSI rises when prices are falling. So we've gone back to the same chart I showed you before, the stochastic RSI. But this is what I want you to observe. So this is the 14-day RSI. This is 70 and 30 are the reference lines. So you see that the RSI itself is in this range of 70 to 30 for this entire down move, which was quite stressful in the market. So we got no signals from the RSI because it was never really overbought or oversold in this region. But the stochastic RSI gave a completely different story. It is overbought and oversold and overbought and oversold because, for example, when RSI started to fall here, stochastic RSI fell. And then somewhere over here, when RSI was still in the middle of the range, the stochastic RSI is telling you, hey, RSI is at the bottom of its recent range. So you see that the stochastic RSI is a much more responsive indicator than the RSI itself. And part of the reason is the RSI has a lot of smoothing using sort of a weird variation of exponential moving averages. So it's heavily smoothed. So it rarely goes above 70 or 30. Whereas stochastic RSI is responding much, much, much faster. So that's the beauty of the stochastic RSI. So once you understand that, now we can build to the next level. So this is still the stochastic RSI. I've used 100 bar just to get a long value. So typically 14 days is an odd number. If you round down to 25 or 12.5 rather, which is near 14, then as you multiply it, you get 25, 50, 100, you get nice round numbers. So I'd rather use 25, 50, 100, and then my low number would be, say, 12 or 13 rather than 14. And anyway, the trading week doesn't have 14 days. So the scale here is 0 to 100. We are at 60 as a reference level. So clearly, when the prices are rising, this is a significant rally during the summer, and this is 2021. You see that the RSI was rising, the stochastic RSI was rising. So exactly consistent with what I've said so far. So let's go back to where we were before. This is a chart at the beginning. This is January 21, January 22. This is the market top. Prices fall, market declines, RSI goes up. Reverse stochastic RSI is 100 minus stochastic RSI. So at this point, you should intuitively understand why the stochastic RSI or the reverse stochastic RSI is rising when prices are falling. So it's intuitively much easier to understand. Oh, this value is high, market's going down. Simple as that. Okay, so now here what I've done is I've plotted both. The red line is the reverse stochastic RSI. The green line is the stochastic RSI. This is the QQQ. That's the January high. This is the October, December lows. And then this is a rally into July of this year. And this is the consolidation. This is the October, November. This is the October low and the November bounce, right? So green up, markets going up. Red line up, markets going down. It's as simple as that. Why is that important? Because right over here, you see there's tremendous optimism. All the, big brokerage houses are predicting 5,200, 5,400. What happened when we were down here? When we were down here, all the major technicians were saying 3,200, 3,000, 2,800. We reversed. You don't have to take other people's opinions for it and believe the chart. That's what I say. Now, you can see that this does get a little choppy. That's not the fault of the indicator. This is based on what the market itself is doing. But when it approaches a high value, there's a strong trend. And for example, here, it's a little slow to react, but when you're down here, it's above 60. So you know that there was a negative to declining period. Now we're continuing with the stochastic RSI, but we're down to 50 bars. So that the previous chart was 100, now we have 50. Now you see, what do you expect? You expect that the sensitivity of the indicator will be greater because we have shortened the time horizon. We'll respond much faster. So green line up, uptrend, red line up, downtrend. So if you look at this July high, you see that it responded almost immediately and went above 60 and approached 100. And it stayed that way during the entire decline. And now we just had a crossover here. And, we know the market is probably going to be in rally mode. And then you can see that we had these brief blips of red above, a brief blip of red above, green above, because the market is just reacting to what the market is doing. And you get more crisscross, more crossovers if you shorten the time frame. We shorten it even more. So you see we have 12.5 times 12. Twice of that is 25 and 50. So I'm coming down towards the default values. And you see that again, you get much more rapid crossovers. You get more choppiness. Again, when you have this rally up here, say it stayed green. When you have this move down, it changed to red right away and stayed that way for most of the time. So it's more responsive. And for example, here you can see that we turn red right away, then we turn green because it saw this bounce and so forth. So only you can determine what the right value is for you. But we are trying to anticipate trend changes. And it's very easy. Red line up means downtrend, green line up means uptrend. And you can rely on what the market is doing and not get, not have to rely on somebody else's opinions or, whatever you don't understand why they're saying what they're saying. Okay. Now I'm back to the 100-day stochastic RSI, but this time I'm using NVIDIA. The idea here is that we're not limited to using this concept on indexes. So NVIDIA, this year's darling, had this fabulous downtrend. You can put a channel here if you want, and all the channel, people who love channels will say, hey, this broke out here, and it was inevitable that it'll go wherever it went. My point is, if you look at it over here, red line above, downtrend. It stayed above in the downtrend all the way to the lows. Just over here, as it started to recover, we had the first hint of a potential change because we green line up. The trend line initially pulled, rejected the up move, so it came back down, little pullback. But you see in this pullback, the red line never crossed over 60. And when it broke out here, there was still a lot of debate. Was it a real breakout? Is it going to reverse, go back down, make a double bottom? Lots of theories. You didn't have to think about it because green line above, uptrend. And if you wanted, you could have traded it. Now remember, just because we got a green thing here, it doesn't tell you where it's going to go. So this indicator will not tell you that it's going to get over there, which is a fabulous move. But we're just trying to anticipate changes in direction and anticipate direction. So for example, here doing this big move up here, we were green, this move up here, we were green, and so forth. So the point here is that trust the market, trust the prices, trust the indicator, but the indicators have their limitations. And then just to wrap up this, connect the two anticipatory indicators. This is the Chande trend meter. This is again NVIDIA with a downtrend line. And we know, I've told you that values above 90 imply a very strong uptrend, value below 10 imply a very strong downtrend. So during this entire downtrend, it never went above 90. So the fact that this, to take a step back, the calculations inside the CTM are completely different than the stochastic RSI or the reverse stochastic RSI calculations. So the CTM is a multi-indicator, multi-time period combo of many indicators, patterns, returns, and so forth. Much more complex, much more powerful measure of overall momentum. But because we had this unique downtrend and a strong kickoff above this trend line, both the indicators are confirming that we have a really strong trend. So when you're up here, and there'll be some skeptics still saying, oh, it could go form a double bottom down there, you can say, well, I think there's going to be a strong trend. But again, it doesn't tell you where it's going to end up. Okay, so you can use the indicators to anticipate a downtrend as well as confirm the change in trend. Okay, so take a little break. I know I've thrown a lot of ideas at you. So now I'm going to talk about seasonality. Now, seasonality is has been, as I said, this was the 1,000,001st time you heard of it. It does exist. No one can explain why, but it does, and it may relate to the mechanics of, the economy, but who knows? Seasonality is not perfect. So whenever we talk of seasonality, it's always spoken of as though there's hardly ever any deviations from it. That's not true. Is not perfect. But you're an individual, you can exploit it. And as I said, my analysis is from year 2000. I could have started in 2010, I could have started in 1980 and got essentially the same results. Okay, you've seen this chart. This is the average monthly return from 2000. This is the average monthly return starting in January. And these are individual monthly returns. So there's some weakness at the beginning of the year, then rally, then a weakness, and summer rally, then fall weakness, and the fourth quarter, seasonal rebound, etc. So how do we take advantage of that? So here, now let's take a step back, and you see that the range here, say +2 to -2, or +1.5 to -1.5. And like always in statistics, the averages don't tell you the whole story. So if you look at the entire range of events every month, then you see the scale now goes from 15 to -15. So that's a completely different range of events than if you just look at the blue bars, which are the averages. So the blue bars by themselves are deceptive. So you see that, for example, in October, you can have significant declines. And this year was a good example. And 87 is a classic example. So October has seen some major declines and major lows. But if I just showed you the average, you don't get any sense for how severe the declines could be, and so on. So something to remember is that the averages tell you one story, but in actual trading, this thing can shift back and forth based on whatever the momentum is doing for that moment. So this is a different measurement. This is saying, if I look at all the months of January, what proportion of them are profitable? That gives you a sense for what's the tendency. So say more than 70% of the month of April were positive. More than 80% of the Novembers were positive. So what we want to do is we want to say, well, the range is what it is. It can be huge, but let's look at the percentages and the probability of being positive and rearrange our trading situation that way. So since October, November, December are a trio of positive monthly returns, or months with high probability of being positive, let's rearrange our calendar. So I've replotted the data from the previous slide, but starting in October. And now you see that we have positive months here, a little dip, another rise, and then sort of a drop off. So this tells you that you can use it to anticipate declines. I've shown you, because of the huge range that is behind the averages, you don't know exactly when it could shift forward and backwards. But there's still some tendency that you can prepare your portfolio for. And then I've shown you this chart. This is October. This is the equity curve. But what I want to show you is in the next slide. So what happens if you just eliminate the months that could on average be negative? As a professional, you can't do that because you're 100% invested. As an individual, you could. So for example, if you just did October, November, December, then March, April, May, and June and July, you get an almost straight up equity curve. As an individual, you can do that. As a professional, they can't. So that's the whole idea. The idea is that if you want to take, so this is a twist on the seasonality. That is, of course, we understand that seasonality is what it is, but most people don't show you the range. So the range is tremendous, like 10 times the averages. So the range can overwhelm your strategy. But because you're an individual, you can say, well, I'm just going to participate in these months that I've shown below. And on average, if I do it year after year, I'm going to be ahead. So in any given year, it could deviate from this curve. But if you do it for the next 20 years, it might work. So that's the whole idea. Okay, enough of seasonality. I'm going to talk about adaptive exits and shortened time frames. So I've already told you that I use a prior channel, some channel and subtract. So you take a channel and you subtract some multiple volatility from the upper channel and add the same amplitude to the lower channel. So you get two lower channels that you can use as stops. And the calculation of the volatility is a little tricky, so it's kind of complicated. So I'll just focus on the multiple aspect. This is the daily data. I showed you the Meta 4-hour chart. So again, 100-bar breakout kept going higher. You could use, so if you had used a 6x multiple, you'd have had the purple dots. The 8x multiple gives you the red dots. And the CTM here you see was above 90 or above 80. So it told you there's a very strong trend. So now we're seeing this after the fact. But if you were here, should I get, and it pulls back and you get breaks out again, would you have taken this breakout? You might have some hesitation and so on. So that's where the indicator can help you. Can help you reinforce the probabilities are in my favor. Maybe I should take this breakout even though I got stopped out here and so on. So trading is full of sort of negative feedback. So you really have to believe strongly in order to stick with a system or a process. And you'll find that unless you really, really believe in it, you can't trade it. So that's why I'm trying to go into the details and give you a sense of what we're trying to do. And sort of, so this could be a system. You got a 100-bar breakout, confirmation of the CTM, and a trailing stop. So, those are the ingredients of a system. This is a 4-hour stop. I showed you again. You see that it's moved much closer to prices. And this is a 1-hour stop. Now it's even closer to prices. Now, if you're a short-term trader, you can say, I just want to buy little swing moves. Then a tight stop may be okay for you. So I don't know what the right answer is for you. But the point is that you can take exactly the same idea, the same stop, but just apply it in different time frames or with different multiples to get completely different outcomes. So if you test these things, you'll get completely different test data. The metrics will look completely different. So the combination of entries, exits, trade sizing, and the multiples can have a profound effect on your test. Now I want to show you that so far I've showed you sort of mostly up trends, but I want to show you that the logic already works for downtrends because I told you that you add you subtract a multiple from the upper channel and add a multiple to the lower channel to get this trailing stop. So this is a 1-hour chart of Tesla. And you see that the CTM fell below 10. So, it's a very strong downtrend. You're somewhere over here. So let's say you shorted Tesla over here. When you get out, well, this is the purple dots are the trailing stop for a downtrend. So just to illustrate that the logic of the exit works whether you're long or short. It's just a matter of what your trade is. And I've blanked out the rest of the lines for clarity. So. And actually, there are 4 lines, but I'm only showing 1 line. So the strong downtrend, you see this amazing below 10, really, really strong downtrend. Eventually, it comes up a little bit, but here's the point. Once you enter the trade, what happens here is irrelevant. Only thing that matters is what your stop is doing. So this is for entry. The stop is for exits. And we don't really care what happens here in terms of when you're in the trade. So you would have got stopped out somewhere over here. And this is an hourly chart of Tesla. And Tesla reversed and went higher. So again, here you could say enter when it first went above 90, you'd be somewhere over here. At that point, you don't care what happens here. and then you just have a trailing stop like the red dots have shown you in the other charts. So this particular exit is very adaptive and powerful. For example, here you see that there's a strong up move in Tesla, and the stop moved up rapidly. Tesla went sideways, the stop goes sideways. So in terms of stop management, this is a very easy stop to live with, and you can calculate your risk every day exactly, put in your stop, and you're done. So very easy to manage. All right. So we've talked about anticipation, defense, and now offense. So this is a very important system that I think would be very useful for you. So let's take a look at that. So it's in the package. It's called a counter trend system. It buys strength after weakness. So it's looking for weakness and then a little bounce and wants to catch the bounce, assuming the bounce will follow through and be successful. It uses a trailing stop for exit. So the big challenge here is, how do you identify that there's a decline? How do you identify there's a rebound? And how do you balance the entry, the speed of entry with the speed of exit? And I'll show you that I found the proper balance. And if the two are not balanced, you get a lot of chop and noise. And then there's a little additional information below. So this is TZA, which is a direction small cap bear ETF. So it's an inverse ETF. Now I'll show you a number of examples of inverse ETFs, but they are very volatile. So I'm not saying it's the right product for everybody. I'm just showing it as an example of how you can make money even in a downtrend. So essentially, buying this is the same thing as being short the market. This is a July high. Market went lower, but this direction small cap bear ETF went higher. So you see we're in this downtrend. We got a losing trade, losing trade, losing trade. So probability of a winning trade goes up. We enter this time pretty close to the low again, go through, get stopped out, one trade. It re-enters, keeps going through, gets stopped out, and we lose quite a bit coming off here. But you could change, this is daily data, you could change to a hourly chart or 4-hour chart, and things will move faster. But the important thing is the inverse ETFs are rising in a falling market, so you can make money in a declining market with an inverse ETF while using the swing system, because you're looking for swings in the market. So here I've got the 4-hour TZA. The upper panel is a 7-period stochastic RSI. So I spent a lot of time earlier on in the talk talking about stochastic RSI. So decline, rise, we buy. Decline, rise, we can buy. The scale is 0 to 1. Anytime it goes about above 0.8 or 80, it's a strong trend. You see, we were using 60 or 0.6 in the earlier charts. So classic setup, we have a decline. We have a decline in the stochastic RSI, then it rebounds. So we buy the rebound, and we don't know where it's going to go here. We get stopped out, we get long again, and go that way. So these green lines and red lines are just there for approximation, just to give you a visual aid. They're not exactly precisely what the system is doing, but this ballpark tells you what the system is trying to do. This is crude oil. So we are applying the same rules without any changes. That's very important, to a different market, the crude oil market. And again, you see the same setup: strong sell-off, rebound, sell-off, rebound. This is 6-bar stochastic RSI. Strength, we're buying strength, follow the thing, get stopped out. And now we have a triangular consolidation here. So a couple of losing trades and probably going to get a winning trade soon. Sell-off, strength, sell-off, strength, sell-off, strength, and buy the strength. Keep going, get stopped out. Weakness, strength, re-enter, keep going, we'll get stopped out. So the important thing here is that we've created a completely different market, different liquidity, different drivers, different macroeconomic factors, but with exactly the same rules that were written many moons ago, with no optimization. So the system is capable of responding to some fundamental way in which markets behave. Now, let's just look at here for a second. So one of the ways you can find trading opportunities, because you can say, oh, that's great, I love that chart, but how do I find things in the future? So here I've simply scanned the currency markets using CTM, and this is a scan that's built into the package. And if you look at Japanese yen, it has high trend, it's trending well. So let's see what it looks like. So again, you bought near a low, beautiful move up, got stopped out, decline, strength, buy the rebound, follow up, buy the rebound, buy the rebound. So we've used the swing system during a long uptrend on a completely different market, the currency market, but it has worked exactly the same way. It looks for a little weakness and buys the rebound. I've shown you a number of examples for TZA. You're wondering why I did that. So here, what I've done is I've only taken the major index, a 3x leveraged and inverse ETFs. So I have the TZA and TNA for the small markets. I have QQ, SQQ, TQQ for the QQQ. I have the XP, XS, and XL for the S&P 500, and the SDOW and UDOW for the Dow Jones. So clearly, with the markets on a downtrend, the bear ETFs are on top. With the markets in a bull trend, the bull ETFs are on top. So here TZA is on top. So we know it's a bear trend. So that's why we looked at TZA, and this is the chart I've seen you before. Again, we were in a downtrend. Market bottomed in late July, early August. We took care of that. And even if you didn't follow this, we anticipated declines at the beginning using the stochastic RSI or the reverse stochastic RSI. Then you could say, how do I implement this logic? How do I take advantage of this logic? You can take advantage of market declines by trading inverse ETFs. Now, these are volatile objects. They're not right for everybody. But just schematically, if you wanted to take advantage of declines in markets as implied by the stochastic RSI or the reverse stochastic RSI, you could use a swing system buying near lows, right? We're buying near lows. Low, we're buying. Low, we're buying. This is another scan. This is TTT here at the top. Again, we've scanned a bunch of pro shares ETFs. So this is a long list of pro shares, leveraged and non-leveraged and whatever ETFs. I've ranked them by CTM value. 100 means a very strong trend. So let's look at that. So the TTT is ultra short bonds. So we know that one of the reasons the stock went down is because rates started rising and went to 5% or thereabouts on the 10-year yield. So when interest rates are rising, bond prices are falling, but the inverse ETF is rising. So rates rise, inverse ETFs rise. So this is rising because rates are going higher. Completely different instrument, different logic, different macro factors, but the system is working the same. We got a low, we bought it, got stopped out, rebound, bought it, got a nice move up, decline, rebound, buy, and follow it higher. So we're using the same logic, the same rules with no optimization on a completely different market to take advantage of rising rates. Okay, let me go a little faster. I think we're running out of time here. This is a scan I did last night. I picked this because there was some, okay, let's just come over here. So this is a scan using the swing system that's built into the package. You see, again, this time I ranked them for volume. I scanned everything in the NASDAQ, and there are a lot of low volume things we don't want to trade. The first few things are the direction leverage ETF. So I said, let's not do those. The first one that was not that was Valvoline. So I said, let's look at Valvoline. Downtrend, three losing trades in a row. We got this rebound and an entry. So exactly, weakness, strength, we're buying strength. So example of finding opportunities using the scan. So it can be applied consistently in any time frame. For example, this is quarterly data on the S&P futures. You see, this is from 1998 to 2024, a very long time period. This is the 2021 declines. We bought the rebound, sold here. This is the 2008, 2009 declines. We buy the things over here. This is the COVID decline we bought over there. So the logic can be used at quarterly basis. If you're a big institutional portfolio type. Monthly, again, this is the 2008 decline. We got pretty close to the lows, go higher. Buy the rebound, goes higher, goes higher. This is a COVID, goes higher. So we're using a monthly data with the same logic, no changes. Weekly data, this is the the COVID decline, rebound, buy that, and pretty much go all the way to the top. We got a series of 3 losing trades in a row during the decline, then the rebound, July high, etc. Daily data, this is a move from May, June, July. We bought at the beginning of the move, followed all the way to very close to the top. A false trade here. Again, this is a move in January. We got that here. And then this is 4 hour, again, beautiful moves, losing trades, but tight stops, so it doesn't matter. And 1 minute. So again, losing trade, beautiful swing move, gets stopped out there. So the point here is that we've taken the system rules and used them on a very broad time horizon from quarterly data to 1 minute data without any changes. And it worked very smoothly. So these rules are very robust. They can be used on any instrument and chart time interval. And you can use it to, even if you don't trade it, you can use it to confirm market direction because, hey, it went higher. Conversely, if you get stopped out, you can say maybe it's overbought. I can use it to do options in terms of selling out of the money options or so on. So you can use it as a confirmation or to drive option strategies. So that's the summary. For anticipation, I showed you reverse stochastic RSI and stochastic RSI, seasonality, defense, shorten the time period, adaptive exit, and the swing system. This is the code for the stochastic RSI and the reverse stochastic RSI. So that's just a default code for the stochastic RSI that you'll find in Metastock multiplied by 100. And then just add reverse stochastic RSI is 100 minus stochastic RSI and a plot of the line. So easy peasy. The package itself is really powerful. It asks the question, is it trending? So you have a tool for that, and systems, and you have tools for that, and with trend following exits. So this is the Chande trend meter. This alone is worth the price of admission. I've shown you the swing system, fantastic system, tremendously useful, worth the price of admission. And I've discussed the long-term system elsewhere and the volatility system elsewhere. And then a quick example of the volatility system with HOLX, Hologic. Again, a scanner did last night. And you see that there was a huge bump up. This is typically what you expect to find when you had an earnings report or whatever. And again, you can use it to buy above this high as a confirmation. Or if you're using option strategies, you can say, well, maybe I'll sell out of the money options or whatever it is that drives you. But you can use the volatility breakout system to find these kind of huge breakouts in the market. So I'll wrap up with that. The package itself is easy to understand, simple to use, very, very powerful. Everything is very clear and laid out. You can use it on any time frame and any exchange. And I hope you'll get that using the link below. All right. Thank you very much, Jeff. It's all yours.
Thank you, Tushar. We just had a question actually out of the GoToWebinar.
Sure.
And you want to know, is the length of the RSI or the stochastic the same?
Yes. So the default value is that you're using the stochastic RSI over, so you're calculating RSI over 14 days, and then you're calculating the stochastic component also over 14 days. So that's the default, but clearly it doesn't have to be. It could be, 14 and 28 or any other combination you want.
Okay, that was our question. So great job. Appreciate you kind of kicking us off this morning. It's good to see you.
Thank you very much. Thanks for inviting me.
Of course. And I'm going to talk a little bit more about the add-on. But again, thank you very much, Tushar.
Okay, bye everybody. Have a good weekend.
All right, cool. Let me do this. Oh, I am the presenter. Okay, good. Thanks, Tushar. All right.
Bye.
Bye. Okay. All right. Sounds good, everybody. Thank you for that. All right, let's go ahead and kind of just close the door for a second. And I'm ready to do actually some prize drawings and all that kind of good stuff. So hope you're enjoying the conference. Hope things are going well. Let's see. All right, cool. All right, okay. So let's talk a little bit about the indicators and the stuff that's actually included in the Tushar Chande Complete Toolkit. It includes the long-term SMA envelope, the Chande trend meter, the wide stop, and the Vidya. In addition to that, it uses a lot of the indicators that were already included in Metastock, like the stochastic RSI that he developed and talked about. So it's a very, very all-inclusive thing. As part of it, you get the Chande trend meter. It's designed to measure the strength of the chart. If you eyeball a chart and ask 30 people, it just basically helps you identify what the trend is. So in terms of the methods that are included with the Chande trend meter, you get the long-term trend system, the swing system, and then the volatility breakout system. All three of those are going to do a really, really good job. And it just kind of depends on what you're looking for. He talked a lot about the swing system. I actually like the volatility, but just to kind of cover what is in the individual systems, you've got your long-term system. It's more of a trend following system. It has high levels of smoothing. It's designed for the patient position trader, and it uses wider stops. So in addition to that, you got the swing system, which is going to use tighter stops because it's more of a short-term method. And then you've got your volatility breakouts. And the way that he identifies the volatility breakouts, I think, is rather unique. It's basically going to identify one-day breakouts. It's going to use average true range to say, okay, has it broken out enough to kind of qualify? Since it has a higher risk of reversal, it's going to use tighter stop losses, of course, and those are all included in the system. So in terms of the total explorations, here's what's included. Here's the expert advisors, and there are system tests as well that you can use and utilize as part of it. And I just kind of want to show you what this looks on a chart since we have a few extra minutes, and just kind of walk you through it. So right here, this is the Chande indicators. You've got the TCCT swing system. Right now, this is just a chart. I kind of did a little bit of a system test. It's worked well. And so this is the swing system. If you look at it, it's going to have the stochastic RSI on it. In addition to that, like you've got your commentary over here as well. Right here, it is currently in a long trade for this. Of course, this long position is basically where it's kind of, Kelly, I can't answer your instant message today, but that wouldn't hurt right now. The long position, and okay, so let me kind of just, if you're currently in a long position, okay, I lost my train of thought. All right, so I can system test these methodologies. I can go in and see exactly what the holdings are. I can see exactly what's going on, et cetera, et cetera, et cetera. Now, if I want to actually also find opportunities that exist in the market right now, it's not hard at all. Of course, we've been talking a lot about scanning and using the Metastock scanner and all that kind of good stuff. And of course, if I want to find an opportunity, the best way I can find an opportunity is using the Metastock scanner. So let me go ahead and do this. I'm going to go ahead and click on the Explorer right here. And what I'm going to do is actually just go to the TCCT. That's the Tushar Chande Toolkit. And here are the systems that are available for it. I'm going to go ahead and let's go ahead and see if we see like either a swing system, kind of the shorter term system, or a volatility breakout system. What I'm going to do is I'm going to go ahead and do a search for the Dow Jones, the NASDAQ 100, and the S&P 500. So all three of those categories is what I'm going to actually search for. And we'll go ahead and see, oh, I've got a few extra scans. You notice I've got Elliott wave scans here. And so what I'm going to do is actually come back in here, turn off those Elliott wave scans so they're not running. And then we'll go back in. We'll select those two explorations. And the thing I love about the scanner, guys, is I can scan just about anything that I want. So we can come in here, run the explorations. It's going to kind of filter out. And I love the scanning in Metastock. It allows us to ignore the opportunities that don't exist and kind of focus on the opportunities that do exist. And it does a really, really good job. So, and you can see right here, the swing system, we're rejecting about 99.7. So out of the 600 stocks that we're actually scanning, we're going to look at CME group. And there you go. That's all. If I come back and I look at a scan and nothing shows up, that's fine. You know what I mean? I can increase my scan area and all that kind of stuff. But I just love kind of the completeness of the system. Tushar Chande has been such a well-respected technician for so long. It's so good to have him on here and kind of helping us with it. So to kind of just sum up, the Tushar Chande Complete Toolkit is $4.99. Here at the conference, we're going to do $3.99 as the special. We're going to give you, of course, a 30-day money-back guarantee on that. We'll give you instant access to some boot camp training that we recorded to go with it as soon as you set up. We're going to show you how to do the scans, how to do the expert advisors, all that kind of stuff. And of course, we'll give you a free trial to Metastock. To get that set up, give us a call, 800-882-3040. You can go to metastock.com/sales-chat or metastock.com/Chande. So do it. And here we go. Let's go ahead and kind of put this in here. Yeah, 800. Okay, cool. All right, very good. Let's go ahead and kind of do a bit of a, Kelly, we're going to do a prize drawing, but actually I don't need your help for that because I used the audience to help us draw. Once again, I want to say thank you, everybody, for coming in. It's been a great week, all 6 days of it. The signups have been great. The attendance has been great. And we really appreciate all of the great speakers that come in and share time with us and ideas. And it's been great for me. I hope you've been enjoying it. I do want to say a special shout out to CMT Association. You can find out more about the CMT Association at cmtassociation.org. If you're managing money, if you're looking to manage money, if you're looking to get more assets under management, a CMT designation after your name could be very, very helpful for you. So go to cmtassociation.org to find out about that. We're also Metastock. Metastock helps you test trading ideas, scan markets, helps you focus on opportunities, find the ones that work well. Guys, it's been rated #1 in its price category for 30 years straight. You can find out more about it at metastock.com/conf-promo, metastock.com/sales-chat, or you can give us a call at 800-882-3040. It's prize time. So what I'm going to do is I'm going to kind of just basically if you've been here the rest of the week, you know how this goes. I have a spreadsheet here that has a list of everybody that registered. Now, if you're watching this on YouTube and you haven't registered yet, there's a pinned link at the top of the comments that'll allow you to log in. It'll allow you to kind of see what exactly is going on with the comments. Okay. What I want you to do here is I want you to give me a number. So the number that we're looking at today, or this morning anyway, should be any number between 1 and 11,957. Whoever kind of pick a number, give me a number in YouTube chat, or give me a number in the other one, and let us know. Type in a number now. Now, you might want to know what the prize is, and the prize that we're going to give away this time is, if you're here with us yesterday, Adrian Matz came in, and he talked about like his methodologies. He's got a brand new book coming out. And he's giving away a few copies of that. The brand new book is called Trade Secrets. I don't think it's out just yet. I think it's coming out. But we're going to give you Trade Secrets, Powerful Strategies for Volatile Markets by Adrian Matz. And what I need you to do is actually type in a number. Nobody's given me a number yet. There's 100 of you guys out there right now. Oh, I got some numbers. Okay. Oh, I just was looking in the wrong place. Jackie, welcome back. You've been here every day. Okay. All right. So we'll go with Jackie. We're going to go with your number 7573. And then I have a bunch of numbers in YouTube that I didn't even see. So 7573. Thank you for that number, Jackie. And that's a Felix E in the USA. Okay. And then out of, hello. Hi, Rao. Good to see you. And then Gretch Armstrong out of YouTube says 16. And so we'll go with that one as well. So David M. Okay, David M. And he's also in the US. 167573. All right, cool. Congrats on the winners. Basically, I'm just going to have, so what, if you want a prize, I know a lot of you have actually emailed me directly asking about a prize. If you've won a prize, what's going to happen is you'll get contacted by the company given the prize. So I'm just going to send your information over to Adrian, in this case, Adrian Matz, and he's going to get your address and he'll send it directly to you. Okay, unless he wants to send it to me, in which case I'll send it to you. I don't mind. So with that being said, great. Good morning, Jackie. Good morning, Rao. Good morning, Steve. Here you go. All right. Our next presenter is Barry Burns. Barry Burns has been a long-term friend of Metastock. I'm going to go ahead and make you an organizer right now, Barry. Barry, one of the things that stands out to me over the years is, well, how great you are to work with. But in addition to that, I like kind of like your method that you use for kind of identifying and isolating and kind of determining a proper trend. And I like how you kind of talk about it as going to the jury and et cetera, et cetera, et cetera. So how are you doing, Barry? Let's have you come in here.
Oh, there we go. Okay.
Ah, cool. All right, Barry, it's good to see you this morning.
Good to see you too. Haven't used GoToWebinar for a while, so
Well, yeah.
with it.
Let me go ahead and make you the presenter. Okay. And welcome to the room. You haven't been in here for a while, but we love having you.
Thank you. I love being had.
All right. Well, I can see your screen. I can hear you. We're off to a great start. So I'll get out of the way, and we'll let you pick it up from there.
All right. And let me see if my webcam is working as well.
I can see you.
Hey, there I am.
Yeah, yeah. Looking good.
Wow. Well, not as good as you.
Oops.
You never age. I'll tell you, I get older every year, and you seem to get younger every year.
I don't know. I'm silver foxing it out over here, but you know.
Oh, well, don't even talk to me about that.
It's all you, Barry. Take us away.
Okay, great. Thank you. Oh, and just for clarification, make sure I keep us on time. I have until the top of the hour. Is that correct?
That's correct. Yeah.
But you want a little buffer time before the top of the hour, I'm guessing, right?
Oh, we try and stay as much close to schedule as we can, but we always run behind. So yeah, if you give us a few extra minutes to kind of wrap up and go into the next presenter, that's cool. Take as much time as you need to, though, within reason.
Within reason. Okay. All right. Yeah. So no more than 3-4 hours.
Right. Yeah. If you want to come back for overtime, you can. We'll stay as long as you want.
Well, thank you so much for having me. Really a pleasure to be here. Like you said, it's been a while, so I'm thrilled to be back. And, Metastock is a very dear place in my heart because it was actually the very first charting software program that I ever used in my history of trading. And my history goes back quite a ways because I traded before we even had software, before we even had computers. My dad started to teach me when I was 8 years old. He was a stock trader, and he started when he was 18, continued trading until he was 88. And he got me off to an earlier start, 10 years earlier than he did. So he started me at 8. And I remember, like I said, we had no computers back then. So the newspaper would come in, and he got the Wall Street Journal, and we'd look at charts on the Wall Street Journal. And, it was volume on the bottom. I think they had a couple of moving averages on there, the 50 and the 200 moving average. And that's how we traded. So we've come a little ways since those days, since the days of yore. And thank goodness we have. And I remember showing my dad, the charting software and all the tools and the scanners and, these things we were talking about. And he was just astonished. He was blown away. He's like, oh my gosh, where was all that stuff when I was learning to trade? And so yeah, it was a beautiful thing that my dad and I shared together our entire lives. And so trading has a special place in my heart, and Metastock has a special place in my heart because I was able to introduce him to it. So anyway, yes, my topic is about trade timing strategies for entries and exits. And let's see, I did test my slides, so they should work fine. Oh, yep, there's my ugly mug, although you can see the uglier mug in real life. That's a picture that's a little bit older, pre-beard. I am the author of Trend Trading for Dummies. I work with, I've received, I should say, Reader's Choice Awards from Stocks and Commodities Magazine, which is a great magazine. Highly recommend it. I've been subscribing to that for forever. And I've also helped some other authors write their books, and I've given presentations at various exchanges, and on and on and on. Here's the reason y'all really came, and that is to hear what the lawyers have to say. So I know you probably see, some of you at least have seen this slide or a similar slide before, because we've got a multi-speaker event here, which is amazing. So many great traders here today and all week long. But I know people come in and out of these multi-speaker presentations, so it's very important that at the beginning of each presentation, we, again, give a legal disclaimer. And I'm not going to read through it word for word. I'm sure you don't want me to do that, but please do read it. And while you're doing that, I just want to give you a little different slant on it. I know a lot of people like, oh, there's that again. Okay, blah, blah, blah. Let's move on. And they see it as just legalese. Please do not think of it as just legalese. Think of it as the core, the foundation of your trading education, which will inform your trading methodology and your strategies when you develop them around trading, because regulators are trying to protect us, right? Their intentions are excellent. And there's a lot of hype in the world of trading, let's face it. And this is the anti-hype. This is to keep us rooted and grounded in the realities and the truth of trading. And so even if you've been trading for quite a while, which I'm sure a lot of people here have, it's really important to go back and still read these disclaimers. And I understand it's not entertaining, but it is essential for you to constantly go back and remind yourself of the realities of trading. Ground yourself in the truth so you don't get carried away with all the kinds of claims and everything that are out there these days. All right. So I want to make this interactive. I know we've had so many speakers, so I'm going to try to be a little bit different here for you today. And let's see if I can pull up, I can pull up the chat. And I want to make it interactive. So if you would, type in what your most common trading problems, struggles, and frustrations are. And I want to address those for you today. So I have slides prepared, but I can customize the presentation for you today based on what your common problems, struggles, and frustrations are. I can focus on those and therefore serve this audience the best. So go ahead and type those in. And I'm going to pull this up in a separate window so I can read what all of you are saying. And let's make this really, really helpful for you. Let's see. Here we go. Oh, there we go. Okay, I see. It's this one here. It's literally called the questions box, which is great. All right, so I'm going to read some of these out. So Maxwell says false breakouts. Yep, that's a common one. Okay, we'll address that. False breakouts. I'll keep that in mind. Then we've got, let's see here, Ghana. Oh, okay. Whoops, hold on. It's moving on me, so I'm not seeing the most recent ones. Okay. So Andrew, not finding enough leverage for small account. Oh, okay. Very good. Yeah. Jocelyn, not knowing where to start as a beginner. Very good. Sonali, hopefully I'm pronouncing these names correctly. I apologize in advance if I mispronounce a name. I struggle with when to sell. Okay, that's very important. Yeah, entries. I mean, there's only really two parts to trading, essentially, right? When you get in and when you get out. So it sounds like you're not having as much trouble getting in, but getting out. And by the way, that is also a very, very common issue among traders. So we'll talk a little bit about that. Scott, basket trading. Oh, interesting. Haven't heard anybody mention that one for a while. So that's one I haven't been hearing too much about recently. All right, so good. Thank you. I like some of the unique questions that come in. Yeah, basket trading. What else?
There's
Anybody else?
a ton coming in from YouTube, and I'll read some of them out to you, just because I don't know if you have YouTube open.
I do not.
GZ911MMSK2J11B says, not knowing which way to go.
Is that the legal name on your birth certificate?
I think that's an actual legitimate name.
Yeah.
This one kind of ties not knowing which indicators work best.
Okay.
Not knowing which way to go in all in on options trading, day trading, scalping, not knowing what direction to go. If trend trading is still relevant even in 2023. Gretch says hesitations to buy at new highs and missing breakouts.
Mm-hmm.
Aditi says not knowing if we need to change indicator parameters for different time frames. Nat says not identifying profit points, and now we have tons more that are in GoToWebinar. So, which are basket trading, where to put stops on short on the money options, best indicators to use, what option strategies to use, setting up a target, forward-looking indicators. I think that's all of them now.
Wow. Yeah, and I see Leonard also just typed in Iron Condor strategy. Yeah, wow. Okay. You guys got a lot of questions. That's good. That's why you're here. Well, good. I don't know if I can answer all of those questions in the next 45 minutes, but I'll do my best. And I'll answer the ones that pertain to my presentation for sure. And again, I'll put a little extra emphasis on those. So it'll help me time, give me time allocation to certain parts of my presentation, and then less time on those that don't pertain to the questions you asked. By the way, I took a survey of this, over 10,000 student or traders, and I asked them this question. So let me share with you the answers. And this is insightful in that it'll show you what the vast majority of other traders are struggling with. So here were the top, I think it's 4 or 5, I forget. They said, and I kind of put these together because people would have a little different ways of saying the same thing. So I summarized them. So number 1 was, I enter the market and then I get stopped out right away. And then after I get stopped out, the market goes back in my original direction. So that one came up a lot. That has to do with timing. It's like I was right, but at the wrong time to get in. So I ended up getting stopped out, and then I was right after all. Another one, getting out of big moves too soon, so not making the huge profits. I think that does pertain to some of the questions that were asked here today in the live session. Getting stopped out too often, that's a big problem. Not knowing the best place to exit the market, a number of you addressed that as well. And number 5 was trading a trend that doesn't follow through. And that goes back to trend trading. Is it a viable strategy still today? Which, by the way, the answer to that is, the quick answer is yes, it is. But how do we know if a trend's going to follow through or not follow through? So, okay. So one of the reasons I wanted to show you this, the results of the survey, was to show you that if you're having some of these same problems, as well as the ones that were posted live in our session today, you're not alone. I think that's very, very important that you understand that the problems you're having, the struggles you're having, are not unique to you. You're not a uniquely bad trader. In trading, we can get isolated since we usually do it from our home or office and not part of a group, although sometimes people do. But still, you can start to get the idea that, oh my gosh, I'm the worst. I'm the only one who has this problem. And I want you to understand, you are not the only one who has these problems. These are common problems that pretty much everybody struggles with, including myself. I've struggled with all of these issues. And that's how I came out the other side. That's how I learned, was by going through these problems and coming up with solutions. And that's my final word of encouragement on this part of the presentation is there are solutions. So every professional trader I know has had to work through these problems. Just don't get stuck on them. There are answers. Now, as Jeff mentioned, my trading methodology is all about measuring what I call the energies in the market. When I refer to energies in the market, I'm referring to the energy of money flow. So no matter what happens in the market, we get caught up in news and gossip and rumor and economic reports, and those things are important. Absolutely, they're important. But it can be, I think it's almost impossible to predict ahead of time what the market is going to do in response to those. For example, quick, easy example is I've seen stocks come out with quarterly earnings that exceeded expectations. So it was good, but the stock went down. You think, why would that happen? Or the inverse. And so market's not always logical. And so the only real way to trade successfully is just to, well, it's the old adage, follow the money. I mean, if follow the money applies to anything in the world, it's definitely trading. because sometimes people discount the market. That's part of Dow theory, the old Dow theory, which is one of the oldest theories in trading. And that means that professional traders will discount the market. And in common parlance, what that means is, you've heard the phrase, buy the rumor, sell the news. So by the time the news comes out, whether it's economic news or quarterly earnings or whatever, professional traders, they've already taken their positions ahead of the news. And so, again, back to the energies of the market, what we're trading is we're trading the money flow. Just follow the money, and that will take you in the right direction, talking about following direction up or down, whether you should stay in the market or get out. You know, all these questions really are answered by this: just follow the money. All right, because money makes the markets go round. By the way, money does not make the world go round. Love makes the world go round, but money makes the markets go round. So what are these energies? There's several different perspectives, different angles to this energy concept of money. So one is trend, and that's just the direction of the market, up or down. Sideways, no trend, choppy markets. The second energy is momentum. So, well, let's say the market's going up, the trend is up. But now we want to measure another level of that energy. Is that market moving up on strength? Or is it moving up on weakness? Is it a strong trend or a weak trend? And that is the energy of momentum. The third one is cycles. And this is how we time our entries. And this is how we solve the problem of getting in and then getting stopped out, and then the market going back in the direction of our trade. After all, that's an issue of timing. Energy number 3, cycles. And energy number 4 is support resistance. This is I call this a blockage of energy. Support resistance levels, whichever ones you might use. When the market comes into these price levels, then a lot of people are watching those price levels, and it's there's a mass psychology effect that comes in where people say, oh, I want to buy off support, I want to short off resistance, or if they're already in a position, then as they come into resistance, people start hesitating, thinking, I don't know if we're going to break through this resistance. So they take profits, or they just totally get out. Or maybe they short the market and go in the opposite direction. And finally, the 5th energy that I use on all my trades is what I call the fractal energy. And that's a fancy name for using multiple time frames. So whatever time frames you use, I never use just one. I never, ever, ever trade based on just one time frame. I'm always looking at another higher time frame, and I'm looking for the two of them to align. And what that really does is it helps me to follow the money, again, from 2 different groups of traders: short-term traders and longer-term traders. And so the more people that I'm following their orders, the supply-demand imbalance, if you will, the more people that are involved in that, the more likely it is to follow through. So I want to be following both groups of traders. So now we need instruments for measuring these energies, because that's the next question. Well, okay, I get the energy concept. This is all great conceptually, but how do I do this? What kind of tools do I use? And I use very common tools. So for trend, I just use a moving average, very simple. For momentum, here's a shocker. I use a momentum indicator. Okay, nothing too mysterious there. For cycles, use an oscillator. And I'll be sharing, I'm going to go into more details with this. Support resistance, we use previous cycle highs and lows, previous wave highs and lows, all kinds of things you can use for Fibonacci, floor trader pivots if you're an intraday trader. Now, for the fractal energy, using multiple time frames, I really like to use a 1:3 ratio between those 2 time frames. If you use time frames that are too far away from each other, then the longer term time frame doesn't really have much effect on the shorter term time frame. There's too much disparity there, too much play in the wheel. It's like when the first car that I had was an old junker when I was 16. And it had a lot of play in the wheel. So I could turn that steering wheel 5 degrees to the right, 5 degrees to the left, and it wouldn't turn the tires of the car. So that's kind of what happens when you use, for example, a 5-minute chart, and then you say, oh, I'm going to confirm it with a daily chart. Well, all kinds of stuff can happen on that 5-minute chart that has nothing to do with the daily chart. There's too much play between those two time frames. All right, so for example, if I was going to use a 5-minute chart, I would use a 15-minute chart as my longer time frame, 1-to-3 ratio. All right, so now that is the system, just as Jeff was talking about, that he likes this approach. So now how do we apply this to making money? In trading, what we are doing is we are creating or determining probability scenarios. Trading is not about certainty. In fact, one of my favorite trading psychologists, he defines trading as managing uncertainty. And there's a lot of good definitions of trading, but I think that's a really good one, managing uncertainty. On any one given trade, you never know what's going to happen. But over a large sample of data, you have to have an edge. You have to have the odds on your side over a large sample of data so that on most trades you're making money. So how do I do that? Well, at each entry point, I simply ask myself, all right, of these 5 energies we talked about, how many of them are aligned all being bullish or bearish? And I give each setup a score of 1 to 5 based on how many of those 5 energies are bullish or bearish. Obviously, the higher the score, the higher the probability. And so I liken this as taking each trade to court. Now, these 5 energies, the key to these particular 5 energies and why I chose these is because each one of these 5 are uncorrelated to the other 4. That is absolutely essential. Sometimes I see people who will put 5, let's say 5 trend indicators on their chart, and they think they're doing kind of the same thing I'm doing. They're not. What they're doing is they're still just measuring one energy, direction, with 5 different mathematical tools. And that's not at all the same thing. So just like in a court case, you know, somebody could be put on trial because they stole a banana. We'll keep it real innocent here. And if you had 5 witnesses go up to the witness stand and, you know, maybe the guy's brother goes up and his mommy and his brother said, no, he didn't steal the banana. And his mommy goes up, no, he didn't steal the banana. His girlfriend goes up, nope, he didn't steal the banana. His brother goes up, nope, he didn't steal the banana. You know, and what else? Cousin goes up, you know, he didn't steal the banana. But see, those are all people related to him. So in a court of law, they're not going to have as much legitimacy. Whereas, again, independent witnesses, if there were 5 people, none of them knew the accused, and none of them knew each other. But all 5 said, yeah, I was there and I saw him steal the banana. Okay. Well, that's going to carry a lot more weight in the jury's mind as they decide whether, you know, they should sentence this guy to however many years in jail for stealing a banana, or at least give him a $5 fine. So silly example, trying to keep things light, but you get the idea. So it's the same thing in trading. We've got to use uncorrelated, and it all has to do with statistics, really. All the behind the silliness is the seriousness of statistical analysis. We need to use uncorrelated pieces of evidence that will statistically put the odds on our side. So how do we do it? Well, let's pull up a chart and look at it visually. All right, so here we've got a couple of charts. On the right, on the left, I've got my 10-minute chart. So as I said, I like to use a 1 to 3 ratio between my 2 time frames. So the left chart I call my setup chart. This is the one where I'm looking for the, well, setup. And then I'm going to confirm it with the longer term chart on the right. So on the left, let's count our energies. So this is the 50 SMA, this red line. That's what I'm using for trend. Now, I also count waves. You've heard the slogan, the trend is your friend until the end. Well, what does that really mean? I mean, we all know that slogan, but think it through. Again, back to statistics. And by the way, don't worry, I was always horrible at math. So I'm talking about math. By the way, that's the great way to make anything go viral, is talk about math for an hour. But I always got C's in math. So yeah, I know really very little about math. It was always my worst subject. But I've been able to apply it enough to trading because I've been able to use the leverage of indicators. I'm a visual learner. Okay, I'm not a data person. I'm a visual learner. And so for me, all the math is in the visual representations. And then, oh, okay, that I can follow. So the 50 SMA, we're using that for trend. And as I started to say, the trend is your friend until the end. The meaning of that is, if you think about it, oh, then the odds are the trend will continue when we buy early in a new trend. So thinking that phrase through, I don't want to buy late in an old trend. I want to buy early in a new trend. And that's where wave counting comes in. It tells us how early or late we are in the trend. So here we've got wave 1, 2, 3, 4. We've got an ABC contraction pattern, and then 5. Now, these are not Elliott waves, just to be clear. Okay, I'm not doing Elliott waves here. I got nothing against Elliott waves, traded it for several years. But I developed my own way of counting waves. I call them, for lack of a better term, berry waves. So in my way of counting waves, I am not imposing a 5-wave structure on trend. I'm just, again, it's all objective, it's mathematical, and it's actually measuring how many waves, based on this algorithm, that the market will continue to move in one direction or the other. So the further we go in the wave count, the less likely that trend is to continue. And then we start looking for reversal trades. So the earliest we can get in is, on a retrace at least, is a wave 2. That's your first wave up, wave 2. So we're early in a new trend. That's energy number 1. Remember, we're put together 5. We got a scorecard. Think of it as a scorecard. 1, 2, 3, 4, 5. That's it. So number 1, we're starting a new trend, wave 2. Number 2, momentum. Here's the momentum indicator. And sure enough, momentum, boom, angling up. It's the red line, by the way. And so good. So we got strength in that move up. Because markets can move up on weakness. No, we want it to move up on strength. And what difference does that make? Strength, it will give you an idea of which group of people is buying. And the reason for that is that retailers, amateurs, people who mostly lose money, generally have very small trading accounts. And so they don't, when they buy, they don't provide a lot of strength, a lot of money, a lot of demand in terms of shares, contracts, lots, dollars, yen, euro, right? They just don't have the money. Again, it's back to the money. There's not a lot of money power behind it. Whereas when professional traders who tend to have larger accounts come in, oh, they're buying more shares, more contracts, more lots. They're bringing more money into it. And that's what creates strength. So you can think of strength as, it's not how many people. And by the way, this is one of the problems with volume. So some people say, oh, volume equals strength. Well, not really. It might, but it's not clear enough. And the reason is you could get 1,000 shares coming into a trade, but it might be, I mean, just as a crazy case, it could be 100 retailers each buying 10 shares. And so those are the people who are normally wrong. Whereas if you get one person buying 1,000 shares, isn't even a good example, but 10,000 shares, oh, that means a lot more. So the vast majority of people are always wrong in trading. So it's not how many people are coming in, not how many traders are trading it. It's not how many, really, it's not even how many shares or contracts or lots. It's the second thing I said, it's how much money. Because the big money is the smart money. And the little money is the, well, I don't want to be rude here. We'll just say the not as smart money. Okay. And we want to trade with the smart money because the smart money is the people who make money and we want to make money. Okay. So that's where momentum comes in. That's the difference between trend and momentum. We want to only, and I will only trade a strong trend. I will not trade a weak trend because, again, this answers to the question, when I get into a trend, will it follow through? That's the answer to that question. Okay, cycle low. Now, this is cycle. So the third energy is cycle. When is the right time to enter the trade? So, like, for example, if I bought here and it went up and then it went down, oh, I'd get stopped out maybe below this low here. But see, our cycle indicator here, we want it to go all the way down to the bottom, below this lower dashed line here. That's when we have a cycle low. That's when it's time to enter a new trade. And it's just crazy to me how so many traders don't have any type of timing indicator on their charts. I don't get it. It's, I mean, here's the logic behind that. Everything I do is a logic behind it, so I like to explain the logic behind it. Instead of just giving you the answers, I think I serve you better by explaining the answers to you as well as I can in the short amount of time here. You need to know why things work, right? Is there a logic behind it? So think of a chart. Well, you don't have to think of a chart. Look at this chart. We've got, it's a two-dimensional object, right? We've got price on the y-axis on the right over here. And we have time. You can literally see the timestamps down there at the bottom. And that's the x-axis. So a chart is a two-dimensional object. Going back to trading being all about probabilities. How in the world can you establish a probability if you're ignoring 50% of the information on a two-dimensional object? If you leave out 50%, you don't have a probability scenario. And yet very few people have a timing indicator on their chart. And timing is all about that x-axis on the bottom, when to get in so you don't get stopped out. You know, here's another example, by the way, just so would we want to buy here? No, why not? Well, trend is up, but look where our cycle indicator is. It's only here. We want this puppy to come all the way down here, and then that's the place to buy. And now it goes careening up. Okay, so just a few quick examples with the explanation. Support, we want to be buying off of support. We got the 50 MA there. And then finally, then we go to the fractal energy, the longer time frame. Now, on the longer time frame, one of the common teachings on multiple time frames, because a lot of people teach multiple time frames, I'm certainly not the only one, but one of the common teachings there is to trade in the direction of trend of the longer time frame. And while that can be okay, I find it's really not very meaningful. The reason is because trend is always a lagging indicator. And actually, by definition, it has to be a lagging indicator. We can go into that if we have some time at the end. You ask me about that, I'll be happy to answer why that is. So on the longer time frame, I don't give a mouse's left patootie what the trend is. Sorry, I'm a dad, so I got to throw in some silly dad comments there. What I do care about is momentum. And here's our momentum indicator, and it's going up. It's bullish. So again, think about the logic of that. We've got bullish momentum on the short-term chart. We've got bullish momentum on the long-term chart. That means we've got the big money, the smart money, and traders who are trading two different time intervals. Big traders, smart money traders, both bringing in lots of demand. And that's what makes the markets go up. All right. Hopefully that makes sense to you. That is the top dog trading system in a nutshell. So now let's go a little deeper. Watching my clock here, still got 20 minutes. So now I want to focus on timing. So here's my favorite trading technique for pinpointing market highs and lows for entries and exits. So let's focus on the cycle indicator for the rest of our session here today. I wanted to give you an overview. I wanted to give you the big picture so you can see how this will fit in. But now I'd like to go even more narrow and focus in on just the cycle indicator and go into more details. So we got to have the right indicator, the right input. So here's how you set it up on Metastock. So you pull up, by the way, this is not a proprietary indicator. You can set this up right inside of Metastock or any other charting platform you might be using. Because what we're going to do is we're going to use the good old-fashioned stochastic oscillator, but we're going to modify it. So we're not going to use it in its default form because it was not created by George Lane as a timing indicator. George Lane actually created it as a momentum indicator. So we're changing the use of it, and therefore we need to change some of the inputs and also the visuals of how we trade it. So let's get it set up on your charts first. So you pull up the stochastic, go to parameters here, click on that tab, and we're going to change these numbers here. So time period 5, slowing 2. And then in %D, we're going to change time period to 3. All right, and I think it defaults to simple and then style and color. That's just personal preference. All right, so I'll leave that up just for a second so that everybody can copy that down if you want to. And let me look at the questions, see here if there's any new questions coming in. By the way, I can't see YouTube, so if there's questions coming in through YouTube, I can only see what, information leading to analysis paralysis. Right, that's a very good point, Art, right. That's why I limit what I looked at as 5 things. That's a good balance between having enough information. Now, you see, you have to have enough independent witnesses, in this case, in my little analogy here, to establish a probability scenario. If you only have 1 or 2 or 3, it's not enough. You have 5, okay, now we have enough variables to establish a probability scenario when they align. But your point is very well taken. If you go beyond 5, then you get the law of diminishing returns. It doesn't really increase your probability that much, and it leads to information and therefore a mental overwhelm. So excellent point. I like it. Barb, yeah, I think I just showed you an example of the 1-to-3 ratio. And I do like to use a 200 SMA, but what you saw in that chart was actually a 15 PMA, 50 SMA. But I also do use the 200 SMA.
We do have a couple questions from YouTube, Barry, if you don't mind, since you paused for it. We just have a couple questions about if people can get a copy of the slides because they're having a hard time reading some of the smaller text on there. So would you want people, like if you want to send me a copy of them, I can forward them off to people if that works.
Yeah,
okay.
I'd be happy to. Yeah.
In that case, at Metastock, we'll put my email in the chat, and if you email me, I'll send you a copy of those. Thank you, Barry. That's the questions that we've got on YouTube right now.
Okay, very good. So I think everyone's had enough time here, and yeah, feel free to ask for those slides from Jeff. Now, there's just one more thing that we do with the parameters of the indicator. We go over here to the horizontal lines, and I put in 20, 50, and 80. And so again, back to what I was showing you before, we want that cycle indicator to go down to 20 to buy, or you want it to go to 80 to short. And 50 you don't really need there. I just like to kind of see where the middle is, just for reference. That's my own little thing. But 20 and 80 is very important. Those are our buy zones and our sell zones. Okay, so we've got the rate indicator, we've got the rate inputs and parameters. Now, like by itself, as I was saying, no one of these energies, no one of these indicators, no one anything means anything. So we have to use it strategically with the other energies. Again, it's one piece of evidence. So we're going to trade these cycles only in the direction of the trend early in the trend. Otherwise, we ignore the cycles. We're only going to trade cycles that, again, have strong momentum behind them. If we get a cycle low that has weak momentum, I don't trade it. We're only going to trade a cycle high or low when that fractal energy is aligned with it. So if I get a cycle low and momentum on the higher time frame is down, I'm not going to trade the cycle. And now here's a new one. I'm going to only trade what I call second chance indicator patterns. So what are these puppies? Well, let me show you. So cycle patterns, these second chance cycle patterns, they indicate a momentum shift at the top or the bottom of the cycle. I call these mini divergences. Now there's other patterns. I got a total of 6 patterns, but today we're going to focus on the mini divergence because, well, that's all we have time for. So here's what it is. So how to trade cycles accurately. Notice, again, here's the problem we want to avoid. Price comes down, we're in a downtrend. Price comes down, we get a cycle high. And again, this black line is the 15 EMA. Thanks for asking that question, by the way. And the red line is the 200 SMA. So it looks like, oh, okay, we got a cycle high and we're coming down, but then nope, boom, goes back up, and we would have gotten perhaps stopped out above this high. So that's what we want to avoid. So how do we avoid that? We use these mini divergence patterns or these second chance patterns. And here's how it looks. It's actually very simple. So here we get a slightly lower low or equal low on price, but look at stochastic. And by the way, that's, remember, well, yeah, we already talked about that, stochastic oscillator. We have a higher low on stochastic. My blue line. The blue line is the K line, by the way. And so that's what I'm waiting for. I'm going to enter here. I'm not going to enter here. I'm going to enter here. I want to see momentum going down, up, and then come down, but with a higher low. That's what shows that momentum shift, the shift of supply and demand. And it doesn't show up on price. It shows up on the indicator. And that shows me that, okay, this is a trend continuation trade. Trend is up, I'm early in a new trend, and this is when I'm going to enter. All right, and as I said before, we also will use this for reversal trades, but now we're going to wait for that trend to get extended. So the average trend, even with Berry waves, just happens to be 5 waves, kind of corresponds with Elliott waves there, except we don't limit the wave count to 5. We just let the market tell us. It's an objective, rule-based mathematical model of wave counting, whatever the market does. So with Berry waves, you could get 7, 9 waves. That's when we look for reversals because, again, the average trend is 5. So now, probabilities, statistics, the trend is less likely to continue. The trend is no longer a friend. So now the counter trend is our friend. So now we're looking to trade against the trend, but we got to wait. Timing is everything. And there again, it's our little mini divergence pattern. Been going down, 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 down. Lower low on price, higher low on K. That's your mini divergence. I call them mini divergences, by the way, because the stochastic indicator does not go to the top of the range in between the 2 lows. So that's what I mean by mini. Okay, so it's just within a few bars, and that's where I would take my reversal trade, and it works pretty darn well. You can even take them in contraction trades when the market's been choppy and consolidating for a while. We get a higher low on price, we get a lower low on stochastic, and that is when the consolidation breaks and the trend follows through. So let's summarize here. What we're doing is we're waiting for the alignment of the 5 energies to put the odds on your side. And this would be a good thing to write down. This is a summary of my entire trading system in one sentence. Talk about overcomplicating things. My system can be summarized in one sentence. That's how simple it is. We're looking to get early in a new trend that is strong momentum at the right time. It's identified by our cycle indicator with their mini divergences, with support at your back, buying off support, or conversely shorting off resistance, and then confirmed by the bigger scale. That's momentum on the next higher time frame. And again, we use a 1-to-3 ratio. And that's it. That's the Top Dog trading system in one sentence. It's very robust and adaptable. You can trade this with stocks, commodities, options, currencies, futures, because all these markets are just about money flow. That's all it is. It all comes down to supply demand. You can really use it for pretty much any time frame. This works for day trading, swing trading, investing. And it's simple. It's objective. Again, I literally, at the end of my course, I have a course. At the end of the course, you get a half sheet of paper with a scorecard on it. And it has a little checkbox, step 1, 2, 3, 4, 5. Check off the 5 energies. And that's it. Okay, we learned how to do that in kindergarten. Oh, here, and Jeff might want to share a little bit more about this too, but I wanted to definitely share this with you because this is super cool. So Metastock, now what I've shared with you so far, you can use that on any charting platform. All right, again, we're just using common indicators. There's no proprietary indicators here. So stochastic, it's on every charting platform. But Metastock has put together a plugin, and this adds so much to the top dog trading methodology. So first of all, the stochastic oscillator is already pre-programmed and everything. They also have this ribbon down here that is added, and so that's proprietary with Metastock, with the top dog trading add-on. So it shows you whether the trend is up or down. And it also plots the wave counts. Now, most charting, actually no charting platform can count the wave counts. I show you in my courses how to count them, but with this Metastock add-on, it'll actually literally automatically plot the numbers on there for you. So that makes it so much easier to identify and know exactly where you are in the trend. And then, as if that weren't enough, then they've got this beautiful thing over here, this commentary. So if you look at this, it'll point where this arrow or this little diamond is, that blue diamond. That's what it's looking at. And it's saying, okay, that is a wave 9 reversal short trade. So you'll see, sure enough, we got a wave 9. Remember, the average wave is 5. So now we're way extended on the trend. So it's just telling you right here, oh, everything's aligned. So the basic setup is wave 9 high with the 50 SMA angling up. Percenti has been angling up, blah, blah, blah. I'm not going to read through every word here. And then there's so that's the basic setup. Then there's the commentary. And then it gives you the confirmation. And then the entry, where to place your stop, your targets. I mean, it just gives it all to you right there. It's awesome. And this is only available on Metastock. There's no other charting platform that has this type of commentary that just, boom, spells it out to you right there. That's just so beautiful. Again, talk about simplicity and not having to overthink anything. Nothing to overthink. It already analyzes it behind the scenes for you. So, yeah, highly recommend that you tap into that. Oh, by the way, I'm going to give Jeff a little time here to maybe give a little further explanation of the plugin. But for everybody here, if you want to contact me more about, if you want the slides, contact Jeff. If you have any questions about this or anything else, you're welcome to email me directly at barry@topdogtrading.com. And I want everybody to come away with something free today, so I'm going to give everybody my rubber band trade strategy. So I'm not just going to give you a little mini course or whatever. I'm going to give you a little mini course that, in addition, has an actual money-making trade strategy with it, because I want you to make money, and it's free. So you get the complete rules on exactly where to enter and exit. The little mini course is called How Pros Trade Different Than Amateurs. Okay, I review my cycle indicator. I show you how to set it up on any trading platform. And again, you'll learn the rubber band trade strategy. I still take this rubber band trade strategy every single day myself. This is not some has-been strategy. And you can get it for free. Start trading it. Just go to topdogtrading.com/free. And yeah, go get it. Go enjoy it. All right. Jeff, I'll turn it back to you. I think, do you still have some slides that show some of the other nuances of the...
Oh, I'm gonna show it off. I'm ready. Yeah, actually, and one of the things is like, I just love how well it works. One of the things that we just did with 18 is we redesigned the whole charting engine in Metastock. And one of the things that we did while we were redesigning it was we wanted to make sure that it handled Top Dog better than the old charting engine. So we did a lot of testing with it. It just shines. So we had a couple questions, but then GZ91, and I won't say the rest of it, said, never mind, he answered the question. So there was quite a few questions that came up that you just answered naturally because you're good at it. So in any case,
Okay.
Gretchen says thank you, and great job today. Good to have you in here, Barry.
Thank you, my friend. Always
Alright.
great to be here.
Cool. And then I'm going to show how the scanning. Of course, we've got scanning in here too, right?
Yes.
All
That's
right.
a huge, by the way. Yeah, I'm glad you mentioned that because that is a huge advantage. And I know people love scanners. I love scanners. And to be able to scan for these setups and have Metastock just find them for you and drop them right in your lap, that is such a huge time saver. Nobody likes to just sit in front of the charts all day long. And yeah, that's incredible. And again, that's unique to Metastock. There's no other platform that can do that, only Metastock.
Barry, thanks for spending an hour with us on a Saturday. It's good to see you.
My pleasure, my friend.
All right. And I'm going to go ahead and just show this. Thanks again.
Okay. All right.
Cool. All right. So this is just a Dow. You might be familiar with it. And just wanted to show how this looks on the chart. This does have all of the indicators that Barry has programmed in. There's also a clean view that kind of gives you a more compact view. If you just want to kind of, like if you want a bit of a starter mode, you can go with a little bit of the cleaner view. And I'm going to show you that to you real quick too. So TDDT, and I'm just going to go with the clean version real quick. And then that way we can kind of walk through things. Yeah, okay. We'll wait for this to reload. I'm going to zoom in a little bit real quick here. And what I want to do is just kind of point out some of the things. Barry had talked a little bit about whether it was looking at the angle and counting waves based on if the angle of the moving average was headed up. That's automatically done for you. The wave counts 1, 2, 3, those are automatically drawn for you as well. You'll notice right here with stochastics, there's some lines that are being drawn on here automatically by the program. Those are divergence markers. You've got your momentum indicator down here. So a lot of stuff that's actually being fed in here that's automatic, that just works well. I want to point out the commentary. Barry showed this out here. And you talked about the free rubber band trade, and I'd recommend that you grab that at the topdogtrading.com/free. But that just came up just a couple of days ago on the Dow. I don't think that's going to hold, but it did hold right back here. So let me go ahead and kind of just show you what happens when you get an alert like this. So I'm going to go ahead and open up the commentary. It's going to default. You'll notice right here there's a triangle that shows up right there on the chart. I'm going to move that back just a little bit. And anytime one of those patterns actually show up, what's going to come up is going to be a complete explanation. A complete explanation. So right here, we've got the first retrace in a short. It gives you an entry position, so 336, an initial stop, 341, and some targets that you can look for. One of the things that we had actually put in here is a lot of information. In fact, we kind of got over how much we could actually fit in the commentary engine. And so what we did was we put together like some HTML files that this actually kind of links out to. So anytime you get a signal, you can kind of come in here and it's going to give you a very, very detailed explanation of everything going on. And I remember we did that for the Top Dog because there's more we wanted to tell you about the trade, but with the positions and all the stuff that was in there, we didn't have the room that we wanted to. So what we did was we actually kind of abbreviated a lot of the stuff. You get your entry, your initial loss, and your targets. But then if you want to go into more detail, you can click into those HTML files. Of course, it also does have a manual, and of course, it does have scanning. So obviously, and we've talked about how scanning's like some of the, I run a scan every day I trade. And if I want to find something in the market, if I want to find one of these top dog setups, I forgot what the abbreviation top. Okay, so I can find any of these patterns that are in here. I can find the rubber brand trades. I can find the triangles. I can find those reversals. These are different scans that we can actually run. We didn't just go into the top dog to actually find out. So this is actually also a good example of something that we were really pushing the engine, the old charting engine. And with the brand new charting engine that we just put in 18, it really, really sings well. So let's go ahead and kind of reiterate what's going on in here. Again, Barry talked about his 5 energy method and how that works. Here's the patterns that are included. You've got new trends, momentum, long trends, reversion to the mean, triangle patterns. This 5 energy method toolkit is only a one-time cost. And I think it's underpriced for what it is. It's a one-time price of $499. We're going to do a conference special where it's $347 today. If you don't have access to Metastock, we'll include a trial for that. We'll back it on a 30-day money-back guarantee so you can try it and make sure that it works well for you. I'm confident that it will. But if you want to do that, go to metastock.com/conf promo. Give us a call, 800-882-3040. We also have people that can answer any questions that you've got at metastock.com/sales chat. Barb, thanks for the questions. Let's see, the moving averages on the chart, because I don't have it memorized. 15 exponential, 50 simple, 100 simple, and 200 simple. Thanks for that question. So a lot of questions. Okay, a lot of questions. Also, let me pull YouTube right here. Just make sure we've got all that. So here's the link if you want to chat with us. And then I can't type and talk at the same time. So there you go. Great add-on. Give it a go. It's underpriced for what it is. But not only can you try it out, we'll give you a money-back guarantee on it. We'll give you a free trial to Metastock. I don't know if you've heard about Metastock yet. Tell you a little bit more about that in just a second. But give it a go. It's absolutely phenomenal. I do want to say thank you. Oh, actually, this is the wrong side, but this will work. I want to say thank you to one of our sponsors, Stocks and Commodities Magazine right now. Stocks and Commodities Magazine. I remember about, like 10 or 12 years ago, I called up the guys over at Task and I was like, hey, I got this idea. We're going to have like a bunch of people come in and we're just going to talk about market education. This was about 12 years ago where we started doing the online traders summits, and that's kind of burgeoned into the conference. And I really do appreciate Stocks and Commodities for sponsoring us, the events, for as long as they have. They've kind of sponsored every single one we've done since the very beginning. So we appreciate that. It is a physical magazine. They've been making magazines since like the 80s. They've got 1.3 million subscribers. They've had over 17,000 articles. And what we're going to do for the prize right now is we're going to give away two 12-month subscriptions. So this is an $80 value. We're going to give away 2 one-year subscriptions, or 2. Actually, for a year, you get 13. They have a bonus issue that comes out. We're going to give away 2 one-year subscriptions. And instead of doing numbers, I'm going to pick random comments from the chat. So let's go ahead, and I've got the chat open here. I'm showing all the questions, and I'm just going to kind of scroll a little bit, and we'll stop right there. And so the person that's going to win, one of the people that's going to win is Quinn. Quinn wanted to get her a copy of all 6 days of the recordings, and he's going to get a copy of 12 months of task. Is what it's going to do. Okay, let's do the same thing with YouTube. Okay. Gretch Armstrong. Gretch, I don't know if I've got contact information from you. And so what you'll need to do, just because I'm not sure if you registered or not, but what you'll need to do is just email me. Say, hey, I'm Gretch Armstrong. Here's my address. If you guys are in the US, you'll get physical copies of the magazine, just like I'm holding right here. If you're not in the US, you'll get digital copies. That subscription actually does include all access to their entire years and years and years of history, all 17,000 articles or whatever, and via their online portal. So congratulations to the winners. And I'm just going to make a note of that before, because one of the things is, if I don't write these down, I've learned over time that I have to come back and get them later. And and then I'm looking through the timestamps, and it's better just to do it right now. Okay. All right. I'm good. Thanks, guys. Appreciate your patience while I did that. Thank you. Lots of questions on the recording. So I've been posting the whole playlist for all 6 days, all 40-something people that have been in here. We've been posting those up. Those are available. We have no plans on taking those down. So it's probably, as long as YouTube leaves them up, they're going to be up there. You're welcome to go through them, all that kind of stuff. We will email everybody that registered for the event a copy of the playlist for all 6 days. So thanks for that question, Barb. Appreciate it. And for everybody that's asked about the recordings. Let's go ahead and kind of get moving. Our next presenter is Toni Hansen. Toni is a great friend of mine. I like the way that she talks about, we do a lot of talks where we talk about like indicators and stuff like that. Toni likes to focus on price action, which is the fastest indicator, right? It's all in the price, and she likes to look at breakouts and fib studies and stuff like that. And so we love having Toni in here. Here she is. Let me go ahead and make her the presenter. How are you doing today, Toni?
Hey, I am good. How are you doing, Jeff?
Good. Good to see you.
Yeah, you too. Let me get my screen up here. Don't know which one it pulled up on me, but I'm gonna switch it over to my PowerPoint one.
Got it. Okay.
All right, perfect.
I'll go ahead. You know what? I'm going to get out of your way. Go. Your turn.
Okay, cool. Hold on. I'm just gonna move some stuff around here on my screen, you guys. And we'll get started. Yeah, Jeff and I have known each other a long time. I was trying to think back here. I'm like, when did we meet? It had to have at least been like 20 years, right?
Yeah. Yeah, I think so. Oh, I didn't realize my mic's still on. Yeah, I think it's been. I remember like the first time we met, it was like, I think it was down in Pasadena or Southern California. We were at a trade show down there. Like, I think it was a money show. I think that was the first time we actually met in person, but I think we had talked before.
Yep, quite a while. So you guys, Jeff knows what he's talking about, right? So the platform, Metastock has changed a lot over the years, and it just keeps getting better and better. I'm going to share with you in my session here today a strategy that's one of my favorites for newer traders. Those that are just trying to get their feet wet in the markets and are looking for something where there's some solid ground underneath them, where they're able to build up their accounts from that nice foundation and then work their way out from there. So I'm going to be talking about one of my favorite reversal strategies, which is called the Phoenix. And those of you that have followed me over the years have no doubt seen some version or another of this class. And I'm going to show you how to use Fibonacci as a timing tool to deal with and handle our entries, our exits, as well as the stop levels and how to move them. So my goal here today is to be able to give you something where you can walk away from this class having learned something that you can go and start applying to sim trading next week. And as soon as you've got that confidence level up, moving over to your live trading. So let me switch on over here and pull up some of our charts. So the Phoenix is a pattern that rises from the ashes, hence the name. If you flip these templates over, then I'd call that particular strategy an avalanche. So we're just looking at these. They're not pure reversals per se. They're not a reversal where we're trying to time the absolute high or low pivot. I got a lot of those too. But what we're looking at rather is trying to take advantage of that very first start to a new trend. So the very initial continuation move as a trend has already began to flip and is then starting to offer the confirmation for the new trend. So in the Phoenix, that means that you're coming out of either a downtrend or a sideways trend where you're dealing with a lot of congestion and back and forth action. Now, the templates that I have here, let me grab my pen. These are just the very basics here. Let's see, okay, light blue. I wish that I could get this to go to a bigger size, but maybe here on, nope, okay. Oh, well. So what we're going to be looking at here is this action over here as we're going into the Phoenix. So the Phoenix consists of these two parts. We've got an upside move, and then we have a zone of correction. So heading into that, what we want to see is a downtrend or a trading range. And we would like to see next a stronger than average move off of the lows, ideally consisting of two smaller waves of buying. And then we are going to be looking for a slower than average price correction, also ideally consisting of two waves. Now, the interesting part of this is that these sections in here can also have two waves of back and forth action. So when you're looking at a textbook version of a Phoenix, this is the basic idea of what we're looking at. Now, our target level is going to be aiming for that initial impulse move being repeated over here on the breakout from that range. Now, this Phoenix pattern is one where it can be kicking off a brand new trend. And in fact, that's the goal. You're looking at a trend that's just going to keep continuing and continuing and continuing, where the Phoenix is just that first initial little correction that gets it going. So our entry trigger on this, I never use the break of the bigger trading channel like you see me drawing here. Because when we do that, this is more of a typical way that you would see it drawn if you're looking at how to trade breakouts or how to trade bull flags or things like that. They'll say, hey, take the entry on the break of the trading channel or the break of the range. We don't want to do that because it not only does not improve our odds of success, but it tends to dramatically increase our risk parameters compared to what our reward outcome is going to be. So when we're looking at taking an entry trigger, I'm looking for a break of that second correction in here instead. And then I am using a stop placement where I'm connecting these two lows here and keeping a stop under that low. There's some more advanced ways that I will trade this particular strategy as well, but this is the core basic version to start with. So think of it like learning a new language. You know, these are basic sentence structure. When we're looking at patterns in the market, we're basically looking at market sentence structure. So this is just a really simple version of one. We don't have a lot of the adverbs and adjectives that are added in. We're just looking at the core basic strategy. And once you have that down and are comfortable with that, then you're going to start to learn the variations as well and how we can improve this even more, how we can go into more unique management of them, how we can determine, hey, you know what? This is going to be one that's going to go substantially further versus one where we can still get a decent little pop, but the odds are greater that it's going to eventually return back to that original trend. So some of the things to look for on here are, first of all, a shift in the momentum. So you've got your strong upside move coming off the lows, then your slower corrective move. And ideally, this correction in here is going to be a fairly parallel trading channel. If it is widening up or narrowing, widening is preferred over narrowing. So if you have something that's kind of widens up a little bit, that tends to be a better setup on the upside versus something where you're getting more of a narrowing with those two corrections. So that is one of the things to look for here with this. Now, target levels, as things are coming here and breaking out, a lot of times you're going to see a repeat of the two-wave movement that we had going into that zone of congestion. And that's the primary target. So again, these things are going to change depending upon the trend placement in the larger time frames. And we can look for a lot more in most of those cases. So here's an example on our Dow. One of the things you'll notice, of course, is that we do have a little bit more of the narrowing I spoke of. So it's not as ideal within this zone of congestion here. But what makes up for that is that we have a change happening over here where we start to get more congestion up the lows, and you can see that kind of widening with the megaphone down here at lows. So this is kind of switching things over where that momentum begins to start, the low, and then where we're seeing this breaking out is creating a pattern known as a head and shoulders, in this case, the inverse head and shoulders. So that right shoulder is often going to be a Phoenix strategy. Now, within this one, you can see the 2 waves down a little bit easily. The 2 waves up here a little bit more messy, and the 2 waves down are a little bit more messy in here. But what you'll notice is that as this gets started, it broke the trading channel. So when it was doing that initial impulse move up with the 2 waves, that broke through that downtrend channel. So what that tells us is that the next strategy to form is more likely to be a reversal strategy, something that will correct that downtrend move. So in this case, it becomes something where we can start to watch for that Phoenix. And if you are taking, a trigger that is traditionally taught, your entry would be right here, but your stop placement would be down here under that low. Let me change the color so this is a little easier to see. So here to here, that's a pretty darn big stop. So what we want to look for instead are opportunities on smaller time frames to take this position, keep a tighter stop. So what that means usually is taking that last channel trigger as it comes into, if you're looking at an inverse head and shoulders, you want about that 1-to-1 time development between the lows. So as it's coming into that 1-to-1 time development, that becomes your trigger zone to take a channel break. And what you can also look at is your distancing between your highs. So in a Phoenix, here's your 2-wave move up, here's your 2 waves correction. What you would want to see is that if you take the first high and the second high and project that out 100%, you want your Phoenix breaking higher within this pretty tight zone, close to that 100% extension. If it breaks too early, it's more likely it could be a trap. If it breaks too late, it's more likely it could be a trap. So you want it to be really close to that even spacing between the highs. So in here, we've got a little bit of a double top. So we can split that to give us that maximum zone where we want to see that breakout confirmation take place. So here's a little bit of a closer view on what was going on here. On this one, you'll notice that we have, again, that rounding off here at the lows. In this case, you've got 3 lows in the middle. So here's our timing for that inverse head and shoulders. Your second wave of correction on this one is a little bit cleaner. And we also have what we call a measured move here on that larger time frame. So this is your 2000 tick of the Dow, which happens to be trading pretty well with gold at the time. So what I was looking at was comparing the pattern that was happening here on the Dow, where we get that pop up, it breaks that tight channel, just like we have down here on gold. And it goes into a slightly lower low here. So actually we were looking at right here where this breaks this, goes into that slightly lower low. But within the channel, notice that this is holding that upper end of that trading channel. So even though it hit lower lows, it's holding the upper end of the trading channel, which increases the probability that you're going to get a Phoenix pattern happening next. So at that point, we come up, we break the larger trading channel, which is what we've got here, break of a lot larger trading channel. And then you've got that correction in there. So this is what that previous chart was doing at the same time. It had that larger measured move, and then we started to get that shift with the Phoenix. So on gold, same thing. You've got that pop up. We've got our two-wave corrections. In this case, it's not quite the perfect parallel channel that we would like. We've got a little bit of a narrowing going on. So it is something that you've got to watch out for. That can be a con for it. The most difficult ones where the narrowing occurs, though, is going to be if that narrowing is a really tight pennant. So that's going to be more dangerous than if it's a bit wider, like what you see here. So if you've got this really tight pennant here, what tends to happen is it can give a false setup and then ends up reversing on you. So having a little bit of a wider range, if it's narrowing, is better than having a narrow range if the megaphone or the triangle there is narrowing. And that was the case of the previous example as well. Same thing happening in there. So as you can see, we're keeping things pretty basic here. And what I want to get into is one of the tools that we can use to help us discern, hey, is this strategy close to triggering, or does it need more time to develop? Because one of the things that traders tend to run into over and over and over again with any sort of breakout type of strategy or continuation type of strategy is either taking it too soon or taking it too late. And so Fibonacci fans are one of the types of indicators that you can use that can help you narrow down that time where the trade should trigger in. It gives you those do or die points. So the one do or die point that we were looking at was when we were looking at that upside move and the correction, and then your distancing between your highs. So having that even spacing there, that is one of the do or die points. And in fact, it can get even more specific. If you're coming up here, you've got your correction with your two-wave correction. If you go and you take your Fibonacci price time extension from here to here, you're going to get 100% right here. And then I also use 123.6 and 138.2. So what you want to see happening is by the time it gets to the 138.2% for the time extension, it should be breaking that range with strong momentum. If it's not, you're looking at that as more likely to be a trap. So get more aggressive with your management on the trade. So entry trigger here, stop here, and the stop is rising as well. So that is something to also keep in mind. And then you're looking for that breakout as a measured move here to here. So you're looking at a setup where your return compared to your risk on average is going to be about 4-to-1 if you're just playing that initial impulse move coming out of the Phoenix. If you're looking for a bigger trend reversal, you can get substantially more than 4-to-1. And that's usually my goal. I'll stick to the smaller ones like this just as like little scalps on intraday where maybe the larger time frames are just kind of messy and there's not really anything happening on the larger time frame quite yet. So I'll just go in and scalp the little phoenixes just for like the first impulse move or so. Now on Metastock, the Fibonacci fan tool is located over there on the left. I'm going to be using a different platform here today in my charts just because I am setting up a new trading computer right now. So things are a little bit crazy and I don't have all of my programs updated yet. But the Fib fan tool is one that's on most trading platforms. We'll be working on getting this even better on some of the other platforms out there as well, but it's a favorite. It is something where once you know how to use it consistently, it works consistently. There are advanced rules that I've developed, though, for how to use it. What I'm going to focus on here today are just some of the basics, though. So what are fib fans exactly? And what makes them so important to chartists, and how are they going to help me improve my trading? So the biggest problem traders run into when they're using indicators is they don't know when to rely on them, when to use them, when to ignore them. And oftentimes they put too much faith in them without knowing the ins and outs. So it's like trying to dive into diplomatic negotiations. Well, you've got Duolingo on your phone trying to learn the language that you're working in. It's not going to work that well for you, right? So we need to work on understanding the language of the fib fan. And I've spent a great deal of time over the last 20 plus years using Fibonacci in my trading. I come from a background in the arts, and it's really just interesting how well it works, whether it's really just a bunch of hoo-ha in the wild for reality or not. In trading, it works, and it's really hard to argue it when I'm showing traders live every single day. Hey, here's the adjustment I made for the fib fan. That's what we're going to look for our target and our pivot levels. And over and over and over again, they hit and hold within a couple of ticks. So very, very strong type of indicator to use. And in the Phoenix, it can become even stronger. So here's an example of a Phoenix trade, and we'll dive into some of this other stuff here in just a minute. And one of the first things you'll notice is that this one takes place within that inverse head and shoulders again. You don't have to have an inverse head and shoulders for a Phoenix. The Phoenix just tends to happen quite a bit on that right shoulder. So some of the things that we're going to be looking for, again, you want that two-wave move coming up, ideally breaking your trading channel. And we would like to see a correction with a decline in volume. So this is actually a really crucial point in a Phoenix that often gets overlooked. We want to see volume declining, and usually it's going to take place in like two zones of triangle. So you'll have an initial decline and then a secondary decline with a little bit of a spike as you're cutting your two waves in half. And that's actually a way that if things are choppier, like they are on this chart here, as it's in the trading range, you can figure out, well, which half is where we're really seeing the second wave of correction, because the division tends to be a little bit of an increase in volume. So you'll have a decline in the volume to start with, a bit of a spike, which is usually where you're going to get a bit of a better bounce, and then you'll get the secondary drop again with your volume, which is happening over here. So that helps break this up. If the chart itself is showing you more choppiness, pay attention to what's going on with the volume. And I'm usually getting into a Phoenix before the volume has any sort of a chance to really pick up. Basically, it's the biggest zone of indecision out there. I'm looking for a break of that secondary channel as my entry trigger. And in this case, if you look at our time development, you'll notice that this smaller channel break here is just a little bit early compared to what we would typically expect with the inverse head and shoulders, because our 100% price extension is right here at this red line. So the closer we can get to that 100% extension, it's going to be better as far as getting that breakout when the Phoenix is part of an inverse head and shoulders. Now, the first orange line is 123.6, and the second orange line is the 138.2. So what I want to see is that by the time it's gotten to that 138.2, it needs to be giving me that strong momentum move for the continuation. And as you can see, it doesn't have any problem doing that in this particular instance. The volume picks up as the channel breaks out. So you basically got that as confirmation that, hey, you know what? Things are looking really good. Typical target level is going to be to take your two-wave movement here, and then where the momentum begins, look for a measured move on that. If the momentum is picking up, you can move your target level to 123.6 or 138.2% price extension. So you can get that going even further on the upside. And in this example, we were looking at something that was creating a bigger reversal on a larger time frame. So we typically see bull flags following the Phoenix to get the trend continuing even further. So if you got really good support here on a larger time frame, on larger time frame trend exhaustion, this Phoenix very often leads to that bigger move. Yeah, I will go ahead and show you guys an example of adding them to my charts here in just a little bit so you can see that. So in a bull flag, we're using a lot of the traits that we would use in a Phoenix. You want the two waves up, the two-wave correction, the drop in the volume to begin with, the spike in the middle, but not as much as over here, and then dropping off again. So that is basically just repeating the action that we see with the Phoenix, and that gives you an entry trigger right here. What's nice too is it's also coming right off the lower end of that trading channel. What you would like to see for a third move on the upside is that this pivot low either barely taps the trend line or doesn't even tap the trend line. It just gets close to the trend line. So if it pushes through that trend line, it's going to be harder for that to offer as strong of a continuation. It makes it easier for this to go into a longer correction, and it could even go into a bigger Phoenix at that point. So a little bit of detail in there to pay attention to. And if it doesn't tap it, we call that a no touchy. And in most cases, what you're likely to see is that it will go from your Phoenix to your bull flag to 1, 2, 3 and start to really increase momentum at that point. So that's an advantage of if it doesn't actually hit that trend line for the new uptrend that is starting. Here is another example looking at some greater detail in here, and this has the Fibonacci fans on it. So here you can see the trend line a little bit better. And a Fibonacci fan is made by going from the low of your impulse move. So this would be your low at the start of the Phoenix. This is where you would typically have two waves of correction coming up. And then it's going to splay out these fan levels. So the fan levels here are, this is your 38.2, it's your 50%, 61.8, and 76.4. So these are the fan levels that we're looking at. This is 23.6, 27.2. So you've got each of these levels that we would continue to watch. In your strongest trends, what's going to happen is that this will come all the way up to that 27.2, 23.6%. And it will then go and retest it. So if it's coming up with really strong momentum, a retest is very probable. So it helps you push to get even more out of that trend. Your midway zone, when it comes into that 50% zone, that's the most crucial area to watch for. Because if you get a stall there, it increases the odds that it's going to come back down to the lower end of that trading channel. And you can use that to, protect part of your position and build back in. Or you can go and look for another setup later if you're just using scalps instead. So you can wait that out for that doubling out with the time development again. And this one, the two-wave correction is a little bit better. So you can see that your distance between the highs is a lot better over here. The problem that we run into, though, is likely in this case, it was a larger time frame. I can't remember exactly on this one, but notice the momentum compared to over here. So what we should have seen was that this would pick up momentum. So your trend would go and basically build momentum. And that's where you would get that no touchy zone where it's not really hitting your trend line down there anymore. So in this case, you can see that it did tap it. Ideally, to get that really sharp move, you don't want it to retap it. You want it to come close, but then not touch it. We call that a no touchy. So that's what you would prefer to see. So the fact that it tapped it, that serves as a warning that, hey, you know what? I need to watch the momentum on this because it could shift and end up reversing. It still becomes pretty easy to narrow down the next target level because you got a smaller measured move right into that 61.8% fib band. So at the very least, you can use that channel break to get out of your position. So here's another one. This is one that I did early morning, and this is actually part of a bigger trading range. So you can see over here, you've got this two-wave correction on the larger time frame. So when you're looking at your distancing between your highs, you're closing in on that measured time development over here. Now, on the smaller time frame, we've got, here's our first correction, here's our second correction, but there's also a little mini phoenix right here as well. And look at how low that volume is. We don't have the spike here in the middle that you would normally want to see during this correction, but after this pops up, so it popped up here, gave a little phoenix there, and that's where that volume is extremely light. So we've got a baby phoenix within a bigger phoenix and a nice momentum shift here to here to here that helps support that breakout as well. So in this one, because we've got the bigger time frame setup combined with the smaller time frame setup, you're able to keep a really tight stop, but you're able to look for the larger time frame target levels as opposed to just the smaller time frame target level. You can see some of these, portions of the trend are not as clean as others. That's because there are different ways that trends can develop. I just don't have the time to get into them right now. But you can see the two-wave correction over here a little bit more cleanly. And then here is that two-wave correction over here. So basically what you're doing is you're taking these zones with the highs and the lows, transecting that channel, and then again, taking your zone with your highs and your lows and transecting that channel. So this one is easier to see, but this is also your two-wave correction right here. And then within here, there's two little pivots that are part of that little baby phoenix that's right in there where the volume went to practically nothing. And that really light volume, again, that is really nice to see because it does mean that as it breaks out, you've got stops hitting and you've got people jumping on the trade. So here's another one that's coming out of a bigger trading range. In this case, it's an inverse head and shoulders, which really is not the best as a continuation pattern. So when you've got a move up and then you've got the inverse head and shoulders and you're looking for a continuation on the upside, there's a better chance that this could only do a measured move here to here and then end up going and pulling back, where this becomes your first correction, this becomes your midway, and then this becomes your second correction. So it's harder to get this to give you a full trend breakout compared to over here when your Phoenix is part of an inverse head and shoulders that is part of what you would consider to be either a larger Phoenix or a larger bull flag. So a bigger continuation pattern for the trend over here. So instead, I use a target where I'm going to just measure this move right here and look for that as my main target level. And I can get that a good 90% of the time, if not more. So on my entry in here, I've got a smaller Phoenix again, just like what we saw in the previous example. So here's your 2 waves of correction, but they're really a little bit fast. So what happens is that the market kind of tries to shift that to allow for a correction that takes as long as previous corrections. And so if you've got an inverse head and shoulders, this is your left shoulder, ideally your right shoulder should take about that same amount of time. So if this had held right here and popped, that would be a shorter shoulder compared to the left side. So comparing your zone of correction for your Phoenix formation to other zones of congestion can also help you visualize if something is too early or too late. If it's too late, usually what that means is that it would double out. So if your previous zones of congestion look like this, then, and it doesn't go right here, then it's more likely that it's going to double out before it tries again. So it doesn't necessarily mean that you're completely out of luck. It just means you've got to wait for the next do or die point to have higher probability of success. So with our fib fan, what I'm doing here is, since this is a fairly average upside move, a lot of overlap within it, going from my low to my high, this pulls back pretty sharply, but it pulls back only 50% or less. So ideally, that first pivot will hook up with your 50% fib fan. And then your 76.4 becomes your major support level. So on this one, I was initially looking for further on this. I can't remember what the reason was that I didn't hold for more, or maybe I did and I just didn't put it on this chart. But you can use your small entry and your small stop here to begin with. And if something pulls immediately into 76.4, or basically 3/4 of that initial impulse move, your probability of it getting to 100% is very, very strong. Now, if it got stuck at 50% and started going into a range at 50%, your odds of it making it up to 100% are dramatically decreased. So what you would want to do is, if it got stuck here at 50% and then tries to continue, I would be taking partials at that 76.4%, or look for some sort of shift that could break down and tighten up my stop on it at that point, because there's just much more likelihood that in order for it to make it back higher, it would need to go into another zone of congestion, and then it could try it again later on, but you're more likely to get it just chopping around here. So that impulse move coming out of your Phoenix is really important to watch for. You want to get it moving to the 61.8% price extension. So here to here to here is your 3 points for your price extension. I'll show you how to put that on here on this one. Right pen go. Here. So you're going to go from, for example, high to low to here. And what you can see is that red line, it made it really easily to 50%. So this pattern right here is the avalanche. It's the opposite of the Phoenix. So you can see it has the 2 waves on the upside here in the middle. And then it triggered after hours here. So this is another example of that, but it shows you how to put the fib fan on here. And let me show you how to put, or sorry, the fib extension. I'll show you how to put the fib fan on here as well. Hold on a second. And again, all charting platforms are a little bit different, but there's not usually a whole lot of difference. So we would go from this high to this low here. And what you can see is it's perfect. It comes up, you're in that kind of less than 50% zone. So it's good to have it at that 50% fib band. And then right off of that 76.4 becomes the trigger point. And this pulls immediately to 61.8%, which means it's going to go at least to 100% and many times further. So remember I mentioned earlier, when we have that 23.6, 27.2% fan, it hits it once with really strong momentum. The odds are it's going to hit it again. So you can use that to look for even more on your trade if it's coming into that 27.2, 23.6% zone without really doing much of a stall. So this is a great example that we just saw yesterday afternoon. You've got the head and shoulders type of version as well. You just don't have a clean shoulder over here on the left-hand side, but you do have that time development aspect where here's where the momentum begins to shift. Here's where it stalls that shift. And then here's where we have a cleaner shoulder over here. So entry trigger on this, you can use this entire channel break, but usually what I'm doing is I'm looking at that smaller channel right as it's coming up into there. And then my stop starts trailing down along here. I get back to my pen. So here's a little bit of just closing in and looking at the details a little bit more. So you can see that second kind of test here of the fib band, the two waves correction. It's just a little bit tilted. Now, since this based out further and we ended up with that level, you're right going into that 138.2%. So it was really crucial. It had to go right there. Otherwise, the base would have taken too long. And then the odds would have become greater that it would go ahead and break down and trigger a reversal, which likely would have gained speed and gained momentum on the downside if that had happened. So it's very important that this confirm the momentum here when it broke out of that spot. This just shows some of the trade management I did on it here. A lot of the charts that I use in my classes, like for Jeff's class here, are relying upon trades that I took intraday or I taught live because I like traders to be able to see them as they're actually developing and playing out. So I do live classes every single day between 12 and 1, and we're always following either strategies that are unfolding in that time and how to manage them, or what the most likely probable strategies are going to be for the afternoon as well. So this is just some more detail using fib bands and showing how those can come into play. So you can see the Phoenix down in here, the comparable time development for bull flag. And these were just some of the executions that I had on it. So I was looking at, this is a pattern, it's called a momentum reversal plus down here. And this is normally where you would get your Phoenix, but it was a retest of that fib band. So here's your Phoenix right here. So this is the Phoenix. And then the two waves, it's picking up momentum, so it manages to go more than 100%. And then this is a chevron, which is another type of continuation pattern. it's one of the more advanced ones. It's trickier, but you'll notice that the time development for that congestion is almost exactly the same. So that gives us really good probability of getting that third move there. And then we get a megaphone for a reversal. So this is my exit and I flipped it, and then here's your avalanche. So the avalanche is the reverse of the phoenix. And that is what's forming right here. And then I just use measured move and congestion over here as a target zone on that. So if you guys want to see this play out in real time, don't hesitate to drop me an email, and we'll get you in there so you can watch them as they're playing out in real time. So here shows you an example of where we've got a two-wave correction, right? But look at our fib fan. It's telling us none of these lows are hitting here as it's pulling back. So the start of our fib fan is that absolute low, and the end of the fib fan is where it starts to go into a zone of congestion or correction. So you can also tell that this was too early for a decent buy because we can look at the previous zone of congestion and correction, and that would have wanted it to come out at least over here before we would get a stronger setup. So this could have done this as part one and then done another correction here and then taken off. But you would have needed to have seen a smaller setup as it was coming into that fib fan zone here before it would bounce. So that's where we could have gotten a setup. Now, if it breaks your fib fan and you don't get your trigger for a phoenix, the interesting thing is that fan is going to serve as a resistance level. So a lot of times that's going to be a zone that I'll go short because it'll broken the support and then tapped that fan level as it's coming back up. And I showed our traders some live examples of that here just over the course of the last week where we were using it, but we didn't like it as a buy, but we could still use that fan as a place to build into the short position. That just goes into that in more detail. And then here's an example of something that just doesn't get going. So how can we pay attention to something that's not doing what we think it should be doing? So this is an example of a chevron phoenix, and it has the first portion over here where the momentum is shifting a little bit. And then it has the second portion here, which consists of those two waves. So in our fib fan, we're going from the low to the absolute high here. And then you're looking at that 76.4% zone as the entry trigger. Now, what we needed to see was for this to go and immediately bring in strong momentum. The problem is if you look in this upper corner up here, we've got a huge gap and move on the downside. So that momentum on the larger time frames is very much favorable for more bearish action in this example because of that trap up there. So it makes it harder for the phoenix to really go and gain momentum. And this is where you would want to go and drop in and use some advanced trade management. So this makes it to the measured move. Let's see how it does it with all of this chop. So you can go and you can adjust your trailing stops underneath that trading channel. So it would help protect you as it's moving higher. So even if it ended up going and flushing back down, you would still have protected most of the trade as a result. And the great thing about these phoenixes is that your stops start to move pretty quickly as soon as you're in the trade. So you can keep adjusting that stop higher and higher, and it doesn't become long before it becomes break even if it does manage to flush down, which is why it is one of my favorite strategies, because as long as you're taking that smaller channel break, you've got a really small stop compared to what your target's going to be. And taking the small channel break doesn't increase your odds of a stop any more than it would have if you waited for the bigger channel break. The only difference is you've got a much smaller stop and you can take more contracts or more shares. All right, gang, I am gonna go on through here really quickly because I've got a 2-hour class I'm doing right after this as well. We're gonna be going into trading naked, which might be as exciting as you're thinking. But yeah, that's what I'm teaching here right after us. So here is another example of our little Phoenix, and look at this. So here's that break, that target level on the larger time frame from that measured move, came in. See how it tapped it? It actually hit that channel. That's what we really don't want to see in order to get things going on a continuation. So on the little mini Phoenix down in here, that becomes the target level. So yeah, if you haven't played around with fib fans, I highly recommend doing so because it is a beautiful tool to add to your arsenal and one that's fairly easy to use because even when we make adjustments, those adjustments have rules to them that are fairly easy to pick up. There's about half a dozen rules or so for it. And here's another example of fib fan. Just shows how I manage this particular one. But again, you can see the volume dropping off and then the tap of that, 23.6, and then the retest at 27.2. And then here is our lovely avalanche as we went into the end of the day yesterday. Well, I want to thank Jeff for inviting me to join him again for this lovely little conference you guys got. You were learning all kinds of stuff, I bet, right? Or becoming really overwhelmed, and then you've got to go back and think about it. Hey, what's something I can go and take from all of these classes? What kind of underlying theme is going through these? For me, it's KISS, keep it simple, stupid. So try to stick as close to templates of strategies you're learning as possible. A lot of them that I shared with you here were variations on the Phoenix template, but you can go and sim trade those and do screenshots of those and go back and study them. So it's really something where you're able to keep very tight risk parameters that allow you the time to learn. You know, you're not going to end up with something that has a huge stop to it compared to what the risk is. And the Phoenix is more than 80% probable to hit at least that one-to-one price movement. So that initial impulse move up before the correction hits, it's most likely to get to 100% of that, which is usually 4 times what your stop is. So over 80% probability of getting to that 100% price extension. So I have a class that I did, it was covered like 3 weeks, where we dive into the Phoenix and the avalanche in substantially greater detail. So you can learn all of the different variations of it, techniques for moving your stops, more advanced techniques for placing initial stops as well, recognizing when you're going to get a Phoenix that is going to be a strong continuation pattern versus one that's only just going to give you that first initial impulse move coming out of it and then can go and continue a larger trend, like a larger downtrend. So you have the Phoenix, which serves as part of your counter trend correction, and then the larger trend continues. So differentiating between that versus the Phoenix that offers a totally new trend, and you're getting in those very early stages of that new trend. So thanks again, Jeff, for joining me here and inviting me to share with all of you folks. And I look forward to next time.
Cool. Dinesh wants to know when the next class is. So do you do it every week? What is kind of the frequency of the classes that you do?
I teach live every single day at noon Eastern. So it is called League of Traders. If you go to my website, tonihansen.com, you'll see the link for it. If you shoot me over an email at toni@tonihansen.com, I can also get you set up with a trial for it as well. Let me type those in there.
I did.
Oh, perfect. All right. Thank you.
It's like I've been practicing all week, Toni.
I know, right? I've gotten out of practice. I used to be a speed typist, but now I just can't do that anymore.
I still can't type and talk at the same time, though. So,
right.
Cameron wants to know, and maybe you could cover this real quickly, because I know you have to go. But
I do.
How do you know when to start putting a fan? Do you just kind of look for a V formation and start there?
Yeah, I mean, once you're starting to see a counter trend move, where it's broken a smaller channel from the bottom, and you have something where it looks like, hey, it's pausing and it's starting to begin a correction off of the high. So, you know, your black line over here, your blue, your green down there is where it's kind of starting, and then you can see it kind of breaks that channel. So you kind of need that confirmation of a channel break first to then use that trend. And again, there are advanced techniques for putting that on here. I just don't have time to get to them today.
You can also scan the QR code. Metastock made one for you. So if you're watching YouTube, that is. All right. Last thing, Kelly says, not a question, but I love the name of the pattern. The concept of Phoenix goes really well with this strategy. Toni, you're late.
Thank you.
We'll let you go. Thanks for coming.
All right. Take care, everyone. Bye.
Bye. Okay. Let me go ahead and do this real quick. And we'll go ahead and kind of go back here. So let me make myself the presenter. Before we go to our next also great presenter, I want to do a real quick shout out to CMT Association for sponsoring the events that we're doing. We appreciate CMT. A couple of the speakers we have today are actually CMTs. Most notably, well, the one that comes to mind is Martha Stokes, who we're going to have talk a little bit later today. But I also think Buff might be a CMT, but I'm not sure about that. We'll ask in just a second. In any case, you know what time it is. It's prize time. Kelly, I should have warned you that we're going to do this, but I'm going to actually have your help here. So if you would, let's go ahead and have you talk to us for a minute. All right. I have a question for you. I know you've been paying astute attention to like all of the sessions we've been doing all week long. And so you should easily be able to answer this question.
Oh, here we go. It's quiz time. I love it.
I just am curious if you can tell me the exact number of prizes we've actually given away right now. I want your guess.
Man, that's a good one. I'm going to go with 42.
I'm actually surprised you're as close as you are, actually. Not 50. We've given away 50 prizes so far. So that's awesome.
If you watch Hitchhiker's Guide to the Galaxy, or read that book, you know that 42 is the answer that you should always go with. So.
Ooh. Actually, I have read that, but I forgot it because I don't remember anything that's been in my brain for more than 2 weeks. So... But John knows what time it is. He's given us a number. Thanks, Kelly. I just wanted you to help us guess. Okay. I wanted to see. 50, I think that's a record for us, for sure. So now if we're going to give away 2 more. We're going to make that a nice 52. So if you would, give me a number. As you're doing that, I already have a number in YouTube, but I'm waiting for a number to be put into the GoToWebinar chat. And so go ahead and put in a number, and I'll tell you what you've won. You've won, or whatever number you pick has won. So let's go ahead and kind of take a look at YouTube, the prize list here. This is actually a really cool prize that's from Silas Peters, and it's his Price Action Weekly Playbook. It's a value of $997. This will give you weekly price action alerts. You'll receive the top trade of the week from Silas, daily market analysis video reports, weekly price action members workshop, Oh, that's what you're going to get. Let's go ahead. So John in YouTube gave us 1, 2, 3, 4. Let me go ahead. That's the code that I have for my bank. Just kidding. Let's go ahead and see who 1, 2, 3, 4 is. Vivek M is the winner of that. I'm going to go ahead and copy that over the spray sheet. Okay, and then Jackie, thank you for the number 7777. And this one's a CM in India with a Hotmail address. So let me go ahead and make a note of that. Okay, since we've given around 52 prizes right now, approximately, give or take. Since we've given 52 prizes, there's a good chance maybe you've won. So just to kind of explain how that goes, we will be sending, as I kind of get everything kind of caught up from this whole week, next week I'll send all the prize winners to the respective companies that we're giving away the prizes, and they will contact you directly to get those prizes. So there you go. Thank you, Gretch, John, Jackie, Dana for the numbers. Thanks for coming. Thanks for participating. Again, just to remind you, we are Metastock. We've been rated #1 30 years in a row. Best software in its price category. We are doing an extended trial. You should try it out if you haven't already. Metastock.com/conf promo, metastock.com/sales chat, 800-882-3040. Our next presenter is Buff Dormeier. Buff does a lot of really good volume analysis, and he's going to talk about his VCPI indicator. I'm a little bit dyslexic sometimes. That might be VPCI. But he's going to talk about his very, very unique volume indicators, how they work, how they're made into Metastock, how you can use them, and how you can look at them as a confirmation. He's a great system designer. Buff, let's go ahead and get you started. How are you doing today? All right. Hey, Buff, we're not hearing you just yet. I did send an unmute request, so it should be asking if you want to unmute your audio. So, but we aren't
Hey, can you hear me now?
Yes.
All right. Fantastic.
Actually, let me go ahead and make you the presenter too. We'll make sure we can see everything. And see the screen, all that kind of good stuff. Here it is. Yeah, I am seeing the presenter view. It looks like maybe, or you haven't expanded to full screen. One of those two things yet.
But
there you go. You're perfect. I can hear you, and I can see your screen. So, and you are a CMT. I knew it.
You got that one right.
Yeah, very good. Cool. What did I miss? No, I'm kidding. It's all you, Buff. We can see you. We can hear your screen and your. Go. Your turn.
All right. Hey, well, thank you, Jeff, and thanks everyone for joining my session today. My name is Buff Dormeier. I'm a CMT, and I'm also a volume evangelist. And so our goal in this presentation is not to instantly turn you into a market guru or reveal the holy grail of investments. You can find those offers in your junk mail. Rather, our objective today is to provide you with new tools, some new applications, and teach you how and why these volume-based principles may allow you to better interpret the charts and become an improved trader and investor. Now, the markets are extremely efficient. Here you'll find the most capitalized institutions employing the wisest minds and the best resources. And going against them head to head, that can be a difficult game. So I'm here today to provide you with an edge so that you too can follow the path that the stock market is blazing. Give me a second here. I'm gonna figure out how to turn my volume down. I don't see how to do that. So give me 1 second.
Oh, thank you.
Okay.
But I think the problem was my mic was
So
on.
today we're going to uncover the fundamentals from my Dow Award-winning research from the 2008 Charles H. Dow Award, where you can find these resources for your own use within Metastock. Now, let me tell you, this is going to be a technical discussion. I'm going to speak about some of my most basic indicators and why they work, and we'll focus on the fundamentals and then build upon that base. Now, it's going to seem basic at first, but you're going to need to pay attention because these are principles that build a foundation, and that understanding is going to be needed as we progress along. So why should I use volume? Provide volume as an edge. This is not strictly my opinion. This is the research that has been applied and tested over and over again. Now, here are the 4 good reasons why to apply volume information. It's like any good sermon, I'm going to provide you with 4 rational points, all starting with the same letter. This is the letter R. Here are the 4 R's of volume. Number 1. R number 1 is responsiveness. Volume provides quicker information. You may have heard the mantra, volume leads price. This has been around since the day as Charles Dow. Changes in volume generally occur before significant price movements. The second R is reliability. Volume confirms price. If you can think about price as the market's testimony. Volume is the market's polygraph. Volume validates and substantiates price. The more investors participating at a given price, the more that price is validated. In this way, volume not only gets you into the trade faster, but simultaneously can increase that probability that trend, that momentum will continue on in the future. Number 3 is risk. If you can identify legitimate trends and distinguish them from failing trends, and if you can identify trend weakness early on, you should also be able to reduce risk within your portfolio. And perhaps most importantly is return. If you're in a trend earlier and have a high probability of being positioned correctly, you are putting the odds in your corner and positioning yourself for a better return. So let's go back to the basics. And it doesn't get any more basic than price. But what is price? So if I buy a stock today, what's my opinion? Well, I'm bullish because I believe the price would rise. Why else would I buy a stock? In order for me to take ownership, the order must be matched, however. And what's that seller's opinion of the security I'm buying? Well, there could be multiple reasons to sell, but most likely the person that's selling me that security, they're bearish. They believe the price is going to decline. Therefore, price is an agreement to disagree. 2 parties with opposite views of the future, they come to agreement. That agreement is called price in the exchange market. Price represents truth. It can be its conviction, the emotion, and will volition of investors. Again, price is truth. It doesn't matter what they're saying on TV, what the analyst price targets are, or what someone's or some institution's view of intrinsic value may be. A stock is worth what it trades for, and that price represents all the collective knowledge of the market. It's truly a beautiful thing. You don't believe me? Ask somebody caught in a short squeeze. Price is truth. Volume is the number of shares traded over a given period of time. I like to think of volume as synonymous with force. So you look up force in the dictionary, that's what it'll say. Force is the power made operative against support and resistance. Well, as Jeff pointed out, I'm a CMT. And so what's support? Support is an area where buyers reside. And what's resistance? Resistance is an area where sellers reside. And what's an uptrend? An uptrend is nothing more than a rising support line. And what's a downtrend? A downtrend is a falling resistance line. Now let's move from technical analysis 100 to technical analysis 400. Volume is the force required to sustain those trends. Now let's look deeper into that. In physics, the physics dictionary defines force as this: a vector quantity that tends to produce an acceleration. Again, this confirms the tenet of Charles Dow over a century ago: volume leads price. In summary, think about what Yoda said before engaging in an important mission. What did Yoda always say? May the force be with you. Volume, my friends, is the force of the exchange market. If you learn or take away one thing from my presentation today, remember, volume is the force. And as an investor, you want to make sure you are on the right side of it. So why did the market go up yesterday, but it was down the day before? Why did it go up? Well, there must be more buyers than sellers. That's technical analysis, right? Well, no. That may be what you heard on CB and CNBC. That's not analysis. They don't understand. In the exchange market, the number of shares purchased always equals the number sold. So here's a simple formula: B equals S equals T. Buy volume is the sell volume, and sell volume is the total volume. They're all the same. So let's put this into practice. Let's say I get a signal from my newly purchased Metastock add-on, and so I get that signal now. So I have to buy the stock now. So what I'm going to do is I'm going to put an order in for 1,000 shares of the stock, say ABC stock. I'm going to put it in the market at market. Unbeknownst to me, there's an institution selling 100,000 shares because it just reached that security just reached their intrinsic value target. So in order for me, so what they would do is they put a limit order to sell their 100,000 shares. My 1,000 shares matches with 1,000 of their shares. And so question I have to you is, who's in control? Is it me, the buyer, with a market order suggesting urgency, or is it the seller with 100 times as many shares to sell, but with a complacent limit order? The answer is we don't know. We don't know until the order is executed, that is. But if the trade goes through on an uptrend, it indicates that demand is greater than supply. If the trade goes through on a downtick, we know there's more supply and demand. These interactions are happening tens of thousands of times every second, 5 days a week when the exchange markets are open. And these accumulations of ticks over time, if they're moving higher, we know demand is in control, and that's visualized by the uptrend. And if security is being accumulated. Now, if those accumulations of ticks over time are moving downwards, we know supply is in control, and that's visualized through a downtrend. And that the security is being distributed over time. Now, what if there is a way to look deep inside of these interactions of supply and demand to determine if volume is supporting price? That is the goal here of volume analysis. So, Newton's first law of motion. An object at rest remains at rest. An object in motion remains in motion at a constant speed and a straight line unless acted upon by an unbalanced force. Why am I reading this? There's an analogy here. Volume is the unbalanced force causing price change. Newton's first law of motion. As a starting point to understanding this physics principles, let's look at my most basic indicator, the volume weighted moving average. This is available to you in the Metastock add-on. The volume weighted moving average was originally published as buff averages in one of our sponsors, Stocks and Commodities, and it's been recently popularized as different names, even different from volume weighted moving averages. So, what are volume weighted moving averages? Volume weighted moving averages differentiate from moving averages, and that they not only include price data like volume, like moving averages, but they also include proportional change of price. In effect, a moving averages shows you the average price, where volume-weighted moving averages show you the average price in which investors actually participated. So, a simple illustration here. Let's say we're creating a 2-day moving average. One with a standard moving average, or simple moving average, and the other with a volume-weighted moving average. Day 1, the price is 10. Day 2, the price is 12. The average price is 11. That's a simple moving average. But what neglected is the volume information. So now let's say the price of day 1 is again 10, 100,000 shares traded. Day 2, price is 12, and 300,000 shares traded. So now we know the average price is 11, but the average price that people actually participated was an 11.5, because 25% of the shares participated at 10, and 3/4 of the investors participated at a price of 12. So here's what it looks like on the chart. The red line is the volume-weighted moving average. The blue line is a simple moving average. These bars, notice when the volume increases, how much more responsive the red or volume-weighted moving average becomes. So why are we going to use volume? Because it encapsulates and captures these 4 R's, and we're going to study that next. So here, what we did is we took 60 stocks over 5,000 traded days. And these stocks, 60 stocks, were based on 3 categories. We looked at large caps, mid caps, and small caps. Then we divided these 3 sizes by 4 factors: stocks with high volume, high volatility, and low volatility. These 3 categories and 4 factors create 12 groups. For example, large cap stocks with high volume would be a group. Each group had 5 stocks chosen by the strength of the factor. So if we were looking at large caps with high volume, we take the large cap index and we find the stocks that had the highest average volume. So in terms of responsiveness, when we tested this, 93% of the issues showed faster signals when you use the volume-weighted moving average than moving averages, whereas only 5% showed better responsiveness with simple moving averages, and 2% of the time it didn't make a difference. So volume does lead price. Here's another study done over multiple decades, done by the Wharton School. And in their concluding statement, here I'm going to read it to you. We find that individual stocks whose trading activity is unusually large over periods of weaker or a day or a week, as measured by trading volume, during those periods tend to experience large subsequent returns. Well, if that's not good enough, the University of Texas hears about this and reason, can this really be true? All you got to do, you just need to add volume. So they went and did their own study on markets and they studied stocks all over the globe. And here was UT's closing comments. We studied the existence and magnitude of the high volume return premium across equity markets in 41 different countries. And we find that that premium is a strikingly pervasive global phenomenon. We find evidence that the premium has a significant presence in almost all developed markets and a number of emerging markets as well. So another example where technical analysis, but specifically volume analysis, is being respected and cited in academia. Now, let's be honest here. Obtaining a faster signal isn't that difficult. All we need to do is shorten a data set to receive quicker signals. That's true in technical analysis, fundamental analysis, economics, any realm of science or social science. You shrink the data set, you get a faster signal. But the cost of that is always at the expense of reliability or accuracy. However, with volume analysis, we not only get a faster signal, but simultaneously improve upon the reliability of the signals. So this study shows 60% of the issues showed improved accuracy with a faster volume-infused volume-weighted moving averages, where only 28% were more accurate with simple moving averages, and 12% of the time there was no significant difference. So volume not only leads price, but confirms price as well. The next R is risk. Of the 60 securities, 70% experienced lower drawdowns than when infused with the volume, compared to only 30% without the volume. Now, risk, I believe, is the most underappreciated statistic by traders. So everyone focuses on this next R, however, return. And that doesn't disappoint either. Of the 4 factors, low volatility, low volume, high volume, all 4 showed increased probability when infused with volume. And of the 3 sizes, all 3 again showed improvement when infused with volume, especially mid and small. And go back to the last one, especially high volume and high volatility. So we take those 4 factors with the 3 size categories. We have 12 groups. 11 of the 12 showed improvement with volume weighted moving average. The exception here was low volume large caps. Newton's third law of motion states whenever one object exerts a force on another object, the second object exerts an equal and opposite on the first. Okay, here's the most important point. You're not going to hear anywhere else. This is my area especially. This is what people miss on volume analysis, this third law. The difference between price trend and a volume adjusted trend exposes the asymmetry between price momentum and volume momentum. So it's not so much the volume weighted moving average. What we're looking at here is how the volume moving average differentiates from the simple moving average. And that difference is the asymmetry between a price trend and a volume weighted price trend. And this asymmetry is the basic building block to construct the VPCI, the volume price confirmation indicator, which tells us whether the volume is either confirming or contradicting the price trend. So notice here in our chart, price here, VPCI here, volume here. Notice that price 1, the VPC bottoms before the price bottoms at 0.3, 0.2, we have a crossover before price crosses over here at 0.4. So volume is leading and telling you what's happening before price. It doesn't always set up this way because there can be many factors that drive price change, but I find that the volume factor is the most significant. So let's put this together and talk about how we use it. Okay, so first let's define some terms. An uptrend is greed. Thing about greed you have to remember is greed is needy. Greed is needy because it always wants more, more, more. Whereas a downtrend represents fear. Fear is a herd reaction. Get me out and we'll figure out the rest later. Volume, rising volume is energy, thrust or fuel. Whereas falling volume, declining volume operates not under the laws of energy, but the laws of entropy. So we'll start here with the first quadrant. We have an uptrend with rising volume. We have greed empowered with energy. This is invigorated greed. This is strong demand. This is an issue that's going up, and more people are willing to participate in that stock as it moves higher. The uptrends be confirmed by that fuel or energy of the volume, and the implication going forward is bullish. Next, we have a trend that's going up, but fewer and fewer people are buying. The volume is falling. This is greed, not with energy, but in a state of entropy, or the market is in a state of complacency. We might define this as an issue under weak demand. The uptrend is being contradicted by fewer people willing to participate at ever increasing prices, and the implication going forward is bearish. Next, we have a downtrend with rising volume. We have fear with energy. This is an issue under strong supply. The downtrend is being confirmed by more people willing to sell at ever decreasing prices. The forward implication is bearish. And lastly, we have a downtrend where the volume is falling. This is fear with entropy or a state of apathy. This issue is under weak supply with fewer and fewer people willing to sell at ever decreasing prices. So the downtrend is being contradicted by fewer people willing to sell. The implication is bullish. So let's put it all together. We got three signals. Is the VPCI rising or falling? Is the VPCI showing positive or negative momentum? That's by the VPCI crossing over a smooth average of itself. Is the VPCI above or below zero? These are all signals. So let's take a look at what it looks like on a chart. Okay, we have the price chart here, we have VPCI here, we have the volume on the very bottom. The trend, what's the direction of the trend here at 0.1? It's obviously down. And look here, we got the red line, the VPCI, crosses over the blue line, the smooth average, and then crosses above the zero line. So this is a downtrend being contradicted by the VPCI turning up and crossing over the zero. Sorry about that. Let's go to the second phase. Now the trend is up. The VPCI is up. So the uptrend is being confirmed by the VPCI rising. Next, we have the VPCI starts to fall. The trend is still up, so the uptrend is being contradicted by this cross under, then going below zero, and eventually the stock breaks down. And then look at this here. Does that look like any letter of the alphabet? It's a letter V. This signals a VPCI bottom. We're going to talk a lot about that here in just a minute. But it's the capitulation side. Then the VPCI starts to turn up. Now the downtrend is being contradicted by VPCI rising, stock breaks up again, and the volume confirms it. Now, here's the study. What we did is we took the stocks in the S&P 500, and we looked at the ones that had the top 10% highest VPCI scores, and we bought those. And then when they fell below the top 50%, we buy them when they hit the top 10%, and we sell them when they fall below the top 50%. And in doing that, we create the red line here versus the blue line, which is the S&P. So I would be remiss without sharing one other VPCI signal. Okay, so how many of you think about this? How many of you know somebody that's always right? Anybody know this? Anybody that's always right? Let me tell you the answer. If you're a husband, your wife is always right. Now, you may not know a whole lot of people that are always right other than your wife, but you probably do know somebody that's always making the wrong choice at the wrong time. And let me tell you, you can find these investors in this symbol right here, the spider. This is a bunch of retail investors that are always driven by greed and fear. So they're usually doing the wrong thing at the wrong time. And so what we're going to do now is we're going to look at the VPCI, and we're going to look for a capitulation sign. And so what we're really looking for is when the market's really headed down south, I mean really strong, and then what's going to happen? This volume is going to really increase. But we're looking at the volume specifically at the spider, because that's where all these individual investors that are always doing the wrong thing at the wrong time are what are they doing? And what we'll see here is with the VPCI when the asymmetry gets really far below, and we can see that by putting a Bollinger Band on the VPCI, and when it crosses under two standard deviations, a 2 standard deviation move crosses under, that's not the signal, that's a setup. What we're waiting for is to come back up, and ever so slightly, that tells us that all those people have already sold. And now, since they've already sold, the market's capitulated, and now it's at a good point to re-entry. So this is our re-entry signal to tell us when to get back in. This was the February 3rd, 2003. That led to a market top later, all the way in 2007. Now, how many people here bought the market bottom the day March at the market lows 2009, other than me? Anybody here? Okay, so how was I able to do this? VPCI V bottom on the very day of that great recessionary low, the March 2009. Find more examples. How about more recently, the capitulation signal of the pandemic? Okay, this one we didn't hit the bottom. We were 2 days early. We got in March 19th, and and then we hit the actual bottom 2 days later. So we were 2 days early on. Got in here, bottom here. So a little early on that one. And what this shows is, what if we were to put the VPCI bottom into a risk overlay strategy? Okay, and these are the V bottoms over the last few decades or so. What that does is it's been a really good re-entry point for the spider. And what have you done for me lately? This is, one's not good enough. How about two? So the W bottom is a shallower V bottom. A V bottom requires a really steep market decline in a ratio of under -4. You can see this one here. The first one hit, it was only -2. The third one hit, it was only -3. But two shallow V's in a row equals a W. And so we got the W bottom actually on the very day, October 1st, that was the low in 2022. Another great signal with the VPCI, not V bottom, but the W. The W, again, is two V's that are shallow. Well, actually, it could be deep. The first one has to be shallow. The second one could be deep or shallow. And so when you add this to a risk overlay system, S&P is the yellow line, and as opposed to growing to 47,000, we grew to almost 80 when we incorporate the VPCI V bottoms, or excuse me, the W bottoms. This is the W bottoms. Here's some stats. The big thing to look at, the beta is only 0.6. Next, what happens when you put V's and W's? Well, as opposed to 80, now we're up to 86 when we put the V's and W's together. So let's advance and put the VPCI into a trading strategy. So here we're going to put the VPCI into a bad trading system. What we're going to do, here's the bad system. We're going to buy the SPY based upon a MACD and an ADX combination. So the MACD's got to turn up and the ADX got to be high. And this tells us when the ADX is high that the security's trending. And the direction of the MACD crossover tells us the direction of the trend we should be trending in. And then we're going to use volume to confirm this, either with the on-balance volume, my late friend Joe Granville's indicator, or my own VPCI. So let's see what happened. This is the data from the Charles Dow Award. So during that period of time, let me just go forward. I forget what the period of time. From 93 to 2006 is the period of time. The S&P averaged almost 10%. But if you were in the MACD with high ADX, you turn that 10% into a 4% loss. That's not good. But when you use volume to confirm it, if you use the on-balance volume, you cut your losses, your bad trading system, at least you didn't lose as much, or less than half of what you would with the bad trading system. But what happens when we add the VPCI into a system that loses almost 4? Well, we move from losing 4 to gaining 8. So next, let's take a look at profitability. We turn this system right here is profitable 42% of the time. And now when we insert VPCI into the system, we move it from 42% to 65%. And look what we did to, even though our return isn't high, look at our risk-adjusted returns. Our standard deviation here is 17 3/4. That's a lot of volatility. Our volatility here is down to less than 7.5. One of the reasons is we're not invested 100% of the time. We're only invested 35% of the time. And like now, that period of time, if we were, instead of putting our money in cash, if we would have put money in T-bills, we would have actually beaten by a hole. We would have had over 10% if we would have just put our money into T-bills during the 65% of the time we were in cash. Also, take a look. Our worst year in our strategy was 2000, where we lost 2.7%. Again, if we would have invested in T-bills, we wouldn't have had a down year. So the question I have for you: anyone have any ideas on how we take this losing system of the MACD and the ADX and turning it into a winning system so we can find something good to pair with the VPCI? As always, I'll give you the answer here. So what's the winning system? It's the exact same system, but this time, as opposed to using the spider or the index, we're going to use the components of that index. So here what we're going to do is we're going to take 5% positions in the S&P 500 component meeting the criteria of a high ADX greater than 30 and a MACD crossover. And then then it also has to be confirmed by the VPCI. Again, this is the same system as before, but now we're going to use the components as opposed to the index itself. So why does it work so much better than the index? Because the index is diversified, and that diversification takes away much of the volatility and the strong trends. So as a baseline, the S&P invested in this period of time grew to 100,000, grew to 1 million, so tenfold. That's this red line right here. Okay, what you might have to ask, what's the yellow line? Yellow line's cash. Okay, so how much of the portfolio was it cash in any one period of time? This 1 million represents a 9.6% return. Now, what's the blue? The blue is using the MACD, the ADX on the components with the VPCI. And so as opposed to having 1 million, we have 4 million. Our returns are 17.5 versus 9.6. This system is available in the Metastock volume analysis toolkit, by the way. So Newton's second law of motion. The acceleration of, this is about momentum. The acceleration of an object depends on the mass of the object and the amount of force applied. Price acceleration or momentum is powered through volume. That's what Newton's second law is telling us in security analysis, that price acceleration or momentum is powered through volume. So another one of my indicators is the volume weighted MACD. And with the volume weighted MACD, what we're going to do is we're going to flip out the exponential moving averages in the MACD, and we're going to replace them with our volume weighted moving averages. And when we do that, we get the same benefits that we did when we did the simple moving averages to volume weighted moving averages. But we're not going to talk about that. We're going to talk about the trend thrust indicator, because what the trend thrust indicator does, it takes the volume weighted MACD and brings it to a whole another level. So this is an enhanced version of the volume weighted moving averages. And again, this was published by our sponsor, August 2011 issue of Stocks and Commodities magazine. Okay, so TCI is similar to the volume MACD, except it's going to apply adaptive logic derived from volume ratios within the calculation. Okay, so here's a picture of it. Here's a bar chart. Here's the volume. Here's the MACD. Here's the volume weighted MACD. And here on the very bottom is our trend thrust indicator. Okay, the TTI is going to look similar to these, but what you're going to find is it tends to lead and have fewer signals because of that adaptive volume ratios. So let's go back to our R's. The first R is reliability. And as you might expect here, trends, the market trends about a third of the time, so the MACD works about a third of the time. However, when we empower this with the volume ratio, our MACD, or now the trend thrust indicator, moves profitability from a third of the time to over half the time. So what this is telling you means that stock may trend a third of the time, but much of that trend isn't being confirmed by volume. Okay, here's the reliability of the 12 subgroups. Almost every group improves from MACD in the mid-30s to reliability above 50 with the TTI. And profitability, with greater reliability comes improved profitability across all 7 groups, all 3 sizes, and 4 factors. So the question asked of me, why don't you just swap the MACD and use the TTI instead in the Dow reward system? That's a good question, and that's what this slide shows. Replacing the MACD with the TTI from 1993, and this is run just until last August. And what happened? You got a 9.3% return, a little bit down, but it's about the same amount of money as the last one, $1.4 million. So the market returned 9.3, but the VPCI, the TTI, and ADX combo got 23%, resulting in not in 1 million, over 34 million. And it did it, look at the beta on that, with less risk. So now, if you really want to find a group with more volatility and even more trend, which index would you might choose? Yeah, I know you know the answer is the NASDAQ. So let's look again now at the NASDAQ 100 components as opposed to using the S&P 500 components. The NASDAQ has significantly outperformed the S&P the last couple decades, and these issues in the NASDAQ exhibit more volatility and trending patterns. So the NASDAQ 100 investment doesn't grow to 1 million, it grows to over 4 million. But what does the TTI system do? The TTI VPCI system doesn't grow to 4. Add over 1 million to it. 1.7 million. So with that, you would expect, wow, that's probably, the NASDAQ has a lot of volatility, 24%. The volatility went down in the system down to 18. And the beta is down less than a half. Now, one other important thing to remember, if you guys have been investing a while, you remember the lost decade. And if you invested in the NASDAQ in 2000, you didn't break even until 2011. That's 11 years of losing money. With this system, the recovery time is only 2 years. It just took 2 years to get back into profitability. So what's next? How about I give you a market update here? This is my capital weighted dollar volume. This shows you how much money is actually moving in or out of the market. What I want you to garner from this right here is that unlike the market, which hasn't hit its, not only either its July highs, it hasn't hit its June's highs, capital weighted volume, or this is capital inflows, are greater now than at any point in time. They're at all-time highs. This is a bullish indicator. So next, I run a growth risk control exchange traded fund ETF strategy, which in December, excitingly, is going to become an ETF. So if you're interested in investing in ETF, and then you want to invest in an ETF that employs these concepts, that's going to be likely available to you mid-December. So if you want to invest in my ETF, you can email me at marketguru@gmail.com to get more information about this very unique opportunity. So presently, an area of concentration in my ETF portfolio is mega caps. So this is MGA, or the Vanguard Mid Cap, which recently signaled a buy and is showing very strongly here with a rising VPCI. Similarly, here's another one in the portfolio, XLG. This is Invesco Top 50. Again, look at this very strong VPCI. One of the reasons, probably one of the major reasons why we're invested in this one right here. Okay, here's our top holding. URA. URA is the uranium ETF. And you can see here by this green arrow, we got a good buy signal on this in August. And when I say this is right here, is the charts on your volume analysis toolkit. And this green arrow here is using the setups that you get with the volume analysis toolkit on Metastock. I also run a dividend growth portfolio consisting of stocks with growing dividends, high free cash flow, chosen and ranked by the volume factor. And this isolates those high quality stocks that the volume factor believes is poised for growth. Now, dividend stocks right now are out of favor, so I don't have a whole lot of charts to share with you here, but here's a decent one. Lamb Research, it continues to look attractive. And you can see here that it was in green for a while. And so in December, likewise, this dividend growth strategy that invests in stocks with high free cash flow and rising dividends ranked by the volume factor with the volume factor risk overlay. That's going to be available in an ETF mid-December. So again, marketguru@g.com if you'd like to be information on getting in on the public offering of that. So this morning for you, I ran a fresh stock screen. Volume from Metastock's volume analysis toolbox. This is the Explorer function. And what I'd like to do next is go over some of the results that recently cleared the screens. Okay, this is HRTG, Heritage Insurance Holding. First thing I want to point out, when you're using my toolbox, the chart system, if you see the chart is red, that means that we're short. The system is calling for a short, okay? So if it's red, it's short. If it's black, it's neutral. If it's green, we're long. And then these green dots are our stop loss on shorts, and the red dots are our stop loss on longs. This is my anti-volume stop loss. Okay, this is a hard indicator to find. Not saying it's only available in Metastock, but it's one of the few places you can find it. It is probably one of my most sophisticated and I think important indicators. Okay. So if you see here that we originally got a signal on this stock back, it looks like at the end of May. You don't see another arrow today because it's already green, but we just re-signaled a buy this morning. Okay, next, this is Escalade, ticker ESCA. Again, another one that was bearish and just recently turned bullish. Very high, broke out on a very high volume this week. VPCI is looks like it's getting ready to turn. The TTI has already turned, and we got a stochastic pop here, a high crossover on on stochastics. Here's another one. Look, this one was bullish and now is in consolidated. I love these consolidation patterns. Just got its first green in a long time today. VPCI crossover. TTI looks like it's set up for crossover, and stochastic is also pointing in the right direction. By the way, I think I forgot to tell you about this. This right here is you can see the different colors in the volume. This is all according to volume spread analysis. So if you follow volume spread analysis, this is the key color code. All right, here's another one. CBOE. CBOE has been, it's been really good for us. So you can go back to 2019, and it's mostly green. And we got another green one in August, and another pop again this morning. Fair Isaacs, FICO is the ticker symbol. This one again, this one signaled about a year ago, and then we got another thrust just this morning. Look, the BPCI is about ready to cross over again, and TTI is flat, but we're getting some momentum with the stochastic. All right, Reinsurance Group, again, another attractive one. This one here, just got the VPCI crossover. It looks like it's lining up right with the zero line. Oops, we get back here. TTI's crossed over, stochastics crossover. So we got lots of things happening with this one. Reinsurance Group, RGA. Okay, Qualis, that signaled here in early October. I got another signal today. Very high VPCI. We got that TTI crossover some time ago, and also a very high reading on TTI. Those are all strong indications. Another one that was in a bear market, it was red for a long time. Now it's turned green. In June, Uber, UBER, turned green, and we got another confirmation signal here just this morning. Okay, save the best for last. IT, Gartner. I love big, fat, wide bases. Okay, and IT has just broken out of a long channel here, and with very positive volume characteristics. VPCI crossing that zero line, same time simultaneously crossing VPCI smooth. Also with a positive stochastic, and that TTI looks like it's just about ready to turn the corner here. So that was IT, was the ticker symbol there. Now, this is the toolbox. These are all the indicators that you get when you subscribe to the Metastock Toolkit. And you also get these setups. That's what we just went over, the VPCI, TTI setups. Okay, exclusive offer. Okay, so first of all, one Jeff's gonna go over. You get the Metastock add-on with all these indicators, so you can do this analysis yourself. Another thing you could do, if you want to get my weekly commentary, just email me, marketguru@gmail.com, subject market commentary. I'll add you to my weekly market commentary. This is the exciting piece for your serious money. These strategies right here, these are the proposed symbols. We're going to know this anytime now, but volume factor, global unconstrained, volume factor dividend tree. If you want more information on that, you can email me the subject VF volume factor ETFs. Then if you want to read more, my book, Investing with Volume Analysis, is available many places, including Amazon. It's on sale right now. I think it's $10 off. And it was the 2012 or 2011 Technical Analysis Book of the Year. And in early 2024, we're going to have my next book, which is the volume factor. And it's going to go a lot more in depth. Investing with volume analysis is really good if you're really savvy and you're a market analyst or portfolio manager. But if you're an investment advisor or a savvy investor, this takes these indicators and shows them. The volume factor book explains how do you put these into strategies that produce successful outcomes. And that's the volume factor book. And you can get on the pre-order list. This is the indication of interest. Is the volume is book.volumefactor.com/pre-order. You can sign up for an indication of interest of the volume factor book. And you would also get with that my white paper, volume factor white paper, which award-winning research in that. And we'd all automatically also subscribe you to Volume Analysis Weekly newsletter. And I'd probably try to, I'll just stop it there. But let me with that turn it back over to Jeff, and we'll see if he has any questions or if there's any questions in the group that we can answer.
Sure. We did have a question. Good job too, Buff. Also, the Charles Dow Award and the different awards you got are amazing. Klaus wants to know, with volume and Forex, would these studies be applicable with Forex and the volume that's reported?
Yes. So if it's as long as the data is reliable, it doesn't matter what. This is all economics. It's all supply demand. If the data is good, it should work fine. The issue maybe with is that with markets that are open all the time, how do you slice and dice the time frames? That's an important variable. Here we're looking at equities, and equities have a defined opening and a defined ending. So we can really, it's really advantageous to take a period of time. Forex is not so clear, but in principle, yeah, all this, and I've heard really strong comments of people using this analysis in Forex.
He also, can you measure the volume? Can you measure the angle of the moving average on volume as a way to kind of analyze volume? What's another question that came in?
Well, yeah, you can take a chart and draw the trends in volume, just like you can draw the trends in stocks. And like one of the setups would, if you're looking at various triangle formations, ascending triangles, descending triangles, those sort of things, the volume is absolutely imperative, because what you want to see there is as you get closer to the apex, you see the volume tightening up. But really the important piece, and what all other volume indicators miss, and what we're really adding with these indicators here, is the asymmetry. How does price relate to the volume, and vice versa? And that's really the key piece of data that really drives these results. Okay, and that's what these indicators. You use an indicator because it's giving you a clear picture of some data that you're trying to manipulate, and that's the piece of data that we're manipulating with the VPCI and some of the other indicators.
All right, very good. Thank you very much, Buff. I appreciate you coming in, spending some time with us. It's great to have you. I appreciate you.
And you likewise. Good luck with the show.
Very good. Thank you very much, Buff. I also do want to just show you how to get kind of these award-winning methodologies into Metastock, because one of the questions is like, okay, is there a good way for me to kind of understand how things, like what's a good way for me to kind of really get a good handle on how things work and that kind of stuff. And one of the things that Buff did a really good job with was actually helping us design an expert commentary. So we've talked a lot about scanning and the set scanning, and Buff even showed them. And we talked a lot about kind of getting the alerts on the thing and that kind of stuff. But I just want to kind of show you how this, one of the things I love about Metastock is how it can help you understand things well and kind of really kind of understand what's going on in a different chart and with different momentum. So that's one of the examples that Buff gave, the CBOE, which is a stock I've actually been following a lot this year. And he was talking a little bit about kind of the signal. Now, this is a different periodicity. It's also, this is his volume momentum system, not the trend surge. But I want to show you this just in terms of kind of like how this can kind of help you understand. So this gave us signal back in July 14th. You can see kind of what the result of that has been. I'm going to move my camera over here. Klaus says, thank you. Thank you. Thanks for the great question, Klaus. So if I'm looking at this on the day and I run a scan and I just kind of want to remind myself of the indicators involved and what's going on, here it's going to tell me this system is going to do 4 things. It's designed to identify market trends, confirm price trend developments, sniff out demand, follow the trend until it shows a sign of weakness. It goes on to talk about it uses the VPCI, the AVSL. It kind of goes into, as you can see, a lot of detail about those indicators. Certainly I'm doing a relatively poor job of reading it anyway, so I'm not going to try and read it all. But this is something that not only can Metastock help you find the trades, it can kind of help break down the indicators for you and tell you what's going on a daily basis and why you're getting a signal. And in a lot of cases, what to do with it as well. And it really does spell that out. So to wrap up, I know we're running just a little bit over in time, and that's not uncommon. But Buff Dormeier's Dow award-winning toolkit includes 2 expert systems, 2 explorations, the system test forum, 2 different templates, and actually 24 custom indicators. And he showed a complete list of that. Here it is again. With the systems, you do have the ability to scan for ideas like he showed. You do get the expert advisors. You have the ability to test for them, all that kind of stuff. And so very, very easily, you can win these award-winning methodologies to your Metastock. It's available on a subscription. It's $149 per month is all. And what we can do is if you buy a month, we can give you the 2nd and the 3rd month for free. And with that subscription, there's no ongoing commitment to keep subscribing to it. So you can try it out, see how you like it, play with the different methodologies. And if it's not something that fits for you, you can just cancel. So to do that, give us a call, 800-882-3040, metastock.com/saleschat or metastock.com/conf. promo. Thank you, Klaus, again for the questions. If you have questions as we go, make sure to type them in, and I will be happy to talk about them. So we did talk about the CMT Association. Buff is a chartered CMT. I'm actually going to talk a little bit about TASC because I just talked about CMT before, and I'm going to talk to him about him again in a minute. But I do want to say thank you to Stocks and Commodities magazine too, for sponsoring the events. They've been such a great sponsor of Metastock over the years. We've been doing these trader summits and these conferences for over 10 years. And for every step of the way, they've helped us with it, and we really appreciate it. So traders.com is where you can find out about Stocks and Commodities magazine. And but they've done 17,000 articles. They've got 1.3 million subscribers. They've been publishing actively since 1982. So there you go. And of course, we're Metastock. It is prize time. You guys know what to do. This isn't the first time we've done a prize. The number that we're looking for is anything between 1 and 11,957. What you're going to do is you're going to type in a number. I'm going to pick one of them, and I'm going to give away 2 prizes right now. This is a good prize. What's the prize? Well, hurry up and start typing numbers, and I'll tell you what the prize is while you type in some numbers for me. Again, What I'm looking for you guys to do is type in a number between 1 and 11,957. Okay, very cool. The prize that we're giving away with this one is McMillan's Advisory Bundle. So at the very start of the week, we had Larry McMillan come in. He gave us a big, Larry's awesome, wrote what a lot of people considered, I can't remember the name of his book because we've been doing this for like 34 hours. But the book that he wrote is considered like one of the Bibles around trading. And if you know what it is, type it in the comments and I'll reference it. But this is his advisory bundle. We're going to give away 2 copies of it right now, which will make it prize number 53 and 54 if you're keeping track. But this includes 1 month of the Daily Strategist newsletter. The Daily Strategist provides timely insight to the stock derivatives markets along with trading recommendations. You'll get 1 month of daily volume alerts, 1 month of the Option Strategist newsletter. So, Larry, thank you for those prizes. Thank you for all the numbers. I'm going to go with Neil's number, 4730. Thanks for the number, Neil. And let me figure out who that actually corresponds to. Okay. Now, we usually don't give out full names on the Metastock channel, but since this guy's name is Trader Gardner, I think we'll be okay. So Trader Gardner is the winner for that, and I've got that located here. The next one that we'll do is Ron in YouTube. It says 9089, so we'll do that one too. Let me just kind of put this in a place where I'll have it in a second. Sorry, I'm getting better at this though. Right, it's not pasting. Paste. Okay, got it. Okay, cool. And then the second number that we're going to go for, and then we will turn it over, is Ron. Thanks for the number 9089. Okay. And that would be Vanessa M. Okay, Vanessa M. Thank you for registering. You won a prize. So Larry, what's going to happen is I'll send the information for that prize over to Larry's team, and they will send you an email early next week. Very quickly, the offer we're doing for Metastock, buy one, get 2 free. I've told you all about it. We've been showing scanning and experts and all that kind of good stuff all week long. 800-882-3040, metastock.com/sales-chat, and metastock.com/conf promo. Our next presenter is Rick Sadler. Rick is somebody that I consider a good friend, has some really good strategies and setups that are built around candlesticks. He runs a company called Hit and Run Candlesticks, and we're going to go ahead and bring him on here. Rick, I'm glad you joined us today, man. Oh, that's a lot of numbers. Thanks for all the numbers, guys. All right. I'm going to go ahead and send an unmute request to you because I'm not hearing you just yet.
There we go.
All
Hey,
right.
Jeff. Hey, Jeff.
I can hear you.
All right.
Let's make you the presenter. Now it should pop up and just say, hey, do you want to share your screen?
All
And
right.
that's all you
Let's
gotta
do
do.
that. There we go. All right.
Okay.
Webcam.
can
Can I
see
share a
that.
webcam too?
You sure can.
Can I
You
do
know
that?
how?
Well, I'm trying.
Let's see.
There we go. Webcam.
Oh, I can actually even
Hey.
send a request to you.
There we
you
go.
are.
Hey,
Where you
doing?
located at now, Ray? Where are you located?
Springfield, Missouri.
Oh, perfect.
Springfield, Missouri.
Yeah, well, I'm going to go ahead and get out of the way. I know we're starting a little bit late. It's the last day. Don't worry
No
about
worries.
time.
It's all good. It's all good.
All right.
Thank you.
It's all for you, man. It's your
All
turn.
right.
Go.
Thank you very much. Let's see. I'm gonna pull this off. If the sound just went bad, Jeff, holler at me or something. Do something. Sound should still be good. I'm hoping.
It's
Okay,
I'd give it a good solid 7.
hello,
It'll work.
Rick Sadler here with Hitting on Candlesticks. How are you doing? Hey, the first thing I want to do is I want to reach out and say thank you to Jeff and Metastock. He's given me, you have no idea how much help he's given me in the last 2 days. And I feel like I've I might have worn out my welcome, but thank you again, Jeff. I appreciate it. Hey, thank you everybody for being here. I appreciate that too on a Saturday. I love questions, so don't feel bad about asking questions at all. And let's kind of get right into it here. Take me a second to make sure I remember how to do all this stuff with PowerPoint. So let's do this real quick. I want to just one little paragraph down here, just remind everybody that all information presented today is intended for educational purposes to aid traders in developing a baseline knowledge to build their own individual trading process, okay? If you want to read more of that, you certainly can. Bottom line, trading is risky, and it is not for everybody. It is highly recommended by just about every educator that I know that you go through an extensive educational process. Trading is not, it's not as simple as, you know, somebody says, hey, buy this, you buy it, you make money. It doesn't quite work that way. So please develop that educational process or get into that. So what I'm going to talk about today is some things that we like to trade, some setups. Now, I'm going to focus on PBO cross, T-line bounce, the 3/8 trap, rounded bottom breakout, the pinball setup. These are the setups that we use in trading every day for both bullish and bearish. But like I say, I'm only going to focus on just a few of them today due to time and what is in the Metastock library, okay? Let's see here. Please forgive me, every now and then I'm going to have to take a little drink of water to clear things. So I apologize if you understand there. I'm going to talk about what I just showed you was our flagship strategies and something that we do. And bear with me again, I've got about 8 boring slides and then we'll look at charts. Now, you may find these slides very useful. I think they're very useful. Some people think they're very boring and just simply want to look at charts. That might be the first mistake. If you're having difficulties trading, that might be a mistake right there, because trading is more than what's on the chart. It's actually what's between your ears, and you've got to have a good understanding of that, okay? So we focus on the trend with highly proven patterns, and we focus on the market being in our favor. An example might be something like this. If I'm going to trade long, I want the market. By the way, the market, if you ever hear me refer to the word the market, it is the SPY, SPY is what I'm referring to. If I'm referring to the Qs, FNGU is something we follow a lot. But if you just hear me refer to the market, it is the SPY. So if I'm trading long, I want the SPY to be trading bullishly as well. What I don't want is the SPY to be trending down and then I'm trying to trade bullishly. I'm not saying that we don't do that from time to time, but I will tell you that those aren't the best trades, okay? They really aren't. I personally focus on something that we call the RTW trend system, and what that is, RTW stands for is Road to Wealth over here, okay? And profitable patterns right here. What is proven results? Proven results is your trading account. It's that simple. Your trading account or anybody's trading account. If you use your trading account, down here, this is your baseline. If your trading account continually grows, now, all trading accounts are going to have little drawbacks every now and then and pullbacks. But overall, if your account grows, then you're doing the right thing. If somebody you're talking to, such as talking to me here, if my account is growing, then I'm doing the right thing, and maybe what I'm talking about actually does kind of work. So that's that's bottom line. There's tons and tons and tons and tons of systems out there. I honestly, I think they're all good. I've learned a lot over my 35 years of trading and pretty much pulled out what makes sense to me. And just because one thing makes sense to me or something makes sense to somebody else, wherever, it doesn't mean that it makes sense to you, and it has to make sense. Okay, so the bottom line is your account, and you should probably watch their account. What we do is we strive for doubling our trading count every 12 months. More times than not, we make that happen. More times than not, after that, we come awfully darn close. So that's a good goal to have, I think. The road to wealth trend, there are two trends that we look at. The first one is the 3 EMA is greater than the 8 EMA, or what we call the T line, and the 8 EMA greater than the 17. That's the faster trend. The slower trend will be the 34 greater than the 50 period moving average. When those are hooked up in the right direction, I'm looking bullish. When they're hooked up in the right direction going down, then we're looking at the short side. Okay. I want to talk a little bit about the T line a little bit here, and this is one of our flagship indicators, flagship strategy as well. The T line is the 8 exponential moving average. That's all it is. There's nothing fancy about it. Just about every charting package out there has it. In fact, I can't imagine a charting package not having it. And it's probably the single best discovery in my entire trading career. Simple is best. I found the T line after losing a big bucket, make that one red, a big bucket of money, and yet still had the determination to succeed. When it comes to, we use we use moving averages, and we use chart patterns and the candlesticks. And in any one of those, not a single one of those is magic, okay? Not a single one. The magic in trading is your consistency of how you use those tools. That's the magic. Just like with the Metastock system, the magic is your consistency with using those tools. And that is probably one of the most powerful things that if I could stress, I could. I mean, I wish I could just stress that so much that, lots of light bulbs just go off, okay? The T line helps to determine the trend, stop, and entry. Now, this is pretty cool because I'm going to be talking about this today in one of our flagship strategies called the 3A trap. That is probably has been we've tweaked it, we've dialed it in, where it is probably one of the best entries in a swing trade that you can imagine. It's easy to spot. It's very visual. It's very clear. It's third grader proof is what I like to call things, and a third grader can look and see it. So that's simple trading, and that's what I like to see. Okay. The popularity of the T-line is now used by traders worldwide, and that's exciting. I've heard a lot of people say, well, if people worldwide use it, what makes it so unique? What trading is not the uniqueness of an indicator. Trading, again, is what's between your ears. So that's the uniqueness of trading, and that's where success is made, right there. The 3D trap. The 3D trap is a entry mechanism, and that entry mechanism is, now here, let me do this with that blue. So what we like to see is a trend. So you've got a bullish trend in a chart. Here, we'll paint this one, that's blue. We'll paint this one green, huh? So you've got a bullish trend that rallies up, and then what happens is that trend or that stock, that candle price action pulls back a little bit. This line right here, by the way, this right here, this is going to be the T line. That's the 8 exponential moving average. And then what happens as price moves down, what I like to personally see, but it's not, everyone, when you get this close into pushing the button, everybody's a little bit different. I like to wait for a bullish candle. Not everybody does. Some people like to buy, down low. You try to get in as cheap as possible. Nothing wrong with that, as long as it works for you. So what we do is like to do this. Now, what we've got here is the 3 EMA. The 3 EMA. And we're going to put this way. So what happens, the 3 will follow price, and the 3 will come down with price like this. Okay. Now this is the 3-8 trap right there. The 3-8 trap is when price is trapped or pinched between the 3 EMA, the black line on this picture, and the blue line, which is the T line on this picture. When we're trapped right in there, that's what we're looking for an entry. Now, again, this is really, like I say, I don't mean to diminish it at all to anybody, but this is very visual, it's very clear, it's very simple. Third grade proof is what it is. Where is price? Is it below the black line and above this blue line here? That's what we're looking for. Did we in fact have a rally? Yes or no? Do we in fact have a bullish trend that we're working with in the particular trade that you're looking to trade? Yes or no? Simple yes and no questions. Really, really easy. So with all that said, this may be a buy right here. And by the way, I also will buy if it breaks out of that 3 EMA. Just a little side note, I use the 3 EMA high personally as my top trap line. I do that because I want to cast a little bit of a larger net. If you use just the 3 EMA, you don't cast quite as large of a net, and that there's nothing wrong with that. Okay. So what we're looking for is that entry in here, and then what we're looking for is profit as that chart rallies up to the next target zone. Okay. So that in a nutshell, I've just described the 3-8 trap right here. Like I described here, the idea is to wait for the pullback, wait for that pullback. The candle falls below the 3 EMA high, sets up a bullish activity, and then we start running up, and then this is what we want to profit on. Okay, let's go try to find another chart. There we go. The rounded bottom breakout. This is another chart strategy that we're going to look at charts with today and talk about. As far as charts go over my career, I have probably made more money with this strategy than anything. Now, it is not the oldest strategy that I've used. It's not the oldest, but I've probably made more money off this strategy. And by the way, this strategy, we're going to also talk about the pinball strategy. The 3-8 trap entry mechanism is used on all of those. Okay, so rounded bottom breakout. This is where the 50-period moving average has been trending down below the 200-period moving average. Basically, what I'm looking for is something that is insanely oversold. I want it really beat down. Well, then what we're looking for is price to move back up over the 50-period moving average. In a perfect world, I want the, let's see, I think I've got it right here. I get ahead of myself here sometimes, apologize. For the rounded bottom breakout, here we go. I described momentum. Let's see, momentum here, right there. That momentum, didn't do that very well, did I? There we go, something like that. I want And I not only want price to be moving over the 50-period moving average, but I also want some momentum. I define momentum as moving averages coming with it. So I like to see the T-line, of course, that's the 8 exponential moving average. I like to see back when we were first, when the rounded bottom breakout was first developed, we did use the 20 simple moving average as crossing over. Nowadays, I tend to adjust that a little bit and I focus more on the 17 EMA. Either one would be fine. I don't believe one is any better than the other. Again, it's the consistency of your trading rather than just rubber stamping. I'm going to use this, this, and this, and this, and then always shifting them or adjusting them. It's a consistency that makes things like this magic. Oops. Okay, let's look at some charts here. I want to make sure I didn't miss something. Okay, so let's take a look at Nike here. Nike is an RBB. This is a rounded bottom breakout. Now, what a rounded bottom breakout again is we want a downtrend with a 50-period moving average. All right, let me make that a little bigger. There we go. We want that downtrend to be running down like that. We want the 50 and price to be below the 200-period moving average up here, because this is actually it is the highest possible target. Now, I'm not saying that Nike here can't come up here. It can, but the rounded bottom breakout stops being the rounded bottom breakout once we get past that 200-period moving average. This is the max target that we're looking at. So you can see how that we're very beat down here, and we're not trying to catch price down here at all. In fact, I'm very much against bottom picking. Bottom picking just does not, I don't feel that it works out for the majority of traders in the long run. I do a fair amount of coaching and private coaching, and that's one of the things I see when traders, they're trying to catch the bottoms and they consistently lose money. But the idea of getting the stock at the best price, that's just an idea that we just can't get out of our head. We like it, but the reality is it's not real on a consistent basis. It's just not, and you'll just end up blowing your account up. So what we want is we want that price to move up like this. And then what we're going to do is start looking for those entries in areas like this. Now, you can see right here, as we moved up, the 3 moved up, the T-line moved up, this would be the 20 simple down here. Notice it didn't move up here. It didn't move up till we got into this area. Now, this can certainly be traded. I might trade that. In a good market, I might not wait for this the 20 to move up here. I might be more, hey, the T-line is moving up, so I might look at that as a trade. But the rounded bottom breakout is about that momentum and pulling those moving averages up with you, because if price can pull those moving averages up over the 50-period moving average in this strategy, what happens, or what the suggestion is, that there are plenty buyers that's doing it, because the only way for price to move up is more buyers than sellers. It's really simple. It's just, there's no trickery to it. It's extremely simple to think about it. What makes price go up? Buyers. What makes price go down? Sellers. So when price is moving up and you've got momentum with you, so 5, 6, 7, 8, 9, 10 days, 15 days, 20 days, 30 days, that's some serious momentum moving up. So as we start moving up, see how this starts to pull back? Because price always needs to come back and do some testing. This is just one of the rules in trading. So we come back and test, and all of a sudden, now we start getting those moving averages, because even in this pullback here, now this is something that really makes, you know, people question sometimes when I say something. In my mind, this pullback here, that's still very bullish, very, very bullish. And it's bullish because that trend is still bullish. And, you know, we can do this and you say, well, we broke that trend. Now, wait a minute now. I'm not looking at that trend. What I'm looking at is the moving average trend. I'm not looking at the trend that price is. Price can be on drugs sometimes. You know, price can be all over the place. It's like a little bee floating around sometimes. It goes crazy. So smooth it out is what we want to do. And what we've got going on here is, as it comes back, you know, I got to tell you, I'm spending way too much time on this chart. I'm not going to get done today. As it comes back, now look what we've got going on here. Look at that rally up and that little rest right in here. This is a 3/8 trap. That's your 3/8 trap entry right there. And look at us rallying right to target up here. By the way, I believe I can double check this. Yes, these are brand new charts. These aren't necessary. The charts I'm going to be looking at are live, you know, from Friday. They're not, you know, 2000, whenever. These are real charts right now. So anyway, you might find something here interesting. So here we are, 3/8 trap. That would have been a great entry in this area, and that would have been a good profit target. You can see us pulling back again. And as long as there's still money to be made in here, this is still a rounded bottom breakout. So, you know, for Nike, I'll watch for this to pull back, watch for the price action to set up again in that 3/8 trap, and that just might be a trade right there. Again, a rounded bottom breakout stops being a rounded bottom breakout if we move over the 200 period moving average, which is that red line. The trade is all about between the 50 and the 200. It is nothing more than a relief rally trade. This chart is in a downtrend, and we're looking for that relief rally here. Now, there's a lot of money that can be made in the relief rally because you're bringing in a couple of things that you might not be thinking about. One, if the market is bullish, if the market is trending and the market is working, then what happens is you see a stock like this, especially quality stocks, and I think Nike's a quality stock. You'll get buyers that buy it because it's cheap. So not only are you getting buyers, momentum buyers in there, or trader or setup buyers, but you're also going to get those buyers that, hey, this is cheap, they're going to buy it. So what happens is you're getting the best of everything working in your favor on Nike. Right. Sorry, that did take a little too long there, and I apologize. I'll try to speed this up. Here's a pin, and pin, this is another one that is looking pretty good here. Look at that bullish engulf right in here. Now, this little blue line right there, this is the 3 EMA, but it is just a standard 3 EMA. I use, like I mentioned before, I use the high, and the high is actually up here right now. So price is actually still trapped between there, but that's okay, because one of the things I look for is if I'm using the 3 standard and we have that 3/8 trap right here, get my pen out again. There we go. So that would be a 3/8 trap right in there. And if you miss that, not to worry, because if we break out of the 3, I love that. That's showing momentum. Remember, our job, well, I shouldn't say my job. My job is not to buy at the cheapest price. My job is to buy a chart pattern that has high probability of making me money as it moves up. I want to double my account. So I want charts that move up. So what I'm going to look for is the power. So when I see something like this, that looks powerful to me. We're going to look at a couple other things in this chart as well. But that looks powerful. That looks like it just might rally on up. And as it rallies up, that's where I'm going to look to take profits. Like I say, to double that my account. And by the way, the doubling, it doesn't mean that you have to make your goal on each and every trade. It's a cumulative number is what that is. Okay, so I'm looking at this chart right here. Oops, here we go. Looking at this chart, and I see a nice little tweezer bottom here on the candlesticks. I see this nice little bull kicker gap right in here. So this is really adding, say, to my liking of this chart. And these are the kind of, well, not so much, you know, I'm getting into candlesticks. I probably should stay away from that a little bit. You know, what's going to happen with the Metastock system, it's going to give you that alert that this is a 3/8 trap, that we are in a rounded bottom breakout scenario. And then, of course, you as a trader, you're going to decide, well, is that chart the kind of chart you want that you're going to trade? And, you know, some traders may not like this chart for whatever reason. I totally respect that. Yeah, absolutely. But I hope that whoops, sorry, that's my mouse. I hope that makes sense. Again, if there's any questions or anything, I can get them at the end of the show here or anytime. I might not be able to hear unless Jeff throws something at me. So I hope that makes sense on pen for that rounded bottom breakout. We've moved up over the 50-period moving average, and it looks like we're headed toward the 200-period moving average for a nice little profit here. Now, here's another one. Here's VSCO. This is another one setting up. Now, as I'm looking at chart patterns, one of the things that I want to look for in chart patterns, you know, there's J-hooks, flags, consolidation areas, things like that. Those are the kind of things that we absolutely love. And right here, we've got a nice little, I'm going to put that box right there, and there's a reason for that. I'll share that in a moment. So we've got a nice little consolidation area right through here. And you can see how we made this low, this higher low, and then rallied up. Well, this started the rounded bottom breakout. There's the T-line crossing up over the 50. Here's that 20 crossing up over the 50. Again, there's nothing wrong with taking this first move. I've just found that more times than not, the first plunge through that area, you get this shaky, rocky maneuver in there, like this right here, where if you allow the slower moving average to cross over, like we've got going on right here, I find that it gives a little better trade. Now, there are those times where this takes off and it never looks back, and you know it just goes, and you've missed the trade. It is what it is. You can't get them all, and that does happen sometimes. But more times than not, until we get a bigger moving average crossing over, you tend to get this area right through here like this. And this is just chop. Bottom line, majority of traders are going to lose money in this. There'll be some make money, but the majority of people will lose money here. So I do this box area right through here, and I purposely drew it right through here. And the reason I did that was, we'll make this color, is, yeah, let's do it this way. If you look at that, we've got a nice little shoulder, and there's a nice little head, and there's a nice little shoulder right in there. This is an inverted head and shoulder. This is one of those chart patterns that we like, look for, we love. When we see that setting up, especially when we see this consolidation box like this, I pay a lot of attention to this. And what I'm going to do is, for entry wise, certainly may put an entry in here, but absolutely, when we start breaking out, because what happens, what does it mean when we break out? It means there's more buyers and sellers. it means if we break out what it's suggesting, I guess, I probably shouldn't say what it means. It's suggesting that the buyers feel that this stock is worth more money than it is right now. And I don't feel there's any real prediction on what it's worth. We are price action traders, we're trend traders, we're chart traders. So what we're going to do is we're going to follow price till we get into our neighborhood of making money on where we're going to profit at. We don't pick the very bottom and we don't pick the very top. We take the center out. And again, we're looking at that whole doubling side and different side accounts, different sizes accounts. Your double number will be different. Somebody with a $5,000 account, your number is going to be a lot different than somebody with, say, a $100,000 account. Okay. Here is a nice 3/8 trap. This is absolutely gorgeous here. HPQ here. This is absolutely gorgeous. Look how we've got this nice little rally up. Now here we don't have, the bigger moving average, the 20 moving up. But that is just absolutely beautiful. That 3/8 trap breakout is what we have right in here. And you can see this, how we've got, again, I'm kind of, deviating a little bit from what our package is with Metastock. But I think it's important for us to look at the overall chart pattern, because what's going to happen here is you'll have the alerts coming in that, one, it's a 3/8 trap, and two, it's a rounded bottom breakout as well coming in here. So anyway, that's just a great looking chart. I still don't even know what even to say about that. It's just very pretty. Let's see here. Okay. This is a pinball setup. This is, I just realized I might not have as many on here of these as I would have liked. The pinball setup is this is the very first strategy that I ever created where I made money on. And years ago, I'm like, I'll raise my hand. I'm one of those guys that blew his account up, not once, but twice. It was very early on in my trading. And the pinball setup was what I developed. And that's where the T-line was developed. And that's where everything turned around for me on this strategy. The rounded bottom breakout is, for the most part, exactly the pinball setup. It's just shifted up into the charts instead of down, way down low, oversold. It's that's the pinball setup, way down oversold, looking for moving up. Originally it was to the 34 EMA is what it was, and we were spreading moving averages out rather than use an oversold indicator. Just simply spreading the moving averages out will do the same thing, and I tend to like that better than using an indicator. Well, anyway, after figuring this out, this is the strategy that I finally convinced my wife to let me trade for a living, or at least try. And I finally convinced her this was a strategy right here. So this one's near and dear to my heart, very first one. And all it is you're moving from one moving average to another moving average. I use moving averages an awful lot. I like price action that launches off or bounces off of moving averages, both bullish and bearish. By the way, all these have setups on the bearish side as well. We're just looking at the bullish side here. So for moving averages, I like to go from jump to one to another, to another, to another. Moving averages, they tend to be places where price will stall or stop or rest, just like a trend line, just like support and resistance. Price will do the same thing in moving averages. And since I am a typical guy, I'm lazy. So rather than draw a bunch of lines on charts, I tend to use moving averages. And that's a very true story. So that's why one of the reasons I use moving averages. But the pinball setup is where you're taking stocks off the bottom, but you're waiting for it to move over the T line. And that's that orange line right here. That's what we want. We want to be over that orange line, and then use a fast moving average like a 2 or a 3 exponential, and then that crosses up over the T line. That starts your momentum. I suspect everybody here has heard of what the golden cross or the death cross. Moving average crossover is a thing. It really is. And it can be a strategy that is out of this world. Now, it doesn't just start and stop with, oh, you have a moving average crossover. There's more to it than that. Our PBO system, our moving average crossover PBO, pullback opportunity, would be that. And it's where we cross. Do this here. It's where you have a moving average crossover and then you pull back. So a PBO pullback opportunity is what we're looking for. So here, see how we moving average crossover, and see how we have that PBO here, pullback opportunity. These trades down here, we're not really looking for them to move sky high. We're looking for them just to move up a little bit here. And this black line represents the 34 EMA. And this is, for years, this is all I ever traded, because it's what got me to trading full time. And it was so successful. And just looking for those swing trades. Now, back then, I only traded pretty cheap stocks, $1, $5, $10, $12, $15. Well, you find one of these pinball setups, these things can move 10, 20, 30%. They can be spread out that much. And if they start to get the buyers starting to climb aboard, and that thing just rips. And that's when I only traded stock, no options. And you can make a ton of money. It's like trading an option almost on this. So the pinball setup, very, very nice chart pattern, especially if you like the idea of stocks that's down a lot. If you are typically somebody that looks for stocks really, really oversold or off the bottom, this is just slightly off the bottom. Just, you have to train yourself slightly off the bottom, not try to pick here or, pick that bullish candle. Just look at that moving average crossover. Watch that 3-8 trap. I got to tell you, that is the 3-8 trap. That entry is pretty cool. It really, really is simplistic, easy, real easy. Okay. Here's CCJ. This is a 3-8 trap here, but really what I want to look at over here is right in here. And this, I think, is a great picture of that 3-8 trap setup. This is one right here, and that would be a bullish candle 3-8 trap. When I'm looking for I'm not saying that candle is necessarily bullish. What I'm saying is when I look to buy in a 3-8 trap, I prefer an open body candle, so where the open is lower than the current price. So I want to, in my charts, I use white and black. So I want a white candle in here. So this candle here, I probably wouldn't be buying. I would, however, buy this, and I certainly would buy this right in here. So you can see how it pops to the upside. See how we pulled back at one point during the day? That was a 3-8 trap right in here. Now, this whole move right in here, we have something called pop out of the box. This is close to that. We usually like another candle in there maybe, but that's awfully close. I would take it. Nice little pop up, a flag type thing. It's a tight box right in there. And then you can see how we rallied up. Look at that pullback. look at that 3/8 trap setup again. Do you see how simplistic that is? How easy that is? You know, up 3/8 trap, up 3/8 trap, just like that. And I mean, here we rally up, see the 3/8 trap. So we break out. What's going to happen is we'll look for that pullback, and we'll wait patiently for price to get in between the T line right here and that 3 EMA. So price move in here, then we'll watch for that buy signal. So what if it never does that? Well, then that trade's not going to be traded. Patience in our trading room, I think it was last week, I talked a lot about probably the greatest indicator that we all have, but we probably use it the least, and that is patience, our patience indicator. Everybody has it, but we don't always use it. So waiting for that chart to come to you, that's one of the tricks to trading. Don't chase, don't get caught in FOMO or anything like that. You know, allow that chart to come back to you. Let's see here. Whoops, I guess I gotta do it like this, don't I? There we go. Here's the SPY right now. And I believe this is the closing price Friday. Yeah, that's closing Friday. And you can see how that pulled back into that 3/8 trap area. Really, this is, I think, one of the most, it takes so much work out of trading. There's only a handful of things that I think are important. Trend, make sure that the market is trading in the direction that you're trading. Of course, make sure the chart that you're trading is trading in the direction you want to trade. For instance, you see how this moving averages are stacked up here. My road to wealth trend is bullish right here, the fast trend. The slow trend, maybe not so much at the moment, but the fast trend is. And it's the same thing with the bearish side. And the bearish side, by the way, you 3/8 trap in the bearish side as well. 3/8 trap in the bearish side as well here. So I don't want to run out of time. Try to catch up a little bit here. Take Apple. Look how Apple, oops, there's Apple. Look how Apple popped up and pulled back. There's your 3/8 trap right there. And look where Apple is now. Anyway, it's just one of those things. You know, you start to see that run. A lot of times, traders, they see a run like that, and then it's, oh, I've missed the trade. You know, I've missed the trade. No, you've not missed the trade, because if you go look at charts, I'm going to say all charts, and I do mean every single one, will pull back. Not every single chart will continue up, of course, and not every single chart will pull into that 3/8 trap area. So that's where we want to pull out things like, say, Metastock, to alert us when there's a chart that's in the 3/8 trap. That's why we want to pull out that patience indicator. Just wait patiently, wait for that alert, and now we can make that decision to pop into that. You know, one thing I haven't talked about is the stop. The beauty of the 3/8 trap is, ask yourself why you like the trade. The answer might be because we rallied and because we pulled back into the 3/8 trap. Okay, that'd be pretty fair. Let's call that the T line right there. Okay, so if you do get a bullish candle and you buy that, but all of a sudden things don't work out and the sellers come in, where would you not like it? If you close back below the T line. So it's like to me, it's a near perfect setup. You're alerted when to stop yourself out, or set your stop. You can put, you know, your manual stop in there, or hard stop, automatic stop. Because, you know, always ask yourself why you like the trade. when you answer that question, that will tell you where you won't like the trade. So if you like it because if it's a 3/8 trap, well, below the trap line, then you're not going to like it. So it keeps your risk very minimal. I hope that made some sense. You know, I'm going to put my headset back on just in case Jeff needs to get a hold of me. I know we're getting toward the end, so I can hear. Okay. Here is SHW setting up. Now this is a nice little bullish chart that has, we've got this nice little downtrend here, and you see that we've rallied up, and see how we're resting right now. Now, again, that blue line right there, that's the 3 EMA. I use the high, and the high is actually right here. So I throw a wider net. I want to catch bigger fish, or more fish, I guess. It's not necessary, but I just like to do that. So this is still a 3/8 trap for me. For somebody else, it might not, but it doesn't matter. It will still alert in the system, you know, a 3/8 trap in here. And now you can trade this. And if you you know, need that stop, one area to go to is always a close below the T line. Now, if that's too far down, of course, you can adjust that stop in there. Okay, let's see. I've only got a couple more slides here. Here's another pinball setup, and this happens an awful lot on the pinball because you are trading on the bottom, and bottom charts, they're down there for a reason, and they're not ready to go up until they're ready. Trying to rush that is just not going to get you anywhere. Burn up your account overall, I think. That's what I used to do until I figured this whole pinball thing out, the T line. But anyway, we start to rally up. You know, you think, hey, I'm going to get bullish, and it just comes back down. It starts to rally up. You're going to get bullish. You come back down. The whole pinball setup is about a bullish candle, and then what we do is we set the entry up to the right of that bullish candle. So this right in here is the entry, and then this right in here is this a little lower than that. There we go. Then that would be the stop area to keep that, you know, that risk nice and tight. We don't want that lost. I don't know if anyone's ever noticed this, but if you make money, well, you can call these little boxes dailies or weeks or months if you want, doesn't matter. I'm going to call them weeks. So if you make money 3, 4, maybe 5 weeks in a row, now you have some losses in there, but overall you've had 5 winning weeks. That's all great and fine and dandy, but 1 or 2 losses can wipe out 3 or 4 of those weeks. And this is what we don't want. Actually, I think making money in the market is relatively easy. The hard part is not losing it. That's the hard part for me. And I think it is for most people, the hard part. So keeping those losses small, that's why, you know, we want to keep some tight stops on there. I like to trade, I like to time trades. I'm not a buy and hold person. I'm a buy and profit person, typically overnight to maybe 15 days. My typical trade is maybe 3 or 4 days, 5 days at the most. But I mean, I've got trades on now I've had for a month. So what I want is to time the situation so that just, you know, when I buy it, it doesn't have to go right up. I mean, that would be nice, but that might be a little bit not possible. But what I don't want is to buy it and then have it just always turning down on me. I don't want to do that. So I'm more into the timing, the chart patterns, the price action, the right setup. And that's where that really helps with the timing area. But along with that, if you're wrong, you're wrong, and step away. Otherwise, this is going to happen. And that will just chew up 3-4 weeks of all your trading, and that's just no good. That just, you know, creates havoc right in here. Okay, so let's take a look at some Walmart. Here's Walmart moving up, nice low, high, higher low, higher high, higher low. See how we pulled back into that 3-8 trap area right there? 3-8 trap area right in here. You can go look at it over here too. See, all this right here might be interesting to buy. As a rule, I have found that overall, if we wait for that trend to establish a little bit, and notice the 3 is over the T line, so you've got a little bit of a trend going on. That's part of my road to wealth trend right there. So it starts moving up, and then we see this pullback. Well, you've got this nice trend, and there's your pullback. There's your entry. That would have been good money right there. This setup doesn't mean it's going to go up forever. It doesn't mean you're not going to get this kind of a pullback here. It doesn't mean that at all. It's like we're set up right now. We start to break out, that can move higher. It could go half a day Monday and then cave in and start coming down. There's nothing really that I know that's going to say Walmart's going to keep going up just because you got a bullish signal. The market is very fickle, especially if you're a short-term swing trader. The market can be pretty fickle. Take a look at, here's RCL, another, excuse me there. I put RBB here, but this is not an RBB, my bad. I apologize. This is just a nice little bounce off the 200 period moving average. And one of our chart patterns that we like right in here, we call that a Fig Newton chart pattern. Here we're up. It gave us a little buy. I would love to see a little pullback, a little bit more of a pullback. And we might get that with a little bit of resistance here. Get us into that 3-8 trap, and then that might turn out to be a trade. But the main thing here I want you to see is, you see that line right there? I'll just kind of straighten it out. And then this line right here, that's your 3-8 trap. So what we want is price to come back in there. I like a bullish candle, so I want to see that bullish candle. And then, you know, in this particular case, you can see where there might be support here, a stop, also the T line, a stop area. And then we'll look for that to climb higher into profits. Let's see. What is this? Oh, I'm at the end here, Jeff. Yeah, I'm at the end here. I really want to shout out and say thank you very much for inviting me. I want to thank everybody for listening. I hope you have found this useful. I hope you have found it very, very useful, and some good education there. I don't even have a super offer page on here. We do have a $7 trial. I didn't even put that up here. We do have a $7 30-day trial. If anyone is interested, you can check it out on the website.
Which is hitandruntrading.com.
Hitandruncandlesticks.com. Yes, sir.
Okay. I always forget the last part of it.
That's okay.
We'll type it in here. We have a couple quick questions I want to go through with you.
Absolutely.
And, let's see. Barb wants to know, does this work on any time frame?
Oh my gosh, yes. Thank you, Barb. Thank you very, very much. My bad for not mentioning that. Yes, on any time frame, because a moving average is on a time frame. So you can use it on a 1-minute time frame, you can use it on a 5-minute, you can use it on a monthly, you can use it daily. That's where I mostly use it. Actually, I mostly usually use it in this order: a daily, 180-minute chart, which we call a 3-bar chart, and a 60-minute chart. But absolutely, any one of these strategies, all my strategies can be used on any time frame, because you're using candlestick, price action, and moving averages.
I actually sent the thing to the wrong one. Okay, a couple more questions. Well, Chris says, this one, Leon says, how do I get in touch with Rick I want to talk to him about private coaching.
Oh, yeah. You can email me at rick@hitandruncandlesticks.com. If you go to our website, there's also at the top, there's also a contact us right now. And yeah, and right now there's a normally coaching. I don't know what it is. I think $350 for 2 hours, but it's on sale now, 200 something for 2 hours of coaching. Yes. And it's where we get on Skype together. I prefer Skype, but I can work with you there, where it's just privately, very private. Yeah.
Cool. Chris wanted to know, is the 3/8 trap close in effect after the candle closes above the 3 EMA, or does it end then?
I'm sorry. What was that last part?
Or has it exited after it? So is the 3/8 trap over after it exits above the 3 MA?
No, in fact, that's I actually almost prefer that a little more than inside, because what that does is it creates momentum. So if the candle you're looking at can close over the 3, that's momentum. But now keep in mind, I'm not the guy. Let me get my crayons out here. You've got the 3 up here, and then you've got, say, the T line right here. Then you have price in here. I am not the guy that's going to ever catch price down here. If you're looking for somebody to get the tiptoe bottom, that's not me. I'm the guy that's going to catch it, say, in this area. I believe in paying, this sounds kind of weird, paying a little higher, but taking it higher. So I don't mind paying a higher price. I hope that makes some sense. So I like it better when it's working.
Makes sense. I liked it earlier when you said it's easy to make money. The trick is not to lose it all. And I think that's where a lot of traders have a hard time.
I've been doing this for 35 years. I still stink at it.
Hey, Jeff, this is Norman. I got a question for Rick.
Sure.
Hey, Rick, listen, Rick, why do so many trading gurus play the guitar?
Yeah.
Why do they in the back?
Well, when there's nothing to do, we sit here and play. Yeah, Jeff's a guitar player.
Not a good one. I know like it.
I guess that's my point exactly. Well, I used to do a little singing. So
yeah, well, I can't sing. I couldn't carry a tune in a 10 bucket.
Maybe we can get a thing together. Great presentation, Rick.
Hey, thank you. In fact, I've got a 4-year-old granddaughter that if I sing, I'm serious. She loves me to play the guitar, but when I sing, she'll stop, boo boo.
All right, that's a Dorm. Yeah, because also we've seen a lot of instruments. That's actually pretty interesting. Rick, it was great to have you today. I appreciate you.
Thank you, Jeff, and thank you very much for all your help.
Everybody. We'll talk again soon.
All right, take care. Thank you.
Cool. All right, and then I do actually absolutely want to talk about Rick's add-on, the patterns for profit. We're running just a little bit late, and that's not uncommon, but I'm going to do our best to get us back on schedule. We do have the pattern identification with the 3x8, the pinball, the T. A lot of the patterns that he talks about you can scan for, you can get expert advisors for, you can get the signals. And I love the ability to actually do that and see that on a screen. So the Patterns for Profit by Rick Sadler is a great add-on. Includes the explorations, expert advisors, layouts, identifies 5 of those unique patterns. Normally this add-on is $7.99. It's a one-time cost, so you pay for it, you own it. It's yours forever. Here at the event, it's $647 as a summit special. And we want to do that now. As with everything else that we've talked about, 30-day money-back guarantee, you can try it out, see if it fits your style of trading or kind of the style of trading you want to do. And give us a call, 800-882-3040, metastock.com/saleschat. And you can also do that online at metastock.com/conf-promo. Okay. Go ahead and type that right there. Before we go to our next speaker, Norm, I'm going to say thank you to AAII.com. They've been helping traders since the 1970s. They've helped 3 million traders or so. AAII.com. And of course, us, metastock.com/conf promo. I'll talk a little bit more about that in just a minute. Our next presenter is Norm Hallett. You're here, right here. And I hear he's a pretty good singer too. He does, to me, I don't want you to read into this, Norm, but you look like somebody that would be a good singer to me. Just, you have that look about you. So in any case, though, we've had Norm on in the conference for a number of years. He's been trading for decades. He's got 4-minute drills on YouTube that have been viewed many times. And Norm, it's always good to have you. Let's go ahead and get you started. I know we're starting you about 15 minutes late. That's not uncommon for us, but let me go ahead and make you the presenter. We'll get you on your way.
Not a problem. Let me show my screen, and we'll. Are we showing my screen yet?
Yeah, I can see it.
Okay, let me expand, or let me at least do that.
Yeah, while you're doing it, I have to say, I've always really liked your logo.
My logo, yes, the Disciplined Trader logo.
Yeah.
It's I actually I've been using it for almost 20 years now. So I want people to see that. Yes, I saw a little delay in Rick, and there may be a little bit of delay, but you see this up here. This right here. This is what it looks like. Come on, this is organized right here. Just want you to know that. And these are some things that I picked up in other countries, which. But yeah, I appreciate being here. You know, you've had a real lineup. I can't believe you're not asleep yet with all of the. You got to be a little tired, right?
Powered by coffee.
That's it. All right, let me.
You. Yeah.
Get rid of that. Okay. All right. Shall I start?
Yeah, I'm out of your way. It's your turn. Go.
To Rick. I just want to say. Baby, baby, I'm aware of where you go each time you leave my door. Okay, just a little bit of action there for Rick and the guitar. I want to work on Stop in the Name of Love. You got to put those stops in. So we're gonna work on that. And of course, do you play the bass, Jeff, or no?
So no. I have a guitar and an 8-string, and I know 8 chords. Or no, I think it's actually a 6-string. But I know just a handful of chords. I'm not good at all.
That's okay. No, listen, you'll get there. We have plenty of time. We're going to 125. Thank you for being here, everybody. I want to talk about something that has fascinated me when I first saw it, and I just can't believe it exists. And most of the issue with traders is that they don't believe it exists, and it does. And that is something called prop trading, where you get to trade a prop firm's money. Let's not worry about what a prop firm is. They come from different sources, but it's generally pooled money that you get to trade and get 90% of the profit. In fact, they're paying me and anybody else the first $25,000 you earn, you get all of it. And of course, that sounds crazy. Why would anybody, any firm, individual firm, or anybody that plans to stay in business, why would they give you the lion's share, in fact, all of it at some point in the beginning of the profit, and call themselves smart business people? And I'm going to show you why you shouldn't worry about that, and they're making plenty, and why you should consider prop trading, because I've been really getting into it. I have been approved for 6 prop trading accounts, anywhere from 50 to 150,000 each. And I want to show you what I've done and what I'd like you to do if it makes sense to you. And I think it's going to make a lot of sense. I think it's the fear of believing that these firms may not be around, and or the whole idea is kind of crazy. But I'm going to put it into perspective for you. So thank you for having me. And I know that, Jeff, that you've always said to me, you always save the best for next to the last. That you're a little different than that. So I'm hoping to give you some of your best here, at least some of my best. All right. let us move through what I'll be covering. I'm covering today the pros and cons of prop trading. I'll also be showing you how prop firms can give 90% of the profit to traders. There are two secrets that I've learned, and I heard Jeff. I was very impressed that Jeff mentioned the importance of the mental and emotional game as being the part. As in any trading, if you're not a disciplined trader, it's not going to work for you. You're not going to, and the prop firms are counting on you being that undisciplined trader, because that's where they're going to get their money, from the fees that they charge, the reasonable small fees. But the dream of being able to make all of the, practically all of the profit with none of the risk, they're taking the risk. And it just sounds, it's so attractive that you just keep coming back and keep paying them fees because you're not disciplined enough to follow your system. So I want to get that out of the way first. And Rick had mentioned it. I really thought I always honor those that even give it a mention, and Rick gave it more than a mention. He emphasized it at certain points in his presentation, and that really shows me that somebody really does know what they're talking about. So I'm going to show you two secrets that you can put into your trading plan that can help you to pass the evaluation stage of prop trading. Because once you pass the evaluation stage, then you're on your own to make the money. But getting through that, it's going to take a little bit of adjusting, possibly, to your trading plan. I'm going to show you why. The basic part is that they don't like you losing a lot of their money, so they're not going to accept some of the wide losses that you're willing to take on your own. They're not willing for you to take them to that kind of risk on their behalf. So I'm going to show you those two things. I'm going to offer you at the end my trading plan at an I'm going to call it an unreasonable price, because it's much better than reasonable, and you can actually follow what I've done. The comparisons of prop trading firms is a study that I had. A very smart, I call him a kid. I think he's in his early 20s, but he also has been prop trading. And I met him on Upwork. I don't know if any of the small business people use Upwork, but he did a comparison for me of these prop firms. What are the best ones? I gave him the criteria. I'm going to show you the results of that test. And I put Santa up here because there's still enough time to pass one of these prop trading evaluations and earn enough profit. It doesn't take much, only a few $1,000s in a $50,000 account to start to get paid or ask for payment, your profit, okay? And there's still enough time to do all of that before Christmas. So I wanted to give St. Nick a shout out. So thank you for making Christmas on the 25th of December. And there it is. I put it in writing for you. So let's get going. Who is Norman Hallett? I've met Jeff. I remember the first time I met Jeff, and I think the last time I met Jeff, unless it was one of our get-togethers as a group of traders after. But I met Jeff at an expo. I was walking around shaking hands, and most people know who I am, because for the first 20, the first about 12 or 13 years of the last 20 years, my focus was the mental and emotional, and I worked very well with those that had trading plans. And Jeff was behind he had a booth, and young Jeff, he's still a young guy. Young Jeff, and I was really impressed with all the people that were gathered around his booth, and I had to see who the hell this guy was. And so that's how Jeff and I met. I'm sure that was a good 10 or 15 years ago. In any event, I've written several books on designing and constructing effective trading plans, and I'm going to give you a hint of that today. This book down here, Inspirational Quotes, was somebody that worked for me said, hey, you did those 4-minute drills. I did over 200 of them, 4-minute, right between the eyes kinds of drills, mostly for the area of the mental and emotional, where I helped you get real with with the reality of trading, and that you need to be disciplined. As Rick mentioned, again, and I'm referring to Rick because he didn't mention it several times. And you don't see that because most traders don't want to hear about their weaknesses. They only want to hear about their strengths, you know. But strength, listen, the idea is that you've got to honor everything about yourself and make some workarounds so that you can make your weaknesses strengths. And actually, this more or less profit was when I was on one of these expos that I mentioned up on stage. That was one of my presentations, and the expo people put it in a video form. In any event, those are still available if you want them on Amazon. The Payne Weber, I work for Payne Weber. If you need a big name, funny about Payne Weber, they tend more to be there was so much of a sales firm that I wasn't very comfortable there for a couple of years. I was a commodity specialist for them. But before that, I ran one of the largest option firms in the country. And that really taught me a lot about how people don't like taking profit when they have it. I formed the Hallett Group. I became a commodity trading advisor, was managing accounts over 250 or greater, and really enjoyed that. And I made 20% of what I earned for other people's money. It was a lot of pressure, but I'm talking to you about earning 90, and that was a good living as a commodity trading advisor. I'm talking about 90% of what you earn in this presentation. And Hallett Commodities was my IB. I was clearing my own my CTA trades through to Hallett Commodities. But really, as Jeff brought out, this logo here represents really the last 20 years of my life, and that's helping traders with the psychology of trading. I did that exclusively, really, for the last 20 years. But 5 years ago, I realized that we were getting traders disciplined with ice in their veins to run lousy trading plans. And I said, hey, I'm the guy that used to write trading plans for professional traders, for floor traders, and so on. So I'm I could be the guy to help them with the trading plans too. That's where I came out with a trading plan that I call, well, I've had several of what I call simple trading plans, because generally most of the issues with trading plans are they're much too complicated. I mean, if you have 10 hoops to jump, it's no wonder that you're an undisciplined trader, because you can't wait all that time. You need an efficient, non-duplicatable. In other words, why would anybody have a MACD as well as an RSI when they're both momentum indicators, and you really don't need both of them? So decide on the one that makes more sense to you. Clear up your charts. My charts only have one moving average, sometimes two, which was very, again, consistent with what not Jeff, but his cohort Rick was telling you, that moving averages are the heart of what I do also, as well as using candlesticks. So I was very, very excited to see somebody agreed with at least the components of trading. So that's me, done it a long time, and I want to help you to put some money in your bank account and take away the risk of losing your own money. So this is what they give you each time you, this is a firm called Apex. Every time you qualify for an account, this is 150, 50, here's the 150, there's another 150 that you don't see here just last week. So here's some, they give you a nice certificate. I also have passed with Top Step. I don't use them anymore. I do use Apex. I'm going to show you why. But I wanted to show you this certificate. This is one that's hanging on my wall. Every time you ask for money, this is the first time I asked for money. It's like hanging that dollar bill up on the wall when you have a retail operation. That's what, and I do have that hanging on my wall. I printed it out, and so I asked for $1,000 of the first $50,000 account I had passed and qualified for. When I made enough cushion, I asked for $1,000 just to see the whole thing come, from A to Z. And once the money hits your account, you slap your face and you say, "I can't believe this is real. Let's put the pedal on the metal. Pedal on the metal." Yeah. Okay. So just a little bit about why you should kind of be tuning into this if you're interested in trading somebody else's money and getting 90% of the profit. Here's a little overview for you. Okay. Prop trading firms are going to fund you for 50, 100, up to 300. Some have $500,000 accounts. each qualification, you got to do a little bit more to qualify. And of course, keep mentioning earning 90% of the profit. So let's look at the pros and cons. Okay, the pros. It's their money and your profit. I'm just going to let that sink in just for a second. I know it sounds unbelievable to me, and I said bull. That wasn't all I said. I completed the word when I first saw it. I said, hey, that is bull. Nobody's going to do it. And then I realized how they were doing it. I'm going to show you how they do it. This is our pros, and the next one is going to be it's going to be our cons, but it's going to be their pros. Okay, so that's how they make money. But this is how we make money. This is why the pros, the reasons we should be considering it. Their money, your profit. Millions are being paid out. This was one of the criteria. I wanted a firm that had already paid out millions and had a growing base, and were paying out more and more every month, theoretically. But I wanted to see that, just like a growing company. When you watch CNBC, how much better did you do this quarter than you did last quarter? I wanted to see that in these prop trading firms, because if I'm going to spend my time qualifying and then earning money and then it never hits my bank, that's a real waste of time. Okay, yeah, I'm not losing any money, but listen, the older you get, the more time is money, and I don't want to lose any time either. A prop trading firm, the top prop trading firm paid out 1.9 million in February. They paid out 2.2 in March, 3.1 in April, and so they were growing every month. In September, they paid out 7.7 million, and I didn't put it up here, but last month they paid over $9 million to funded traders. Okay, and just like an 80-20, there's 20% of those funded traders are making big money. That's where I'm heading as I'm doing more prop trading and less presentations, because listen, I want to help people. I want to help serious people that want to get this done. So, but I also see the opportunity here for even somebody like me who's traded his own money for decades. Why wouldn't I put that in a nice 5% whatever, and then bill and just trade somebody else's money? There's no loss involved. It's unbelievable. Okay, so here's 7 points. It's believable now to me. Again, that's what's hanging up on my wall. A word on leverage. One crazy thing about this, one of the criteria when you're testing for to get funded, and when you're actually trading, when you're in the, and I'm talking here the futures market, although they have prop firms for Forex and they have prop firms for some option and stock trading firms, I haven't really looked into those, because I think the meat of the whole business is in the futures area, which I'm more friendly toward. I think futures is just a terrific avenue for speculative profits. But when you have a futures contract, you need to meet their margin. To take an S&P contract, an ES contract, you've got to have anywhere from 15 to 25,000, depending on the volatility. But that's not how these prop trading firms work. Their margin is even crazy. It's even crazier. It's even crazier. In other words, in a $50,000 account, they'll let you take as many as 10 contracts. They only count the number of contracts. So theoretically, you could put on 10 S&P contracts in a $50,000 account, where that would not be possible even near in a normal margin. You would never do that. But for those people who are complaining about there's not enough margin, or is there enough margin, there's too much margin. They want you to use that margin so that you blow out listen, they want you to win, and I'll tell you why they want to win in a second. But they know that most people may overuse that and can just continue to pay them fees. Okay, so be smart. Okay, be smart. Know that if you have a good trading system, then this is all going to work for you. If you don't have one that you can trust, I've got one for you, and one that's been tailored to jump the small hurdles that they put in your way to qualify and to get paid. Okay, and they're not crazy hurdles; they're reasonable hurdles. In fact, I'd have more hurdles if it were my money I was giving you to trade. Let's take a look at some of the cons. Okay, there were fees during the evaluation. Okay, and I'll give you an example. For a $50,000 account, with Apex. Normally it's $167 a month that you pay. Now, on a $50,000 account, you only have to make $3,000 before you lose $2,500. $3,000 before you lose $2,500. So the fee during the evaluation is $167 every month. Now, if it takes you more than a couple of months, you're probably not doing it right. Okay, so the fees $167, but they run specials all the time. I just opened 2 more $50,000 accounts and 2 more $150,000 accounts, so that and because they were having a 90% off sale. So instead of $167, it was $16.70 on those accounts, on those 2 150s, and winds up to be about $65 on the 2 150. So although they're there, the Apex runs, they run specials all the time. I'm not going to give you a link to get the specials if you're interested. I'm going to give it to you in a few seconds. But so the fees are there, but they're not abusive. Even I was paying $200 and some odd with Top Step. Took me a month and a half to pass. So I when I first started, I was learning my way, and so it cost me $400, $350, $400. I'm sorry, it cost me almost $500 to qualify, but it doesn't take you long to earn that back. So fees, it's a thing. The other thing is the reset. Okay, the reset fees. When you blow out an account, if you lose that $2,500 before you gain $3,000, and you want to reset it, it's $80. And they're running a special on that this month, half price, so $40 resets. So these are the fees that they live on, that they're buying mansions on. Okay, because just like any other kind of trading, if you're not a disciplined trader, you're going to just keep paying the fees. The good part about it is that the fees that you're paying as a losing trader is not anywhere near the fees that you would be paying with respect to the money that you're losing. In other words, the money that you're losing compared to the fees that you're paying. Even a losing trader is better off doing this, okay? But you don't want to be a losing trader, okay? You want to be a winning trader. And of course, it's even better for winning traders, okay? 90% of traders fail. They know this. So they're just raking in the money, okay? And, you know, what happens is you get close to getting it. You make $2,200. You only have $800 to go for that $3,000. And you start, let's get there. You start doing, maybe you either get too careful or too aggressive. All of a sudden, that almost worked. Let me pay another $80 and reset. There's a lot of moments of excitement when you keep that dream of their money, your profit in front of you. And they know that. So, you know, get disciplined first, or build it into your system as I have. Listen, you can't count on the system to cover all of your trading ills as far as mental and emotional, but we have very reasonable programs to help you with that. That was the basis of our company until about 3 or 4 years ago, when you know, people started to really win on our trading plans. So I decided to tailor one for this prop trading, because I just think this prop trading thing is fascinating. Now, after you pass, okay, here are the fees after you pass. You have 2 choices, okay? You see this 80 right here? This is once you pass, they fund your account with $50,000, and you have a choice. You either pay $80 a month, or you pay $130 lifetime. Actually, I think that the one I just did, it was $140, so they've upped this $10. So you're either paying, if you have no confidence in your trading plan, you're going to be paying $80 a month, and that's the only fee there is. All these other fees stop, and it's just $80 a month. And incidentally, through this whole thing, they're paying for your data. They're paying for NinjaTrader, which is their favorite platform that they use. Okay, so I believe that they may demand, some of these firms demand that you use a certain platform. They really like NinjaTrader. I've never used NinjaTrader. But I decided to, instead of using TradeStation that I used for 30 years, I learned, it took me about 10 minutes to learn TradeStation, enough to put up a chart and run my system. That's how simple my trading plans are. So don't let that scare you if you're not using NinjaTrader. But this is the 150 is what I pay a month, what I would have paid a month on the $150,000 accounts that I've qualified for. But instead I pay $225 and I never have to pay another fee. Again, that's it. Okay, unless I blow that account out, and I don't want to do that. Okay, so I'm just showing you that yes, there are fees, but they're not abusive. And if you find this abusive, leave now, because either that or develop or take a look again at what you can make out of this, what the risk is out of this compared to these fees that I'm talking to you about. Okay, so are these really cons? Are these really cons? I want to give you this right here, the disciplinedtrader.com. I'm going to leave it up there just for a second so that you can write it down, because disciplined is not the, when I made a URL, I thought, hey, everybody needs to be disciplined. There's no other substitute word, but it's that SC, that'll kill you right there. So the disciplinedtrader.com/Apex, this forwards to a link that Apex gave me, that will always give you their best deal no matter what they're running. Okay, they run deals all the time. This will always give you their best deal at the moment. So write that down, whether you ever see me again or not. The disciplinedtrader.com, instead of giving you some unbelievable long link, I've just used this link and forwards to that. So that's my gift to you, whether I see you or not again. This right here is a napkin. Some of my best ideas came out of napkins. And this is going to be one other chart I'm going to show you, but this is the only chart you're going to see. Really, that look at this. This is the money. The y-axis is the dollars, and this is time. This green line, I just wanted you to have a visual representation. This green line is you paying fees and never winning. You pay the $80. You pay the the $16 that I just paid for a new $50,000 account, and you keep on losing and you never win. Okay, if you have fun, maybe that's worth doing. If you have fun trading, here is what happens when you trade your own money. You win, you get excited, you lose. It's the same losing that you're doing, but what happened to your bank account? This is the normal trading avenues. This is when you trade through one of these prop trading firms. I just think, I just don't know how to better say it. I guess I've been saying it a million times, but you want to consider this. It's not a big risk. The main risk is your time, and the reward is fabulous. Okay, so let's keep going. This is the prop firm study that firm at this is the prop firm study that I gave to Brady, who's the kid that the genius kid that I gave the assignment to take a look at this. What I considered at that time, this was about 4 or 5 months, well, 3 or 4 months ago, the prop trading firms that I was hearing a lot about, that other traders were asking me about. Hey, do you know anything about Trading Pit? Have you heard about Surge Trader? Everybody seemed to know about Apex and Top Step. But I had certain categories that, and if you want this study, I'm at Hallett, NHALLETT at thedisciplinedtrader.com. Ask me for the study, I'll send it to you. But the prop trading firms studied 7 of them. The winner was clearly, to me, Apex. I think Top Step is worth looking at too, but Apex had some advantages that I liked. Okay, they paid out again $19 million in the last 90 days, and $9 million just last month. They again $7.7 million. They had a 4.8 rating on Trustpilot. Now I'm not a huge fan of Trustpilot because I don't think that criteria is really what it should be. I mean, one of the criteria is if you've only had your web page up for for less than 6 months or a year, that's a minus. Well, what if you put up a new web page and and you've been around for a while but just refreshed it? There's something, but 4.8 that's a good score. It's an excellent score, even with my reservations. Traders from 150 different countries, so they know what they're doing. Here's a blow up of one of the parts of that chart, and I just want to show you some of the things. Forget this last column because we didn't put the decimal points in here. So concentrate on here. In fact, just concentrate on this one. 50. I used to recommend the 150. I think it had the best numbers, and I'll show you why in a second. But I like the 50 because the numbers are very good, very reasonable. You only have to make $3,000, okay? And the drawdown is $2,500. They have they have a way of measuring drawdown, which is detrimental to traders. But I'm not gonna go into that right here. But in my program, I'll show you how to get over that. Okay. This $50,000, all you have to do is, now I called it, their normal is $167 a month. I just paid $1,670 for the first month, and if I need a second month, it'll be double that. So they're giving me 90% off the first month and 100. Now they're giving you 70% currently. So it would cost you $45 right now in order to give the $50,000 shot a chance, okay, to be funded for $50,000. So trying it is not going to hurt you here, okay? Your target is $3,000 before you lose $2,500, and it's trailing, means that as you make money and as you're 50, it goes to 51, 52. This $2,500 follows you, okay? You don't want to have anything more than your at this point the high water mark, okay? And there's a caveat there. Again, I'm not going to explain it here. Because there's other things that are important to explain, but it's not a stopper. It's actually something that makes you a better trader. Okay, now this 1.2 ratio is just the comparison of these things, and you can take on as many as 10 contracts in the 50. Now, why I like the 150 is you're paying 297 with no discount, but they'll always have some kind of discount. So, at 90% off, you would be paying only $30. But they want you to you got to make 9,000 before you lose 5,000. I like this because you see this 15, 25. Here's a nice gap of 2,000. I don't like that red. I don't like to trade with a red line at my back, and neither do you. I don't like to. So I like a little bit of I like that room. I don't like to be down $4,000 and have to come back before I make 9,000. I don't like that. But I like the fact that I can take on a few more contracts, or one or two more contracts with this kind of breathing room. But the way you counter that in my recommended start for you is that you just take for smaller contracts. You can take minis, micros, all kinds of small contracts and futures. So trade small, think big. And so I want, and one of the reasons I like the 50 is it's the easiest to pass. This is too small, 50. The 50 is easy enough to pass and give you some room on the downside here. And I want that money in your account. Once I got that first $1,000 in my account, I said, holy smoke, this is different. This is a dream come true, not only for me, but every small account and every senior that I've ever talked to that were worried about their money or just blew out 3 or 4 accounts. Stop it. Do this. It's a real thing. Okay. So let's continue. Enough with the chart. You can take a look at that again, but I want to give you the keys. I've got about a half hour here. So I want to give you the keys to the kingdom here. I'm a twin, so that's not my picture. I was much cuter than that. Actually, I wasn't, but this is a twin. My twin brother passed away in 1960. I'm sorry, at the age of 60, and he was the good twin. So you're dealing with the other twin, and the reason I'm the other twin is I was the guy that was always speculating, and nobody ever understood. I mean, you ever go to a cocktail party and they ask you what you do, and somehow you don't say I'm a speculator, I'm a futures trader. You do something, you say something else about yourself, or you couch it in something else, because somehow that means that you're not responsible. Well, if you do it right, you can proudly say, "Can I have my martini?" And you asked what I did? I'm a futures trader. Can I help you? So don't worry about names and labels. Worry about winning. and worry about being disciplined to win. Okay. Here are the two you want at least 2 contracts upon entrance. I'm going to show you what those, I'm going to tell you why, okay? The first contract is for scalping. I am not a scalper. I was never a scalper before I hit this arrangement of prop trading. Scalp trading, you want to take short profits in order to pad your gains so that you stay further from that red line. Because if it's a losing trade, when you're thinking bigger, it's not going to hurt you because you took a little bit more profit. You took a little profit out of the trade. So using a scalp along with what I call a runner, that's the way to do this, okay, that I found is the most comfortable and makes the most sense. Okay, you're going to minimize your drawdown and you're going to capitalize on a jumpstart trigger. Now, in our system that I'm going to offer you, and in any system that I've really built in the last 5 years, I use what I call a jumpstart trigger, a trigger that has a jumpstart that has a very high probability. When I say high probability, I mean over 67% of getting you where you want to go. And I'm not talking about 1 or 2 ticks. I'm talking about a reasonable number of ticks. And I show you how to measure what the expectation based on the other part of the trigger. And so what you want is, and how do you find a jumpstart trigger? One that works at least 67% of the time to get you to have an initial move in your favor of some consequence, okay, of some magnitude. Okay, and you need to figure out what that could be, and then you need to test and see whether it really is or not. Because so many traders used to come to me, and they still do, that say, hey, really using this trigger, and somehow it stopped working. Well, I don't think you've tested it properly, or tested enough. When I suggest a trigger to you, I've tested it, and you should be testing it too. All right, so always start with 2 positions, 1 as a scalp. The next one is what I call a runner. It's for expansion. Okay, you want the opportunity for a big winner. Look, especially in current markets. Okay, one other note is that the last $50,000 account I qualified for, I did it in 3 days. Okay, even using small contracts. That's the kind of volatility. And I had to wait another 4 days to get funded because they want you to trade at least 7 days before they'll fund you. Why do they do that? I think 2 reasons: to stretch out to tempt you into maybe trading another trade and paying another fee if you happen to lose on that crazy trade, but mostly because they don't want traders funded who are not going to be good traders. They want you to win. Okay, I've said that they want you to pay the fees, and they do, but they need guys like me and guys and gals like you who are winning. Why? Because we give testimonials, we make presentations like this, and that sucks in another 100 people who they know that 90 are going to just pay fees. Okay, so they need us for the testimonials. Okay, and so this is the way of business. They love when they say, Norman Hallett just made $50,000 last month. They would love me to talk about that in one of my testimonials, and because they can put it up, I'll shoot a video for them, and then all of a sudden everybody says, well, let's give it a try. So the more people that they can win, the more they can bring in the non-winners. I hope that's clear to you, but I'm only talking to winners, right? Okay. So the contract for expansion, the second contract is for expansion. You want that to run, and with this volatility, you can have some nice big clips. Okay. But you got to defend the growing profit. In other words, when the market starts expanding, you've got to look to defend that. You don't want to give that back, because giving back a profit, okay, is what hurts you with Apex, without giving you all the explanation. But you don't, when you have a profit with Apex, they want you to capture as much of that as you can. So when you do have a big winner, you want to defend that. I like to defend a couple of bars back. There's a couple of underneath the low of a couple of bars back, and this works with a 5-minute chart, the 10-minute, just like Rick was saying. When you're using the components of a trading plan that we use, you're going to it works on any time length that you any candle length that you want. So whether it's weeklies, monthlies, 5 minute. I don't like the 1 minute. I think it's too fast, but I worked with this on the 2 minute and done very well. So of course you're minimizing your drawdown when you're grabbing the big money. And in my trading plan, what actually happens is I've looked at the numbers over the last couple of years, and what it is that these scalps offset any losing trades that you have, because they won't all be winners, and that you'll wind up seeing that these expansion grabs that you get are the money that that you take home, that you're going to be taking home theoretically if you look at this. Okay, so another primary benefit is eliminates a common dilemma: scalp or run. Remember, I said that my trading plan here is built with the mental and emotional part in mind, and what I mean by that is that a big dilemma is when you only have a single position, or you treat all of your contracts that you take as one position. When you get a good pop in the beginning, you start thinking, hey, this could be the big one, and therefore you don't take the profit, you let it go. And or if that hurt you and it came all the way down the last time, then you want to take a short profit, and then that one went to the moon, and you could have had a big profit. So with a one contract, or treating multiple contracts as one contract, you never know. You're never quite sure how you're going to handle the winner. So by doing it this way, you've eliminated what is one of the biggest drawbacks for the unconditioned trader, for the undisciplined trader. Okay, so that's why that's why I think this is important for you if you're going to be prop trading. I know it made my life a lot easier as I went through it. All right, the second key is another simple key. And it's about leverage. You want to take small contracts and give yourself a wider range as far as the stopping is concerned. And you're using the same rules, but sometimes you get a really nice trigger that has a very wide range. Okay, it has a lot of risk involved with it if you took the trigger. It looks the same as the smaller trigger, only it's a bigger version. You can go ahead and take that trigger because they work out more than the smaller ranges do, the smaller triggers do. You can take that, but use a small contract or use the micros, and there's so many of them. I was trading micro silvers yesterday in a $50,000 account. It was fabulous. Okay, it could have a little bit more volume, I guess, but enough volume to trade with responsibility, to trade in a responsible way. So small contracts give you wider range. Current market volatility demands allowing a position to breathe, okay? And so, and of course, that prevents whipsaws, and smaller contracts allow more contracts to be initiated and scaled out of. I really like using the smaller accounts, the micros and the minis. This way you can scale in and scale out at certain support and resistance areas, which are easy to identify, okay? So just giving you some real benefit there by insisting that you consider smaller contracts and let the volatility work for you. It's another defense against drawdowns. All right, I want to, I've given you enough about some tips, and I hope that you were able to, but I want to take the last 5 or 10 minutes just showing you how I've put this all together in a trading plan for you. And I want to give you a great deal on it so that you can get started, and you can, just like I showed you Santa before, it can all happen for you. Get funded and get that first check before Christmas, okay? This is the Loaded Gun Simple Trading Plan, and it's got, the Loaded Gun Simple Trading Plan has a lot of the elements that I've just glossed over, but the core of the Loaded Gun Trading, core area of the Loaded Gun Trading Plan are just 2 videos. It's so simple. This is a simple trading plan. As I mentioned to you, it's a simple trading plan, and that's what works in trading, simplicity, okay? Simplicity that's been tested, okay? There's no confusion. There's no challenging your patience. Okay, if you're waiting and waiting for something to happen, that's what draws you into doing poor things as a trader. But if you have a trading plan that that has a frequent, reliable trigger that I mentioned, that has that pop, then you're talking. Now you're not worried about your lack of discipline or your lack of patience. You're actually working around it. So the core Loaded Gun Trading Plan is really just 2 videos of about 45 minutes each. So within an hour and a half, you're going to get the main really the core. You can run it just the way it is. In fact, in the beginning, that's all there was. That's what made it popular. It fits on one sheet of paper. You'll download that and you'll have it in front of you. It's very easy to understand, but you'll get those core trading plans. All the rules fit on one sheet of paper. Okay, all the nuances. I've coined something called nuances. They are things that you can do, rules that you can adjust just a little bit in your trading plan that help you as an individual. Okay, understanding if you're a trader who lacks discipline, there's one of those nuances you may want to take. If you're somebody that tends to if you want action more, there's a nuance that can allow you to take trades on the edge without hurting yourself, okay, more than you normally would, 1 or 2 ticks. But it feeds into who you are instead of changing you as an individual, which you may have done before and not have any success. Let's change the trading plan to honor who you are. That's what a nuance is. Right now, there's 7 of them. We're testing 2 more, but people really love these nuances. Okay, there's a private Facebook group. I don't think a lot of traders are older traders. It doesn't have the action that I like to see. But I'm there every day checking into it. But don't worry about the Facebook if you're not a Facebook. If you hate Facebook, I can show you how to go incognito. But I think the most important part here is getting together are our monthly get-togethers. The last Wednesday of every month, we get together as a group with all our little boxes on Zoom, and we talk about our successes. Some new people may have questions, resistances. So we talk about our experiences, so that it's really kind of a family that we have that's running Loaded Gun. And generally families don't get together unless you're having some sort of success. So I really love these get-togethers, and they're recorded. If you can't make it, you can go ahead and view the recording in Kajabi, which is where we deliver our trading for you. Okay, so we give you updates, we share experiences and recordings, but I want to offer you one thing. I want to help you. We'll do this together. This is the first bonus. Let's work together and make this happen. Unlimited one-on-one coaching with me, not one of the people who I've trained for this, but me in this particular case. Unlimited one-on-one coaching sessions for 90 days. As soon as you invest in the Loaded Gun Simple Trading Plan, you'll get an email with a calendar link. You'll be able to schedule a personalized one-on-one walkthrough with me, and I'll proceed to learn about your trading background and advise you how to get that quick start with your new purchase. Again, I'm going to dig in a little bit and maybe suggest a nuance or 2 that'll stop you from doing the wrong thing because it fits who you are. As you perfect running the plan, I'm going to be there, and if you need me, for as many times over the first 90 days, one-on-one. Just go back to the calendar, book another session. We'll go over it again. I'll answer any of your questions. Now, most of the time, it's going to be 1 or 2 meetings, and then you're going to, if you have a question, shoot me an email. You'll have priority with my email, and I'll answer it. I may make a video for it. I love to do that. I can make a quick 2, 3, 5-minute video, send it to you, and answer your question that way. So, but if you're the question man or the question woman, it's okay. You can have as many meetings as you want with me. So I want to be there for you. I want to hold your hand and let's get through this. There's no reason why you shouldn't be a funded trader. Okay. I may have to slap you in the face a couple of times and to adhere to just basic trading discipline. But if you're a disciplined trader, this trading plan is going to be very easy for you to run. Okay. But I want to be there all the way with you. Okay, we want to celebrate your first funded account. So I'm going to be there with you for 90 days. That is the first huge bonus. Here's somebody that talked about. This is Ted, who's a longtime customer of mine, but just jumped on the Loaded Gun almost 2 years ago now. Simple to understand, set up with easy to flow rules that will work in any market. Any time frame. Takes me less than 5 minutes to look at all of the markets I trade and make my plan for the day. First, test the Loaded Gun trading and trade it in sim before you're confident. In this particular case, I want you to trade it here. He was trading. This is before the advent of prop trading, and then go live. Examine all of the included nuances and test them to see if they improve your results. He says that not all systems are 100%. And so keep your losses low and so on. But he's a very professional trader, very great guy out of Austin. But here's a guy that was struggling and grab loaded gun, and I want you to do that too if that's you. Here's some. Alan he's into real estate. He doesn't do a lot of trading when real estate is hot. So 2 years ago you couldn't get a hold of him. Now I can't get rid of him. Now I can't. We talk. But Alan now he's trading he's probably trading full time now. Your processes are usable by every trader, every trading style, any guide to guide us in creating our own personalized systems. It's what I want to work with you to take our system and personalize it for you. The tools have helped me increase my profit, win ratio, confidence, and my job satisfaction. As a full-time trader, that's been the greatest benefit of all. I give you this. Listen, I got a lot of I've got a lot of testimonials, but they're not, wow, this really looks good. I've went through the first training and it really is great. No, this guy's been through it. He's making profit. Okay, there is a win ratio. He's got confidence, and this idea of job satisfaction. I just thought this particular it really said it all. But you want profit. You're not doing this to start off well. And listen, I'm giggling there because I've been through it too in the very early part of my career in the 80s. Okay, and I'm sure you have. I want to show you this particular testimonial, and this is the last one I'll show you because this is what our chart looks. Look how simple this is. Okay, it's got a moving average. It's got but look at this. Purchased on 12/10. Okay, this was on a Saturday in 2022. He purchased this at 12/10, and he sent this to me the next Thursday. So 5 days. In 5 days, he was already trading loaded gun in 5 days. He looked at the videos and the nuances. It took the attached trade, and I'm just showing to you that this is not hard to learn. Okay, it's not hard to learn, and I want to be able to show it to you and give you this if you're willing to have me help you to get funded. Okay, I just wanted to show you that one because it's easy. It shows you that it's not something that's going to take months. Here's the second bonus. I just added this a couple of weeks ago. It's that genius I talked to you about who did that comparison for me. He also prop trades, and he also is he's a techie guy. I'm not a techie guy, but I'm going to set it all up for you, the data feed and the trading platform. If you have NinjaTrader already, you're okay. And he can set up other platforms for you too if they fit Apex. But the data feed, you have to put in what they call Rhythmic or Tradovate. Those are just data feeds. Again, you're not paying for it, but you got to set it up. And some of these firms, including Apex and TopStep, it can be a little complicated. It took me a week to set it all up. I can't believe it. I'm kicking myself. I'll try it again tomorrow. He will do it all for you. What he's going to do is on Apex and TopStep, they have more advanced setups and can be confusing to traders like me who are tech challenged. So I'm going to connect you with my young genius who will jump into your computer. You'll give him permission to go into, and you'll sit back and he'll set up everything for you as you watch his mouse go around, so that all you have to do is start trading. No headaches here on getting set up. If you go for this, I'll make sure that you get set up and get ready to go. You won't have the impasse and frustration that trading firms have, and it's not them. They're trying to make it as easy, but when I do the cooking in the house, when I see all these ingredients, I don't do it. I want 4 or 5 ingredients. And that's it. These people it's like the long list of things, and that's okay. It's doable. Most people finally get through it. But why that frustration? Sign up, take advantage of this, and by Monday, Monday afternoon, you'll actually be trading. Okay. All in all, this is what Roger sent me when I sent him Brady. Which is with the genius kid. All in all, it really went well. Brady is obviously skilled. His cursor darted back and forth without explanation. I ended up feeling like I had gotten a bargain. Now, he paid $150 for it. I'm including it for you, okay? I'm including this in this offer for you. So what is my offer? So this is what I'm calling the Get Funded offer. The core loaded gun trading plan. Again, it's an hour and a half, both videos to understand the core and the printout and all of the examples in the video. All the nuances, they're only about 10 to 15 minutes each of these nuances. So it's another hour and a half, 2 hours. That's it. It's not like a million videos, okay? And the monthly get-togethers. That's a really good part of it. Whether you look at it's good to share your experiences. It's good to hear other successes. It keeps you motivated, okay? The bonus one, which is me, unlimited, one-on-one coaching for 90 days. I want to hold your hand and make sure that you get this down right. Bonus number 2 is the hands-on setup. We'll do it all for you, setting up the data feed and the trading platform for you. And before I give you my crazy pricing, I want to give you my personal guarantee. I am so confident that you're following the Loaded Gun Simple Trading Plan will result in you getting funded by your prop firm so that you can risk their money and not yours, yet still receive 90% of the profit you generate. Just share your trading experience with me, that you followed the rules, but it didn't work for you. And I'll refund your purchase plus $500. I mean, what good? I see these guarantees all the time, trading guarantees. They show you how to trade, and then somehow you lose 10 or 15,000. Yeah, at least I'll give you 500. Okay, I haven't had to do it yet, and I won't have to do it. Listen, this is a proven trading plan, so it's an ironclad guarantee. I'm giving you that umbrella of safety, so there's no reason not to take this offer. Again, Loaded Gun Simple Trading Plan, which on our site right now is $24.97, and that's a great price for what you're getting. The core, the nuances, the Facebook group, the monthly meetings. I'm going to give you that one-on-one coaching with me for 90 days, okay? And then the do it for you, done for your setup, and we'll get Brady to jump into your computer and make it all happen. So that's a $250 value if you're not a client of mine, but if it's $150 if you are, but I'm including it here. Okay, it's a total value of $52.47. And again, we've been offering it half of that value on our site right now, $24.97. But I'm going to give you 50% off, $1,247. Work with me for 90 days. Let's get you funded. That's going to be easy to recover. You saw that testimonial I gave. It didn't take him long to recover in the 5 days. But again, by Christmas, this can happen for you. thedisciplinetrader.com/meta. There's that disciplined again. So you can actually click on that if you want. If you're watching this, click on that. And it should open a browser for you, and you'll get to the site, but the offer page. But look at thedisciplinetrader.com, write it down, /meta, but use the coupon code PASSNOW. Okay, use the coupon code PASSNOW, thedisciplinetrader.com /meta, PASSNOW. I want to listen. I want to hold your hand, and we'll do this together and get you funded. Okay, there's a limit of 10 traders, and I have to do that. I take on 5 or 10 at a time. I had 6 just graduate, let's say, and so I've got some room here, but because of the one-on-one unlimited nature of what I'm offering you, that fills my calendar. So I don't want you to look, and you can't see me for another 3 weeks. You can see me. You can always see me the next week, sometimes the next day. Okay, so there's a limit of 10 traders. I want you to take advantage of them. Anyway, are there any quick questions, or do we have time for questions? I wanted to make sure I got it all out there, Jeff.
We have a few questions. The biggest one seems to be options trading. Can you use this with options trading? That's a question from both G, Danish, and one other person.
From G Wiz? Okay.
No, G. There's a couple questions, but they revolve around options trading. Okay. One from G and one from Danish.
Okay, I'm going to say G Wiz anyway. But
okay, that's your choice.
The answer to that question is I'm not sure. I don't believe there may be out there prop firms that are. I've got a big background in options. And it's funny that I haven't really looked into it because I've been focused on futures really for the last 15 to 20 years. And if they're out there, look for them, but use the same criteria that I've used when you examine them. Look for ones that have been sending money, okay, that have been sending increasing amounts every month. Look for one that's been around for at least a few years. So use that criteria when you look. Just Google it. Google prop trading, option prop trading. But if you've never tried futures, you may want to consider it. But that's not a great answer. Actually, it's a great answer from the standpoint that, yes, I don't know, but I
don't know. It's always a good answer. around here.
I don't know. Are there any other questions?
What's the success rate after your course?
People are always looking for that success rate. The success rate after my course. I guess you're asking how long do people stay funded and start. The question is, how disciplined are you? I mean, I can give you all of the rules and regulations, but unless you're disciplined, for those disciplined traders that are doing this, you're looking at somewhere in the 80 or 90 percentile. For those that are undisciplined, you're looking at somewhere between 0 and 5%. If you're looking at, if you're a trader who is a disciplined trader and wants to do this, you've got a very high probability of making this happen. And if you're not making it, and if you have a good trading plan that you're making money with now, but you'd rather risk somebody else's money, use your trading plan, because it should work with a couple of adjustments, the 2 keys that I gave you. But mostly, listen, trading is all about the mental and emotional part, and you can have as many workarounds as you have. So you're going to have to answer your own question and be honest about it. If you're not a disciplined trader, we've got courses for you to be that. That's where we made our reputation. So the answer for a good trader is 80%.
All right. Dinesh wants to know, what's the best way to learn how to trade futures? How do you suggest somebody get started?
That's a good question. I would, I think there's some, I used to say pick up a book on it. And there are some good basic books, futures trading for dummies. I've never seen it, but I'm sure there's one out there. But right now, just hit YouTube and look at some of these trading plans that are talked about on YouTube and see which makes sense to you, which seems to work for you. And usually you can either get a trial period or a good guarantee. But you've got to have I don't know if you can trust flag up in your mind before you commit to somebody. But you want a simple trading plan, and if you haven't learned about futures, the best thing to do is to get started learning. Do some prop trading, make some mistakes. But I wrote a piece. It was a paper in Traders World magazine. Larry had me produce it. He produced it for me there too. It's called the death of simulated trading. See, I think what you're looking at here in prop trading. I mean, why practice trading only to take the huge step of risking your own money and have all that the cortisone, not cortisone, but forgot what the word is. But all that stress start as soon as you trade your own money. Trading somebody else's money is a lot less stressful. Yeah, you're risking your time, and that's a bad thing. But prop trading, demo trading is going to be out in a couple of years. You might as well practice here at $16 to $30 a month, whatever it is, to get where there's some responsibility right from the beginning, but not your own money. And then and if you hold on to that responsibility and you pass, you got $50,000 to trade, and you may be trying to do that with $5,000 or $10,000 or $20,000. The crazy part of this is that what I'm seeing is that at least half of the people that are grabbing loaded gun and are doing this have not only had their own trading plans that were pretty good, but have plenty of money on their own, and just don't want to risk it. Why risk them when you can risk their money? So a lot of good things happen here if you can be a disciplined trader and you don't ask about other people and how they're succeeding, and focus on your hurdles and getting your self-discipline to succeed. That's where the attention should be. Okay.
All right. Thank you very much, Norm. Appreciate you coming in and spending some time with us today.
Okay, now, thank you for having me.
All right. Very good. Thanks. Let me go ahead and do this. Okay. All right. All right. Cool. Okay. All right, cool. Thanks. Hope everybody's doing well. Thanks for participating. One thing that we're going to do, we still have one more prize drawing. And what we're going to do for the final prize drawing is we're going to do it at the very end. And we're going to reward you for staying for the very end. So at the very end of today, we're going to do a final Metastock prize. So hope you're enjoying the conference. Hope everybody's enjoying themselves. Thank you for coming. One last shout out to one of our sponsors, the CMT Association. Yesterday we had Stan Dash come in and he talked about the CMT, how it works, all that kind of good stuff. If you want to find out more about the CMT Association, you can go to cmtassociation.org. Now, we meant to have Martha in a little bit earlier this week, but we absolutely love Martha. She always does a really good analysis of the markets. We love the indicators that she works with and the indicators that she uses. And we love the way that she kind of looks at kind of quiet accumulation and the different indicators that she has. So without further ado, let's move on to our final speaker of the conference. Martha, how are you doing?
Hi, I'm right here. It's good to hear.
Yeah, okay. I can hear you now.
Getting set up.
Awesome. Yeah,
Okay.
you're coming through. I know we're starting a little bit late. I don't want you to. You're good in terms of time. Take as much time as you need to, and let me know when you're ready, and I'll let you go.
Okay. Can you see me now?
Oh yeah, you look great. Yeah.
Hi, everyone.
Up in the Seattle area office.
Yeah, I'm a longtime chartered market technician. I sponsor a lot of CMTs and everything, so I work from the professional side. So what I'm going to do today is talk to you about how the inner market works. You're on the outside looking in, and it can be a real problem for you because you don't always understand what's going on. As always, I'm an educator. I retired in my late 30s, and my partner came to me one day and said, "Oh, Martha, we have all these people constantly coming to us for help, asking for guidance and all of this." And he says, "We should do a 2-day workshop." And I said, "Are you nuts? I'm retired. I'm having a good time." Blah, blah. And he pestered me for a year. And he said, "Martha, you're bored. You've done all the things that you want to do." And I had to admit it. And I love teaching. So I said, one workshop, just one workshop, and I'm out of here. And and we did it, and I'm standing in front of the room, and there's stockbrokers, and there's retail traders, and there's brand new people learning to invest, and there's financial plan. And I'm saying, I turned to Howard and I said, they know all this stuff. They have to know all this stuff. We're going to have to refund everybody's money. They're not going to, I don't have anything to say that they don't already know. They can read from books and all this stuff. And he said, "Martha, just do your stuff." And I just started talking, and I started explaining about the market and what the market really was. And I stopped after about 8 or 10 minutes, and I said, the room was just deathly quiet. I said, "You don't know this stuff, do you?" And for the past 25 years, I've been saying, "You don't know this stuff, do you? You've been trading for 10, 20, 30 years. You've taken all these courses, and you still don't know this stuff." So today you're going to learn this stuff and find out what the inner market is, because what you're trading is on the outside, like looking through a dirty window, trying to understand what the stock market is about. A few years ago, after publication of my second professional thesis, the Market Technicians Association recognized the significance of my new theory and publication on relational technical analysis. My first thesis that won me the CMT was cycle evolution theory and deviations in cycles. And that one has been a landmark where they feel that it's really advanced the cycle, understanding of cycles in the stock market and other areas. So that is also part of this course. At that time, I was asked to present the new method of technical analysis to the entire membership of CMT. The new theory has been widely accepted and is being used by many professionals all around the world. My thesis expands the use of technical analysis in a new approach and methodology that is very easy to use and apply. I teach this to my students who take the Technitrader methodology course, which is a complete and comprehensive approach to making income from the financial markets. If you want to be a hobby trader, that's fine. If you want to be a professional, most people who want to become professionals also check me out. The Technitrader tools incorporated into Metastock charting software are used for this purpose. Today, I will introduce you to this new way to study stock charts using Metastock charting software. And Metastock has fantastic charting software. Relational analysis is the evolution of chart analysis and the interpretation beyond the basics of price, indicators, candlesticks, index, and trend analysis. You've all learned this stuff, but you need more. The US stock market is the largest market in the world. Did you know that? Even if you combine all other nations' stock markets together, it is still massively larger. In fact, there isn't a financial market in the world that we're not the largest of. The highest number that I saw recently was $140 trillion of assets worldwide that under management from the US buy-side institutions. So it's big. Millisecond transactions create new challenges and new opportunities for the retail side of the market. This is millisecond trading. You have no opportunity to millisecond trade, but the professional side is all on the millisecond now. It's all on the millisecond. So you're trading the 1 minute, and sure, you're a broker, you click and your broker's got it, but you also have to remember that your broker is watching and monitoring everything you type in. That broker is recording. So they know in advance what you're going to do. So they can decide whether they want to PFOF it, payment for order flow to Citadel or whatever, or fill it themselves. And so they can take money from you by nickel and diming you to death. It's not free. I know you think it's free, but it's not free. Nothing is free in the stock market. Technotrader tools used with the Metastock charting software offers more analytical tools, state-of-the-art hybrid leading indicators, and additional data which broadens the depth of analysis and therefore your technical perspective. If you really are serious about trading as a business or becoming professional or making an income from the market, then you need to go more than what you have. Whenever you can improve your analysis via your software tools, you will improve your ability to analyze and trade successfully, whether you are a beginner or a professional. Beginners that start with me have this awesome openness and they just follow the rules. So they're instantly successful. I had a student just the other day that said, Martha, I paid for the course with just one trade. And he's continuing to have success like that because we are very careful about making sure that students have everything they need. The financial markets are an ecosystem. I like to say it's like the ocean and how the complexity of the ocean. Most retail traders have a simplified understanding of the stock market, really too basic for today. The market changed dramatically during the pandemic and thereafter, and you have to catch up. You're behind. You have to catch up. The stock market and other financial markets are complex and highly evolved ecosystem that continues to evolve. We're going to have non-fungible tokens pretty soon. We're going to have digital assets and all this other type of investment opportunities and trading opportunities. Therefore, just applying mathematical equations, which MACD or stochastics or RSI or other indicators of the old generation is a mathematical equation. If you just apply mathematical equations without considering the entire ecosystem, it will not provide the highest return of investment for long-term or trading income. And you need to do both. You need to understand the long-term side and the trading side. You need to do both. And you can do that with your Metastock charting software. So there's all kinds of sizes of trades, all kinds of different kinds of activity going on in the market that you're totally unaware of. You think, oh, sellers versus buyers, somebody's going to lose. Wrong. Most of the time, people are making money. When viewed as a living and evolving organism with continually expanding diversity, the financial markets become far more understandable. And when you understand something, you can make more money out of it. Relational analysis expands the awareness of the entire financial structure for better interpretations. So imagine you're driving at night with fog, in the fog, wearing sunglasses. You would have about this kind of vision. You couldn't really see who's coming or going. Your perception of what is going on while driving in those conditions would be completely off. The vehicles in the fog include a log truck driver late for delivery, a heavily loaded semi-truck, a Jaguar, a motorcycle, two bicyclists trying to cross traffic, several teenagers in a car, and many, many weary commuters who are just wanting to get home. But you can't judge who is where and what they're doing or why they're doing it. With the fog and sunglasses, it is impossible to see them or judge their speed, purpose, or emotional mood accurately. This is how you trade the market every day. You have no idea what's going on that you can't see, and it whacks you. Oh, I got whipsawed out. The market makers hate me. Oh, I can't use stop losses. They don't work. On and on and on. And it's because you don't have a visual. So this is what you see right now. If you took off the sunglasses, turned on fog-piercing headlights, and focused on all the vehicles around you, your ability to successfully navigate congested areas increases, right? So we can sort of see the conditions just mentioned are very similar to what technical traders experience while trading the modern automated marketplace. They really can't see, and this is still really blurry. This is the technical analysis that you have right now. About this much vision. It's not good enough. You can't really see what's going on. You can't actually see the other buyers or sellers, and without some understanding of who is buying and who is selling, risk increases on your trades. And you wouldn't be at this conference if you were one of my super students. I have one who started out years and years ago, and now he's managing a $100 million hedge fund. Okay, so I have quite a few of those. Now we have more clarity. Relational analysis pierces the fog surrounding the entire market. And final clarity with relational analysis. This adds clarity to the analysis regardless of the trading instrument you are using. It can be used anywhere. So now you can see it. You have to remember that the US stock market is massively huge. It's a 1,000-lane freeway trading 1,000 times per second. And you have to get a handle on that so that you can make more money. All your courses that you've taken are very good. All the ones that you think you understand and all the things you have, but you're missing a huge, big chunk of what you need to understand. When traders learn technical analysis, they learn basic trend patterns, topping formations, bottoming formations, and so on. However, that is not learning how to use that knowledge in the modern market structure. Not only must you learn the patterns of technical analysis, you must also understand the relationships between the different patterns. Who is in control of price? Just learning to identify an engulfing white candle is insufficient. Who made that engulfing white? What does it mean? It doesn't necessarily mean the stock's going to go up. Where that candle forms, what candles preceded it, and where it is on the overall trend are critical. What is happening within price in relation to the intent of the trade and how it relates to indicators that reveal dark pool activity and high frequency traders trigger activity is crucial to truly understanding and using technical analysis properly and successfully in the modern market. Dark pools have vast quantities of liquidity. They pull and they buy and they sell in accumulation slow mode. No, you can't see their activity, and I'll explain why. HFTs are the big gappers of the market. Wouldn't you just love to get into a 10 or 20 point gap before gaps, not after gaps, and then start selling down? You go, whoa, why did that happen? Relational technical analysis takes into consideration far more data from the chart and includes a deeper analysis, and it's simple and easy to learn. This allows the retail technical trader to understand who controls price, which in turn provides a superior indication of how price will behave in the near term. We can't predict the market. We can't predict the weather. We had a storm come through here just overnight. It's like, whoa, I hope I can do this. We can't predict the weather. We can't predict the stock market because it's humans. It's not a mathematical equation. It's not just a specific thing. It's all over the place. You have to understand, say, whoa, the dark pools are here. Whoa, that's a pro trader setup. They're nudging that up, and it's going to have a HFT run after that. When you see those patterns, and it's like taking you from looking at the charts and kind of seeing this blurry image to reading the chart like you would a book. This level of market activity, this levels the market activity so that retail technical traders can trade with the professionals rather than against them. And I can guarantee that with all the courses you've taken and all the trading you've tried to do, and if you're a new beginner, you don't know this yet, but you're still trading against the professionals every single day because they can see everything you're doing. They're in your chat rooms. They have AI checking out the social medias. They check their Facebook. They see what you're doing. There's no private. There's no private. Not against the AI. No private at all. The new market structure. This is from the SEC website. I encourage everyone to always visit them. This shows how the speed at which price can move up and down on the millisecond action. And this is the action that you would see normally in the normal public exchanges like the New York Stock Exchange, ICE, NASDAQ, and so on. So all of you have learned this. You all know this. It's everywhere on the internet. Banks and wealthy individuals and corporations control 50% of the market. Average investors control 40%, and uninformed investors control 10%, and they lose all the money. However, this was written in 1890. This is 2023, by the way. Hello, everybody remember that this is 2023. So why are you learning this stuff? It's outdated. Here's the new bull market cycle, and we expect to see a stock market cycle that's bigger than the 1990s. Why? Because we have 20, count them, 20 new technologies coming to market. How many do we have in the 1990s? How many? How many new technologies came out in the 1990s? Anybody? 6. Buy-side institutions start the bottoming action after a bear market. They're the first ones in. They bargain hunt. They don't buy cheap stocks because they know those cheap stocks are going to be ending up either hostile takeover or Chapter 11 or Chapter 7. They're buying companies that have the fundamental values are above the price. And so they want to bring that price up to that fundamental level. So they're buying first. Then we also have the wealthy private investors. You never hear about them. I'm not talking about Warren Buffett. He's just a small funds manager in the scope of things. When you're talking 100 trillion, 50 trillion, So the wealthy private investors are billionaires, and we have quite a few of them, a few hundred or a few thousand, and they just turn their money over to a very good money manager. But they are all, almost always, have been businesses that they started in a garage or something, and then they grew up like Jeff Bezos did Amazon. And so he knows a lot about the market, so he can tell his money manager, oh, buy this, sell that. Professional traders on the buy side do the floor trading for the institutions, but they also trade to adjust the inventories. Professional traders that are independent, this is a growing number. A lot of my students qualify for professional status and trading as a business, and they make a lot of money. They do very, very well. One of my students, she's an MIT grad, her husband's an MIT grad. He works for Boeing, makes a buco bucks, and she beats him every year with her position trading. She makes more money. Sell-side institutions are the big banks and the financial services companies. So you're looking at Bank of America, JP Morgan, and Goldman Sachs, that type of thing. The buy-side institutions are Fidelity. The giants are Fidelity and Vanguard, and the derivative developers, BlackRock and State Street, massively huge companies. Professional traders on the sell side, they also do the buybacks for the corporations. These traders are short-term. This is short-term. Sell side is short-term. Buy side is long-term. These are short-term traders most of the time. These are long-term investors. Corporations will buy stocks either to acquire or to just help boost a small company or make a partnership going on. They also do buybacks, but the buybacks are done physically by the sell-side institutions. That's a big thing that a lot of you miss, is that when a corporation is doing a lot of buybacks, there's a lot of swing trading opportunities there as well. You just need to identify that there's a corporation and the sell sides professionals are doing that activity. High frequency trading and hedge funds go hand in hand. And they are very fast, and they are the ones that gap the markets at open. If there's a huge gap and high volume, it's them. Sovereign funds, foreign funds, nonprofits. You betcha everybody is invested in the US stock market. All kinds of countries that hold treasury bills, they want to be in our market. Why? Because of the 1,000 Fortune 500 companies, most of them are US. So yeah, we own it. We stop worrying about our economy. Stop worrying about the future of America. It's all right here. You just have to participate so you can make the money out of here. And you're not. You're on the outside looking in. Small funds, asset managers have been, and small funds managers and small hedge funds have been classified by the SEC as retail. They're no longer required to do a lot of the reporting. There's AAII, Investor Business Daily, and fund management groups. They always get in late, always. There's the memes and the retail traders and the small lot investors, and you're up in here and you're trading late. And the small retail trading chat rooms trade really late because they wait for a guru to tell them what to buy. And the odd lot investors who buy a couple of shares and hope that they'll get wealthy overnight. So that's the buy side. 80% of all the market activity is on the professional side. 20% of the market activity is on the retail side. It's not 50-50 anymore, folks. It hasn't been for 40 years. So the buy-side institutions start rotating out when they see that a company's cycle, and they watch those cycles carefully, has reached market saturation. They want to get out before there's market decline of that company. And all businesses cycle. Some of them may be a year, 6, 10, 20, it just depends on the company. Wealthy private investors also get out. Corporations get out. Sell-side institutions are the market makers that get in early and start selling short. Selling short is the appropriate term to sell short a stock. And then professional traders on the sell side get in there. Professional independent traders are also providing the sell short that provides the buy to cover for those people who are panicking and selling. Professional traders on the buy side also will do some of that to adjust inventories as the price of the stock goes down or the market. High frequency trading funds, trading and hedge funds also are provide some sell short activity based on SEC approval. I'll get more into that later. Sovereign funds, foreign funds tend to get out a little bit later. Smaller funds, investment groups, and retail traders and chat groups all are this group gets out about here. Retail traders, memes, and chats start to try to sell short. They're late, they're late, they're late. And small lot investors get out because they're buy and hold and will hold forever. I'll hold for 40 years. And it's like, okay, not a good idea, but I get it. And then odd lot investors who capitulate because they have such a low capital base and they've lost it all. The buy-side institutions start at the bottom. So write it down. The dark pools always start at the bottom. So you're going to be looking for dark pools in the bottoms. Relational analysis includes technical analysis, chart-based fundamental analysis. You can see the fundamentals in the charts. You don't need to go to all those crazy, hard-to-read reports. Risk analysis is in the charts too. And quantitative analysis is incorporated in our scans, our sorts, and all the tools we provide and have written exclusively for Metastock. All of this data is in the charting software, enabling you to do a complete analysis of a stock and the company all at once. Whoa, is that not too cool? Yes, you don't have to go here or there or go to your trading buddy and chat room and say, hey, has anybody checked out what their fundamentals are lately? It's here in the charts. You just don't see it. You don't see it because you don't know what you're looking at. You just need to know how to read the charts properly, which is an integral part of TechnoTrader education. That's why so many people, retail and professional, come to us even after they've taken, I've had people that have taken like 15 courses. Oh, I spent $50,000. I'm going, how could you spend so much money and not be 90%, 95% accurate? And we're very quickly, they go, Martha, I had no idea. I didn't know this stuff. I didn't know this stuff. I had no idea. Fills the gaps, and then they're successful. This provides an invaluable, in-depth, and far more accurate analysis, speeds up the stock pick selection process, and helps you focus on the best stocks to trade, eliminating inferior stocks. Most of the time, if you get whipsawed out, it was an inferior entry. It didn't have everything knocking off, ready to go. You just didn't understand that a MACD crossover isn't enough. In fact, it's late. With relational technical analysis, traders are using far more information in a simplified trading process that generates higher profits with less time than traditional technical analysis. Let me repeat. It generates higher profits with less time than what you're doing right now. So we have written some specific indicators for Metastock. TTQA is quiet accumulation, showing accumulation and the process of how to get in. I don't have time to give all the specifics. A shift of sentiment is occurring here. Just before it starts to go down, we'll start to see some rotation out. So you know the stock is going to go down, and so you don't jump in here thinking, oh, this was a dip, I'm going to get in, and then it goes crushingly down, and you're going, I'm losing more money. You have to understand all of this to really do well. Fundamentals are in the charts. This is where the fundamentals are in this little zone. And there's buy zone going on here because this is where the fundamentals were, and this is where the fundamentals are on earnings Q3. And we can see that some people had a shift of sentiment out of there, but it came right back down here. And then these low gray bars represent the buy side institutions, not the big ones. The big ones are smaller funds and HFTs and that type of thing. So you can learn this. It's very easy to read and it's very simple to do. Risk analysis also in the chart. Oh, the stock is going up, up, up. Oh my gosh, it gapped. Well, way before it gapped, it started signaling way over here that it was going to go down, way over here. These indicators are great because they're leading indicators. They lead before, they lead price. And the biggest problem you have right now is you use candlesticks and you use all these price and time indicators, and you don't have any of the large lot indicators. You don't have any of the accumulation indicators. You don't have any of the flow of fund indicators telling which direction the money is flowing in and out because it goes over slowly. So the impact on the stock price changes slowly over time, and you're just having a good time trading, and then all of a sudden you get whacked, and it's a big whack. It's a big loss. And you're going, whoa, I don't know if I want to trade anymore. In the past, quantitative analysis analysts wrote algorithms primarily for the sell-side institutions, HFTs, and hedge funds. So they're running on quantitative analysis, and that's kind of an AI thing, kind of, sort of, maybe, but it's similar. However, buy-side institutions now use quantitative analysis for their buying and selling. They set a price. We have a spread. We have a 1 penny spread, a 2 penny spread. My floor traders, you are to buy so many number of shares of stock of this, and you have to hit the penny spread. And I've been on the buy-side floors because I'm a retired buy-side, a technical analyst. And I see these hundreds of floor traders all scrambling. And when they hit the penny and have that routed on the millisecond, and they hit that penny, they are very excited because they get a bonus. The technical traders can now employ some form of this type of analytics in the Technotrader scans in Metastock in their sorts and strategies using Technotrader tools and Metastock charting software. So we embed it in there for you. You don't have to buy some tacky thing on it. It's there. In doing so, technical traders will improve their trading process. Wouldn't that be wonderful? If you could improve your trading process, have less time. Time is money. How much are you worth an hour? How much are you worth an hour? $50, $100, $500? How much are you worth an hour? How many hours do you spend trading stocks? Minus all of the costs of trading stocks, your office and all of the other things that you have to have. How much money are you making? $4, $2 an hour? Nah, not good enough. Not good enough. In our modern world, we have to get going on this because the digital economy is taking over. We're no longer a consumer-based economy. We're a digital economy. Everything is in the financial markets. That's where the money is. That's where you need to be. Market condition analysis is an example of such application. It is far more accurate than just using the major indices value changes to determine the trend and condition. The indexes don't tell you what the market's doing. They're 8% or less of the whole body of stocks, far less than that when ETFs and all the other new products and instruments that you can trade on the stock market. You don't have to go to all the other financial markets to trade. You can trade. You'll be able to trade some form of cryptocurrencies on here. You'll be able to trade non-fungibles. You'll be able to trade the inventories of corporations with their assets sitting on a ship coming to port. You're going to have all kinds of things that you'll be able to do. The market condition analysis is my proprietary and professional relational technical analysis of conditions present at any given time. I started writing this when Howard and I had a trading floor and we had a bunch of traders, and I had to do better. I was like, futures don't work. That really is awful. It switches like that as soon as market opens, and indices aren't working. So I started writing these scans and everything 25 years ago. Oh, more than 25 years ago, I've been teaching. But back in those days, I was really working on various things, and we put it on a big, expensive, huge $5,000 platform. Metastock doesn't cost that much now, does it? You got a good deal with Metastock. And it really worked for my floor traders. It includes quantitative formulas which reveal whether dark pools are active or not, whether the market is entering a momentum mode, a platforming mode, very tight sideways action, insipid, not a lot of activity on either side, or a void, no buyers, lots of sellers, no buyers. The last few weeks when the indexes have moved down, it's because there was a void of buyers, not because people were panicking and selling. But, oh, you see these cute little meters and saying, fear, the market is driven by fear. No, it's driven by uncertainty. It's like, do I want to buy a stock? Is it going to go up? Is it going to down? Maybe I should wait a little while. I'm not going to buy a stock right now. That's not fear. That's a void, and it's indecisions, and I bet you didn't know about it. And you were trading in a void, and you got whipsawed. Voids are becoming more common nowadays as so many of the giant institutions control when their orders trigger. They can set them out automatically once their traders set the formula for them. Market voids are extremely high-risk conditions which are not visible in index action other than the fact that the stock market goes down. Oh, Dow stock market, quote unquote, news or other market indicators due to the type of order and venues giant funds now use. So let's talk about market condition. I have 7 scans that I've written, and I tweak them periodically, and they're embedded into Metastock. It took us quite a while to get there, but it was very good for Technitrader students. Momentum buy side market condition. So I'm asking the computer to give me all of the charts that are flowing with strong momentum on that particular day. Give me all the stocks that are selling down on that particular day. Then I can compare where the bias is. This is up or down. It has nothing to do with the indexes. The index has been down, but it could be showing momentum to the upside for the next trading day. Institutional activity. How strong is the institutional activity? If the market's going to be selling down, they pause. They help create the void. See what you're missing here? It's so exciting to teach. Bottoming stocks are how many stocks are bottoming. It tells us whether the market is starting to move up. After the bottom's complete, then we'll have a little bit of velocity market and so on and so forth. Consolidating stocks. Consolidating stocks. Now, who would compress price? Who would cause price to compress? Type. Any idea of the charts I showed you earlier? Dark pools and pro traders. So when there's lots of consolidating stocks and they're compressing price, they're buying on the penny spread, and then they're going to nudge that stock, and the HFTs are going to trigger because the pro traders haven't figured out how to nudge and they get in the stock, they nudge it, the HFTs gap it up, and then they sell as soon as the market opens. Wouldn't you like to do that? Range-bound market conditions, also called trading range. This is how many stocks are in super wide trading ranges, either on the long term and the medium term, and what's going on with there. And platform market condition, which is a compression where we had that starting where the bottom formed with the dark pools, bottom formed. Then they saw that fundamentals were higher than the price. So the HFTs ran it up on the earnings news. And then the dark pools started accumulating a little bit more at that higher level. And then the earnings came in good, and then the platform market formed again. It transforms into a momentum market at some point. So these are the market condition analysis scans, and they tell us a lot of information about what's going on. The platform market condition is also relational market condition. In other words, comparing current price against recent price just a few weeks ago. So that's a good comparative. By quickly comparing the number of stock charts in each scan pulls up on any given day, it is easy to determine what market condition is present at that time. I write 2 morning market reports. I get up about 3 o'clock in the morning, and I write these reports for my students so that they have all the things. I tell them what the market condition is. I tell them what the bias is. I tell them what the scans indication gave me, all of this information, so they know exactly how to trade for that particular day. From there, it's simply a matter of using custom scans designed for that market condition and to find great stocks. Cuts down the time enormously instead of trying to just find stocks on the open or, oh, everybody on Facebook is going to buy Apple. Okay, all right. The pros know you're going to do that. They're going to trade against you. This incorporates a type of quantitative analysis into the trading process in a simple, fast, and highly reliable method. So we have our custom scans and we analyze it, and then we have our list of stocks that come out of that so that you can trade and you can be ahead. The whole idea is you don't want to get in stock that's been moving. You want to get into it very low and then have it run up. And so that's what we teach. And it's very professional oriented, but retail traders love it because they can be make as much money as the professionals. They're not making a couple $100 or whatever a day. There are 6 market conditions: bottoming, platforming, moderately trending, up or down, velocity, up or down, trading range, and topping market. 4 of these are sideways patterns. Trading range is a very wide sideways pattern. Topping starts as a topping pattern, is sideways now. More, you have the flat top. You don't have the big head and shoulders tops. They don't form anymore unless you skew the data and pretend that it is, but it isn't really. So the topping actions are very different. You have all kinds of shear cliffs. You have a flat top that drops all of a sudden. That's because the dark pools are controlling their last final exit of that stock. And then the sell side institutions will see that and they'll start selling short. Bottoming market is also very flat that slowly develops. There's a lot of new kinds of bottom formations that are not in the CMT program or anything, but I hope to get them in soon. And the platform, which I described recently, the automated marketplace tends sideways about 70% of the time. Moderately trending and velocity and trending markets are for both up and down. Downside price action is very different from the upside action due to the lower number of market participant groups actively trading the downside market or selling short. So when we're buying, there's all these buyers. First the dark pools, then the pros, then the sell side, then the corporations, and the buys, and it accelerates. And then suddenly you have your retail side, and they're all speculative, emotional buyers. They're buying, I'm going to get rich, I'm going to be a millionaire tomorrow or next week. And they're buying speculatively, and then it collapses. The downside's different. You have, excuse me, you have your buy and hold for all eternity. You have, oh, it's got to go up, it's got to go up, it's got to go up. So there's only a few groups that sell short of those market participant groups I talked about. Buy side doesn't sell short. They're long-term investors. If they need to rotate out, they're already out before that market begins down. So you have to understand there's 6 different market conditions. Each market condition impacts the price action and the volume action and other things differently. And when you say, oh, Martha, this is a platform market. Oh, okay, so I can position trade and I'll get these stocks and I can swing trade with the HFTs as they move it up and you're all set to go. So market condition analysis tells us who is in control of price, which of the market participant groups at that given time control price and control it enough to manage it in the direction that they want it to go. What technical patterns are prevalent and reliable based on who controls the price. How price will behave at resistance and support. Some of you are using percentage stop losses. Stop doing that. Don't use percentages ever in any of your stuff you do. It's just easy prey. You have to have the proper resistance and the proper support for the trading style you're using. Trading styles are a specific thing that you apply a strategy to. So if you've learned a strategy, so you got to learn what a trading style is. What trading styles work best for that particular market, what indicators to use or how to adjust the indicators that you're using, the inherent risk in trading specific styles in that market condition, what trend line patterns are common. How many of you know of the 5 major trend line patterns? There's trend line patterns, there's trend, and there's trend line patterns. What entry and exit signals are most reliable? Candlesticks are great. Steve Neeson did an invaluable benefit to all of us by bringing it over in the 90s from Japan. But the reversal and continuation patterns and the pretty little terms and the 3 soldiers marching and all these other things, they're not in our market. And that's probably why it's hard for you to find stocks to trade, because you know that there's a springboard that's generated by the pro traders. There's a resting day pattern. There's a pole vault. There's a hurdle. There's all kinds of Western candlestick patterns that actually give you an idea of what the stock is going to do or what it has done and what it will do next. The Japanese candlesticks are great to study, but trying to apply all those pretty terms and all those exotic things can be very confusing, and they're not entry or exit signals. They're just either a signal that the stock may reverse at some time or it may continue at some time. That's not good enough for our modern markets and our gigantic US stock market. The strength of price and volume patterns, this is important. How strong are they in relationship to each other? A lot of you will trade on low volume. Don't do that. Low volume is warning you that there's a problem. The run is running out of steam. Market condition analysis tells you how and when to trade, who is controlling price, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. It tells you everything. It's a roadmap. Market condition analysis is your roadmap of which market participants are actively trading, which are sidelined or waiting, and where we are in the overall long-term, intermediate-term, and short-term trends. This provides the relational analysis needed to navigate the complex automated marketplace. Why each market participant group impacts price differently. You need to learn why and how each of the 12 market participant groups affect price and volume. You must understand the wide disparity between the groups in terms of venues. Where do they do their work? Most of them are off exchange now. They're not in the exchanges. Order types, TWAPs, VWAPs, there's all kinds of different kinds of exotic orders. And I have to brag a little. When we first did our first workshop, I came in after being gone to do my daily stuff, and because I was a swing trader, so I didn't watch the markets. And I came back, and Howard's talking on the phone, and he's laughing, and he's talking, and he's talking. I said, "Who are you talking to?" He said, "Herzog." I said, "Who?" And he says, "Herzog." And I said, he's whispering to me, and I said, "The New York Stock Exchange market maker. You're talking to the New York Stock Exchange market maker." I said, "What are you doing?" "Well, I had to make sure that our new order type that I just created, that's working really great for our floors, is going to be good for our students too." And he loves it. So I got off the phone. He says, yeah, he wants to use it in his floor, on his floor of his trading floor too. And he was so proud. That order type is only taught in TechnoTrader courses, is a proprietary system, and it works. The limit orders will kill you, and at market is even worse. So over the past few years, the financial markets, especially the stock market, have fractured into a multi-venue structure that has never existed before. So you have to, maybe you've got all this knowledge, but it's not working for you. Relational technical analysis makes it easy to recognize each market participant group's footprint on the stock chart. Buy zone. We have pro trader setup. I can just go through here, HFT. I can just see this, and the indicators give me information about what I need to see going on. I can't teach it all in this thing because it's a very, it's an in-depth course. Variables and order sizes. Dark pools are institutions buying tens of millions of shares of stock over time. Over time, not all at once. Their typical lot sizes for one order is 100,000 to 1 million, which are automated orders that trigger over many weeks' time or several hours in a day. So are they going to move volume up a lot? No. Spikes in volumes are not dark pools. They know what they're doing. I've seen 25 million lot orders come through early morning. Those are directly from the company. They're buying them directly from the company. Smaller funds share lot sizes range from 10,000 to 50,000, and most are automated to trigger on volume. So volume weighted at price, VWAP, is a dangerous, very dangerous order type. And it gets smaller funds into all kinds of problems. There was 20,000 smaller funds before the pandemic hit. When the market started going down in the second phase, we lost over 10,000 of them. They went out of business because they were actively trading. Didn't know what the heck they were doing. HFTs trade 60,000 to 90,000 times per minute, 1,000 times per second. Hence, their relatively small lots on the millisecond scale become large lots on the minute scale you are using. HFTs use a variety of algorithms that trigger automatically. HFTs front-run retail orders using price. They create huge volume surges, and it's a fully automated system. There are no humans, just programs. Professional traders typically use 100,000 to 1 million share lots and up, depending on their capital reserve provided to them by their firm or what they have on hand themselves. I've seen a lot of 5 million pro trader lots lately, and then I see a whole lot of high option puts. And you guys who are option traders, you think, oh, the options market knows the stock market's going to go down. look at all those puts on Apple. And then Apple goes up. Why? Because option puts are used like futures by professional traders to mitigate and hedge their risk. They're mitigating their risk. High option puts mean professionals are in that stock with a very high number. I have a friend who works, Catherine Clay, who works in options and now CBOE. And she wrote this really great program. And she says, yeah, Martha, look, this stock that you told me to check out, he's got a 5 million share lot on it. And look at all these option puts he's bought to mitigate the risk of it. And that's why a lot of the options expire worthless, because they don't care. It's just an insurance policy. Corporations trade 50,000 share lots when in buyback mode. They're not doing their own buybacks. There's no corporations that have a trading floor. But they do buy back millions of shares of their own stock over a long period of time, usually 3 to 6 to 9 months. But there'll be runs that go up, and you can trade those. Retail traders trade an average of 100 to 5,000 share lots. Is pretty typical. That's pretty small. A lot of my traders are bigger than that. Retail investors buy an average of 100 to 1,000 share lots. That's pretty average, but still small. A lot, retail. New investors buy less than 100 shares. Oh, I have a few dollars. I'll put it on Amazon and I'll spend my $130 and get Amazon for $130 and I have 1 share. And in a few years, I'll be a billionaire. Very dangerous for newbies to be investing like that. So please don't do that. I don't mean to be critical. I mean to make you aware of this situation. Variables and order types. There are many order types. Dark pools use various types of time-weighted average price, TWAP, orders which allow maximum control of the entry price. These blue are the dark pools. The little purple are pro traders. This huge spike up is memes or HFTs or whatever at market open. HFTs use algorithms that trigger on retail news, arbitrage, on popular retail indicators such as MACD. Yeah, they use your MACD and stochastics all the time. Smaller funds use volume-weighted average price, which is often automated, triggering on HFT volume. They think they're chasing dark pools, and they're chasing HFTs. Professional traders seldom use limit orders. They don't need to. They have far more sophisticated order types, including cowards, somewhere along the line there, modified many, many times over. I have to smile whenever I talk to a professional. Retail traders use limit orders, which often result in whipsaw action. Because you're buying, you're saying, give me it at this price or lower. And then that day, the stock is going down because you didn't know that the bias of the market for that day was down. And that's what happens. Nobody's picking on you. It's just that you don't understand this stuff. Small investors use market orders, at market orders, which usually fill from the broker's inventories. It just lets your broker fill it at any price he wants. Liquidity maker and takers. It's critical to know which market participant groups increase liquidity. You need to know which market participant groups lower liquidity. When liquidity falls, the relationship between supply and demand shifts, forcing prices up as the supply of shares currently being offered out diminishes. There are tons of shares of stock. You will never not be able to get a fill, but there's what is offered out at a certain price and what the bids are or the asks are for that. That's what causes the changes. The opposite occurs when there are large lots reducing inventories in exchange traded funds, for example, trusts and mutual funds. So when they start selling slowly over time, that shifts that supply and demand that's currently in the market, not overall. When huge quantities of stock are being offered for sale, this forces price down because there aren't any buyers taking it. With the fully automated market, illiquidity has become a major problem for day traders and large lot traders. Professionals don't day trade anymore. By the time the spread got to decimals, it was over. That happened in 2002. Get on board. Don't day trade. Liquidity makers and takers. Buy-side institutions are liquidity takers as long-term investors. Sell-side institutions make and take liquidity as their short-term traders. The SEC classifies HFTs as maker-takers, as many earn high incomes from exchange rebate programs. So they're making money, filling the queues at open, They make money. Professional traders are liquidity makers trading the short term. Smaller funds are takers, as most are long-term investors, but some are still actively trading and losing money. Retail traders and investors are minor takers or makers that have minimal to no impact on overall liquidity. So it's not you guys. So market venues. In the US, there are currently 13 stock exchanges. Did you know that? Where HFTs, smaller funds, retail traders, and small investors trade. That's your area. 50 plus alternative trading systems and dark pools or twilight pools where buy-side institutions and derivative developers do most of their transactions. Hidden from the retail trader, you do not see them. Somebody says, oh, I've got this system that shows that whales are there. That's your small funds managers buying a large lot. There are also some electronic communication networks left. In addition, some US retail online brokers internalize their customer orders, which is a loosely connected and multi-company venue all on its own. The SEC considers these retail brokers who trade between themselves to make more money on your orders a consortium dark pool. Retail brokers can also send retail orders to market makers such as Citadel for payment for order flow. So when you see PFOF, it means payment for order flow, and that means that your broker didn't fill your order, it sent it to somebody else to fill. Speed of execution. HFT's low latency order execution systems have the fastest execution speed with 60,000 and 90,000 trades per minute possible to date, and it has not exceeded that. SEC Midas data shows that dark pools have the slowest execution at an average of 10 minutes to fill. So that order is filled over 10 minutes of time by smaller lots. So they want to buy 1 million shares, 100,000 here, 50,000 here, 20,000 here, 100 here, 500 here, fills that. That's how they control volume. Dark pools often must wait for liquidity to appear, gathering up numerous small lots to fill their large lot orders. The retail side average is less than 1 minute. Each group's order execution occurs at a different speed. That matters. So while yours is taking time to getting filled, price can move a lot. And here's dark pools versus HFTs. Dark pools are at the bottom. HFTs are the movers. They move price. Dark pool and twilight pool activity has risen to almost 40 to 50% of the total consolidated ticker tape volume per day. Massive. It was only 10% back in 2005. Dark pools are used by the giant buy-side institutions who control 90 to 140 trillion in assets worldwide, depending how the market's doing. Dark pools provide off-exchange, over-the-counter OTC orders on alternative trading platforms. There is no market maker books. This provides two benefits to the giant fund: the ability to control their impact on price when buying or selling giant lots. They don't want to affect price at all. Avoiding HFT front running that is common in the stock exchanges. The dark pool's controlled and bracketed orders trigger automatically over time, creating a consistent price action that shows up in your charts if you know what you're looking for, and it's easy to see. Only relational technical analysis reveals their activity because we have the indicators, we have the price, we have all this stuff together to show you it's on the charts. You have a decided advantage when you use TechniTrader tools embedded in Metastock charting software. Since institutional or algorithms produce computer-generated order flow over extended periods of time, their patterns and price range are precise and repeat. You'll have a certain high and a certain low. Repetitive price action by dark pools allows the technician to prepare for sudden momentum moves. Why? Because at some point it starts to compress and compress and compress. Why do I call one of my favorite beginner buy entry signals the springboard? Because it's compressing price, and then all of a sudden the price springs out and up. Compressing price will create a spring up or down. So it allows the technician to prepare for sudden momentum moves. This gives technical traders the edge to be able to anticipate HFT and pro trader activity, as these two market participant groups tend to chase the dark pools. So it's really cute. Smaller funds also tend to accidentally chase HFT action, as they are typically using VWAP. So HFTs and pro traders and all the pros, and you want to get in and be a pro trader and be right there, because when they see the dark pool activity, they know that that momentum is coming, and it's coming quickly. Cluster orders. Many technical trading systems, including some AI, use either MACD and or stochastics for formula trading, using a rather primitive and oversimplistic algorithm. These popular indicators create inherent risk in today's electronic order processing marketplace. High-frequency trader firms use these indicator formulas in order to find anomalies in order flow. The intent is to front-run cluster orders, and they can, and they do. When cluster orders are identified by the QA formula or AI, it triggers HFT millisecond trades that can move price before the trading system's orders are filled. A normal order flow where we don't have any activity from AI or QA or whatever. Cluster orders, these are retail traders that cluster together because they're all buying the stock around the same price, or the same limit order or whatever. And the HFTs just go, okay, let's take them out. Dark pools have a consistent low and a consistent high. They don't buy the stock above that price, and they will wait to see if it falls below that price. So they halt their orders, or in this little area, it's very hard to find them. This is the primary cause of whipsaw action when using technical systems, especially for intraday. Cluster orders are the primary reason that trading systems fail. Shift of sentiment is seen in both candlestick patterns and how the short-term bottom is formed with a shift of sentiment pattern and hybrid leading indicators. We have a shift of sentiment going on, and it causes the stock price to go down, and then it causes the stock price to gap up with HFTs chasing the dark pools. HFTs search for the dark pools, giant share lots hidden on ATS venues. Often the HFT automated trigger order accidentally trades against the dark pools. This creates a temporary one-day sell down, which reverses the next day. And it's like, buy zone. Volatile price is caused by HFTs, not dark pools. The shift of sentiment occurs prior to the HFT run. Candlesticks have frequent resting day patterns, so you can recognize those with resting day patterns. HFTs are just the opposite of dark pools in terms of price action and candlestick patterns. HFTs are trying to force price to move quickly and in huge volatile or velocity intraday patterns. Gaps are far more prevalent in recent years than in prior decades, and they're gigantic. You know, we have these huge gap downs and these huge gap ups. HFTs made a big boo-boo. The stock's fundamental values are right in here. It gapped it down, and then it just the dark pools drive it back up into the buy zone. Huge gaps and extraordinarily long candles are the primary candlestick patterns from the HFTs. Smaller funds, as well as retail traders and investors, often chase HFT activity without realizing it. Oh, the stock is running, everybody in the chat room group. Let's all buy it. And then it goes in reverse, and you go, gosh darn, why did that happen? Well, HFTs are way ahead of you. HFT candles are typically one-day events and often do not change the trend. So if the trend is going down, it continues down. If the trend is going up, it continues going up after that. So relational analysis uses additional indicators incorporated into the charts. Hybrid indicators are a new type of indicator that employs more data into the formula in a more complex method. The use of uptick versus downtick analysis and small lot versus large lot activity provides leading indicators that are superior to the older style indicators in the modern automated marketplace. The original indicators that everybody still uses today, written in the 50s and 60s, were price and time because they didn't have volume at that time. They didn't have large lot versus small lot. Since more of the most important market participants use off-exchange venues and more complex orders and transactions that can be delayed revealing their activity requires new types of indicators because you have to wait till the market is closed before all of the dark pool orders are in the charts. So let's summarize. Relational technical analysis expands on traditional technical analysis. So what you've learned already is good. Incorporating more information for more reliable results. It's like the difference between grade school and high school and college. This game-changing approach to chart and market analysis is taught exclusively through Technitrader's Methodology Essentials courses in conjunction with the Metastock charting software and the tools we have embedded in it. Relational analysis works for all financial instruments. However, the market participant cycle I showed you today varies for each market. I showed you the stock market today. Market structural changes have made it necessary to not only study index activity, but also the activity of the dark pools, because they control a lot of activity. The buy-side institution's activity is hidden. Tracking the giant funds is simple with relational technical analysis. These large lot investors have distinct footprints on the chart. Front running by HFTs can be avoided or used to your advantage when you learn this unique form of chart study. RTA shows you where HFTs are most likely to trigger next on short-term trades. Accepting new concepts for some of you is going to be intimidating at times because you're so used to do what you're doing. But all technical traders need to adapt in order to succeed in the evolving marketplace. And everyone that's a middle-class American needs to learn about the stock market and start trading and investing and doing both, because you'll be left behind, because this isn't a consumer economy anymore. It's a digital economy, the first in the world, and all the other countries will follow. And if you don't have this information, you're going to be left behind. If your kids don't have this information and start investing and trading sooner, they're going to be left behind. So you have to get this stuff. We have a price for all attendees. It's a $99. It's a 24-hour bonus that you can have. You have to register for 24 hours on our website. You don't have to watch it that quickly, but you have a week's access free. I love this one. This is one of my favorite videos that I was teaching. It's got a ton of stuff in it. You can watch it as many times as you want. And if you join our Profit Hunter group, you can ask a couple questions on that, and you get your answers about that. So that helps you. And so if you're interested in our courses, you can come to our website. You have this link that I would like Jeff to put in so that you can all go here and have free access to fast track your trading.
I'm working on it. I'll get it up there for you.
Yeah, it expands on what I taught today in more detail. I could go on for hours and hours. One time I had an 8-hour thing and I was hoarse by the end of it. So there's just so much to learn, and I know I went really fast, but I hope you enjoyed it, and I hope you learned a lot. There's a lot of stuff in here to learn. So if you see the video, you can re-watch it over and over and get some more information about it. If you like what you do and you like me as a teacher, visit our website. That's all I have to say. Any questions?
No, not a lot of questions. If you have some questions for Martha, let us know. Some comments, though. Maverick, earlier in the chat, she's like, oh, actually, I lost it. I was kind of getting ready. But Maverick said something that I totally agree with. Let me go back up here. And said, Martha always gives an interesting and informative presentation. And we agree. We absolutely love it when you come in and spend time with us and talk to us about kind of like what you're doing and all that kind of stuff. So
yeah,
we did get the link for the core, the value, the the prize in the chat. I've been going for 46 hours, Martha. I no longer have any ability to
I'm so sorry. Yeah.
But
yeah.
You did a great job. So good to have you in here.
Thank you.
You can click on the link in the chat and kind of get over there for that. Good to have you here.
Thank you.
All right, very cool. Thank you very much, Martha.
Bye.
Bye. Okay, and then what I'm going to do here real quick is just kind of talk about a few other things. Let me go ahead and make myself the presenter. I'll show my screen. I want to talk about, real quick, our sponsors today. All of them have been amazing. AAII, with AAII.com. You can find out more about them there. The CMT Association, cmtassociation.org, and of course Task Magazine. Really appreciate all the support we get from all of our sponsors. Let me do this real quick because it's actually giving me the full screen image of my face instead of what I'm looking at again. And let's see, I can't get it out of the way. Okay, maybe that works. Okay. Let's do that drawing, Kelly, that we promised. Remember how oh, wait. A couple things more. I hope you enjoyed the event. All of that kind of good stuff. Is there anybody here from Australia? I'm just kind of curious. If you're in Australia, will you just say yes in the chat? And while you're doing that, welcome. If you're from the land down under, you might be watching this in the future as well. So, but we are coming and we're doing our first live presentation in person in Sydney, and it's coming up really, really quickly. So if you go to Sydney 2024, if you go to metastock.com/Sydney 2024 in January, on January 21st, we'll be doing a 2-day event down under, if you would. And we're going to start with Scott Brown. We're going to have Daryl Guppy there. We're going to do lunch. We're going to have Gary Burton. Gary's somebody that helped me design out the Haguro system in Metastock, one of those systems that I love to talk about. And then we're going to have Rahul Mohinder. He's going to come down with us. And that's just Saturday. On Sunday, we're going to come also have a couple more sessions. Kelly's going to speak. Daryl Nagel's going to speak. Rahul Mohinder is going to do 2 sessions in the afternoon. So it's going to be a great event. I love these in-person events. I'm glad we're back to kind of a post-COVID routine where we're kind of going back down there and doing it. If you're in the Sydney area or you want to come do it with us, go to metastock.com/Sydney 2024. Normally it's a $500 ticket to come. It's 50% off until the end of the year. So I'm going to go ahead and type that in here. And I'm sure that Metastock right behind me will as well. So there you go. I don't think there was a promo code for Martha. If there did, hey Martha, I know you're still there. Maybe you're still there. Was there a promo code that they needed to use for that, or was it just the website? Okay, I might have her muted. I'll unmute her. Hey, Martha, are you still with us? Okay, I don't think she was. I don't think there was a promo code either. So if you go up to the website, if I'm incorrect, just give them a call. It's very, very easy to get a hold of Technotrader. If you want to give them a call, you can go to technotrader.com, click on contact us. You can call them toll free. You can email them, info@technotrader.com. So there you go. Okay. Oh, okay. All right. Well, we're going to figure, apparently. Oh, okay. Okay. All right. All right. Well, let's, I'll get a code. Kelly, maybe if you're watching, you can back up the video just a little bit. Or Mel, if you're still with us, maybe you could type it in the comments as well, because I don't remember the offer code. Let me see if Mel sent it to me earlier. We will get it for you. Yeah, okay. I just have the, it says coupon is 2023 Traders Conference. So yeah, go up there. And at the end of the link, it says coupon equals 2023 Traders Conf. So 2023 Traders Conf. Matt, great job. I appreciate that help there. Just go ahead. That is the promo code that you will need to know as well. I appreciate that. So in any case, it will also show up on the repay as well, Raj. Okay. All right, we settled the whole business about that. Maverick says, thank you, Martha. Great information. Okay, Garth, thank you for pulling that. Okay, so the promo code is 2023 Traders Conf. We've got it. Thank you for asking. Thank you for coming in here. All that kind of good stuff. Now, I hope you didn't leave, because I promised earlier that we were going to give away a prize. Kelly, are you ready to help me give away a prize?
I am always ready to give away a prize, Jeff.
Okay, very cool. This time, we're going to give away the last prize of the day. This is the prize that we decided that you had to be present to win. So, Mr. Kelly, what I want you to do, we're going to pick somebody that's still in the attendance list. What we're going to give away is a Metastock subscription. Can you tell them a little bit about Metastock?
I would love to tell them about Metastock. Metastock's one of my favorite things, Jeff. How did you know to ask me that question?
Okay, tell us about it.
Metastock is one of the top tier technical analysis products on the market. It is designed to help you easily I scan through the markets and look for opportunities. If you've heard our presenters talking today about scanning the markets is one of the toughest things to do. It's one of the hardest things to do is find opportunities. And the Metastock Explorer can help you easily identify opportunities. And that's one of the best features of Metastock. It can also help you test your strategies, understand if they've worked historically. You can take it and you can actually look at probable future prices based off of past events. One of my other favorite features besides the Explorer is the Expert Advisor. It's going to give you buy and sell signals on your charts. It's also going to give you awesome expert commentary that's going to help you easily understand what's going on the chart, which is always one of the biggest challenges. And then it's, you know, Jeff, are we giving away the real time or are we giving away the end of day?
Real time. So we're going to include 3 months of Zenith.
Okay, so what we're actually going to do is you actually get Reuters News with it as well. So Reuters News is one of the most incredible parts of it. Being able to get Reuters News real time coming through with it. You also get an amazing program that comes with it called Metastock Zenith as well, which is a full-featured fundamental data analysis platform as well.
All right, very cool. And then we'll also throw in 3 months of Learn Metastock. How would you describe that to people?
Metastock is a great way to say, hey, I'm getting this amazing Metastock software. What is the easiest way for me to get up and running? And Kevin Nelson, who runs LearnMetastock.com, does an amazing job. He runs an amazing set of courses about not only Metastock, but also technical analysis in general to help you learn technical analysis, how to apply all that in Metastock. It's worth $100 a month for LearnMetastock.com itself. So you're going to get $300 worth of free Metastock education to go with it.
That all sounds really, really nice. Do you know I'm so lazy that when I bring on a new sales guy, I make him go through LearnMetastock.com?
Jeff, if there's one word that defines you, it is not lazy.
All right, very cool. Well, let's pick a winner. So I'm going to go ahead and let you do this. And out of the people that are still in the attendance list, why don't you randomly pick somebody?
All right, I'm going to scroll through the list.
And remember,
here.
don't dox them.
No. I'm just kind of going up and down. I'm going to stop randomly and point, and then I'm going to say John. Well, it's John G. The second.
Ooh.
One. But there's two that are John G in there, and it's the second one down, Jeff.
Okay. I gotcha. No, let's see. Maybe we can help John understand which one it is. Actually, you know what? Let's do both.
Oh,
how about that?
If you're a John G, you're a winner.
Yeah, okay. So let me just take a note of these two. Congratulations, John G. If you're still in, which you will be because you're showing up. There's two of you, so we're going to give away double prizes tonight. So I'm just taking a note of your email addresses so that we can kind of get in touch with you and make sure you get your prize. So let's see, where'd the other one go? Okay, I got it. Okay. Cool. Congratulations, John G. Okay. All right, very good. Thank you for this, Kelly. Sorry that took a little bit. All right. I want to say thank you, everybody, all of our presenters. You guys did such a great job. I was talking to Kelly about this earlier, and I just feel like the conference went so well this time. We did have a slippery schedule. We had to move some people around and make it all work, but we did. I feel like everybody came in and gave a really good lesson. And I'm really happy with how everything turned out. I hope you learned something. I want to say thank you for everybody for coming, spending some time with us. We will send all of the recordings out here in about an hour as soon as we shut down this room. That whole process is automatic. If you want a prize, we'll be reaching out to you next week to help you get it. But I want to say thank you for coming. I hope you enjoyed it. I figure it's a really, really successful event. And thank you to everybody that participated, our sponsors, Task, AAII, CMT Association, all of you guys did a great job, all of our speakers, and all of you for coming. Really, really appreciate all of that. So thanks for coming. If you do want to get your own extended trial for Metastock, I'll just say it one more time. It's won 30 years in a row. Best software in its price category. It'll help you scan markets, test trading ideas, forecast profitable price movements, give you real-time commentary, alerts. There's a reason it's been rated so highly for so many years. If you have any questions about Metastock or any of the products that we talked about over this week, we'll have a sales team here. They're going to be available for at least 15 more minutes, so give them a call. They'd love to hear from you. They'd love to talk to you. And really appreciate everybody. We'll see you again real soon. Thanks for coming.
Hi, Kelly Clement here from Metastock. Before you go, I have two quick things for you. One, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTube book, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those two things. Thanks for joining us and keep on trading.